Market continues to be all about this number, the 10-year, ticking up a touch to 413 today. Of course, as we got core PCE sort of ratifying yesterday's data. Core 2.9, looking for 3, prior 3.2, as the disinflationary trend, at least in this country, continues. We'll get Cramer's Mad Dash countdown to this final opening bell of the week in a minute.
Time for Jim's Mad Dash. Of course, we count down to an opening bell. It's a little more than 7 minutes from now. Final trading session of the week. We're going to focus in part on American Express. That's the subject of the Mad Dash. There are conference calls going on right now, Jim.
And this is extraordinary, because what I wanted from Intel I got from American Express, which is just a gigantic guide up. I mean, and it's very 9 to 11% revenue growth, 12.65 to 13.15. I think that people might have felt that he was just going to do 12. I mean, this is an extraordinary story of people going out again, out to dinner. 11% growth at restaurants, and that's Resi too, by the way. This is resonating with younger people. A global network of cards, over 140 million. The points are so loved. And Steve's comparing cash back, which nobody really knows. Hey, I got 1% cash back, versus points, which, by the way, young people love. They love points because then they use them to go take trips with, and they get the little cards and they're all excited. This is the juggernaut that should have been. I mean, the whole time Steve's been consistent, but it's finally getting credit.
But
Steve
Jim,
is remarkable.
This move right here.
Well, that was because he said that October was weak. It was really weird because October was not.
But that move right there. Now they're talking about 9 to 11% revenue growth for 2024.
Well,
has that been accounted for as a result of that move?
Yes. I mean, this got the shorts going nuts, and people thought that maybe this was the beginning of the end of this incredible growth story. It wasn't at all. And Steve's just he said, look, I look at the receipts. October wasn't that good. He didn't mean to cause this hoopla, but wow, this is such a great story, David. And if people should know that if this was the broad story. In other words, if people want to buy something, Carl and I were talking about, like there's some things that are working away from tech. This is the best. This is now the best financial. It's really extraordinary.
And they're talking
by
about
the way,
as
the charge offs aren't bad at all.
much as $13 or a little bit more, $13.15 in earnings for this year. So I guess you figure out your multiple there.
I think that this is a story that everybody can get their arms around because all generations seem to have come to this story. I remember when the Lakers, we referenced Karl Malden. Remember he was don't leave home without it?
Yeah.
Well, no one's leaving home without this thing. It's a remarkable time when, say, a PayPal, there's this guy, Alex Chris, he was going to shock and awe us with all these special things. Well, David, you know, he mentioned AI. This isn't AI, David. This is business.
We're going to talk about PayPal as we get an opening bell for you about 5
Chris Alex, what's
now.
Chris Alex? Alex Chris?
Alex Chris. Alex Chris, yes.
AI.
You can catch us anytime and anywhere.
We don't want no stinking AI.
Listen to and follow the Squawk on the Street Opening Bell podcast. We're back.
Jim mentioned American Express before the break. Jim, a couple other things that we got out of the call. One is that restaurant spend crossed $100 billion for the first time. And then they gave some multi-year metrics over the last 2 years, revenue up 40. And member spend, FX neutral, up 37.
These are extraordinary numbers. You know, when I first saw it, I was listening to Becky, and she talked about it. And I said to myself, if I'm the Fed, I got to worry. Now, we got this PC number, which I thought was fine, not that hot. And then I started thinking, and you talk to Steve, they are just taking a lot of share from everybody. But people are, they're doing a lot of DoorDash, too. It's not like they're taking out. But the country seems to have changed in terms of where we buy and what we do. I had McCormick on tonight, and they're not doing that well at the supermarket. I think people have just, we got to shift here. People don't want to make it. They want to buy it. And you're going to see from American Express, it's very clear that the desire to go out is what's happening. Airline's not as good as I thought, but the desire to go out is almost insatiable in this country.
Yeah. T&E, travel entertainment up 9, prior 13. That was a little bit of a slowdown.
But I just think this notion of what you're going to do at night has changed. And it's like every night
Looking at the market on open imbalance, 121 million to the buy side.
No more focus.
Amex definitely going to help out the Dow, and there'll be a push and pull between Amex and Intel on the 30. Let's get the opening bell here and the CNBC Real-Time Exchange. And the big board, it is crude oil shipper Okeanis Eco Tanker celebrating its listing at the NASDAQ. It's BrightSpring, KKR-backed home and healthcare services platform celebrating its IPO. Jim, regarding crude, we're at the highs of the year.
Right.
A lot of seasonal factors argue gasoline goes higher from here.
Right.
Houthis attack the USS Carney.
Yeah, I mean, I've been a believer that oil held at $70 level, and it can go higher, maybe even much higher. I would say that the LNG, Secretary Granholm, the decision to delay these plants, these are long-term projects. You really can't do what the president did if you're going to encourage long-term projects in this country. Now, I totally understand. Look, there's people, I'm sure David has a view about whether if you put so much infrastructure in for nat gas, if that doesn't hook people in natural gas. But then there are other people who say, listen, energy security dictates that this is a good thing, because Russia was 80% of the supplier of nat gas to Germany, and then it cut to 20. But this pause of approval has shocked people who are spending fortunes building these incredibly important
and there's
plants.
a lot of business models built on the idea of increasing exports, and obviously these are the export terminals that we're talking about that would go potentially all around the world.
Yes.
It's amazing what the Germans have done, by the way, in terms of building the import terminals they needed to in such a short amount of time to help them take that gas off of ships, instead of it being piped from Russia, obviously, which is no longer happening.
Oh, you're sorry. And this is going to backfire. Again, I don't want to be political, but I follow the rails. It's just going to be, CSX is a buy off this. Norfolk Southern is a buy off this. Because what this does is they just pivot and go to coal. I mean, they don't pivot. No, I don't know Norfolk Southern's quarter. I want to be careful. But CSX, I thought, was a good quarter. I thought Union Pacific was a good quarter. But David, it isn't like they're going to pivot. Have you ever heard the Germans rap on solar? It's really interesting.
Tell me, give me the rap.
It's not very sunny.
It's not 29%
of the time it's sunny. It's not Philly.
Only 29%.
Yeah, 29%. So like they're kind of stuck, and it's not. They love to pivot to solar. It would be great, and they pivot to heat pumps, which is very positive. That's something that carriers buying, but then they change the subsidies. I just think that I don't know who the president was advised on this, but they're a little misguided, and they needed to do more work on this.
Well, Granholm did say it's temporary, it's positive approvals. We haven't done one since 2018. Right. And she said, given the boom in exports, it's time to take a look. This is what she said on Squawk this morning.
Nothing will change in terms of what is currently being exported or what is currently under construction. This is just a pause so that we can have an assessment that is rationally based and then apply that assessment to those projects that are in the queue.
We're already the number one. We overtook Qatar and Australia.
No, but I was surprised. There have been some really terrific pieces about how at Davos there was a sense of let's get away from short-term, moving aggressively as we can to ESG and think more about energy security because of Russia. And this really flew in the face of what I thought was a key initiative for national security, because we spent a lot of money defending Ukraine. It was shocking for people who build these things. Shocked, and they don't.
Right. Although again, it's the plans for the new ones that are being delayed, held up right now.
But you have to spend a huge amount of time and money just citing these things.
Oh, without a doubt. No, without a doubt. I mean, we know. Listen, we know. Chenier and Freeport, I know well. Michael Smith there, so I'm somewhat familiar with it. I do wonder why we don't have these smaller nuclear plants. Like, why isn't that becoming the thing?
When you speak to Larry Culp about it, I think for the world of Larry Culp, but you can't make up clients. You can't make clients. And people just still don't trust it.
But I mean, these smaller nuclear powered.
They make so much sense. I mean, in Larry, the GE, the energy business.
It's got to be the way, doesn't it?
It has to be the way. Did you see the Fukushima pseudo-documentary? Because, Fukushima's come back to a dumping of radiation water. There's another big, not just Palestine and Starbucks, there's a lot of boycott Japan because of water dumped from Fukushima. But the Fukushima documentary or docudrama is very frightening because it basically just says you had a power plant company that was saying, whoa, don't tell the prime minister how bad this is.
Right.
I just think the press for nuclear is so bad, David, versus the reality, which we all know it would be fantastic.
It's unfortunate.
I mean, clean. It would be clean.
Given the transition, and it's going to take a while, as we all know.
Canada's trying.
Sarah, who is?
Canada. There's a small. And France never backed away from it, but we have to. I feel like it's something we should push just because we know that it's emotional. It's emotional against it, not empirical against it.
All right, back to sort of things that
Colgate had a great quarter.
You want to talk about Colgate? Sure.
Colgate never misses, David. I am so sick of they're like the Niners. They're always in the darn playoffs. They got McCaffrey now.
Instead, Morales notes that we ended the year at 3.6% for PC with a 5.3%
it's
policy
fine.
rate.
It's not. 2 years, the stock's barely up. Come on.
No, but I'm just saying that I knew that the stock has been a total winner here, and it did a great number. Now, Procter did a great number.
Just like Amex, just like a lot of other stocks have been winners since suddenly the rates weren't going to go up anymore.
I'm just saying. I mean, they've got this great organic growth. They've raised price. It hasn't hurt their business at all. And they do high-end, pet food.
High-end pet food. Yep.
And there's just something really great about toothpaste. Toothpaste, good business. It's like kind of plastic and stuff inside it, and they put whitener, and next thing you know, you're using it every day.
Every day.
And then you order it on Amazon, and I got the Sensodyne. I can't stop it. Andy Jassy, listen to me. I got like 400 things of Sensodyne. Please, I don't know how to stop it.
You're on the auto. I'm
on auto for so many. I'm on auto on Gatorade, the G. I have like my wife says, Jim, we have a pantry full of it. I said, I don't know how to stop it. It just comes.
It's another example of Colgate is where volume was a goose egg, and it's all on price.
Yes, it's
and we
all
heard
on
from
price.
Procter about how that's going to have to change.
Yeah, I do think so. Now McCormick raised prices, and it really hurt them. And I thought it was very interesting because they make things that are not very expensive. But I just think that this business, we're now starting to see the business. A lot of these stocks went down off for higher rates, but a lot of them, even silly things like GLP-1 hurt Colgate. They don't have anything that's impacted by GLP-1. I do like Colgate, but my Chapel Trust owns Procter, and we can't believe that we're actually up since Procter had been such a poor performer in that group.
Guys, the winner of the wireless wars this quarter was Verizon.
No. Are you going to the thing?
It's Verizon.
Are you going to the big meeting?
No.
You didn't get invited to the big meeting?
I don't get invited to anything Verizon.
There's a Verizon meeting.
My last interview with Hans Vestberg, I won't be getting invited to anything. That was like a year and a half ago.
This is Sound of Music. It's Verizon.
Oh, yeah?
Yeah. No, the Verizon meeting, I got invited to the meeting.
Wait, like it's on a hill?
I don't even know what you're talking about.
I'm just saying it's like that, people just...
I have no idea what you're talking about.
It's a play. They're putting on the greatest play. They said, listen, Jim, you got to come. You got to come to this thing. No, I mean, this is like, I can't believe I got invited. I've been so mean. But you
don't know what you're talking about.
There's a giant meeting, they're hosting. They have raised prices. It's stuck. A lot of people feel that it's called an analyst day, and it's Feb 5. And I'll take this as my guess.
The reason I mentioned Verizon was really in light of T-Mobile, which was ho-hum for the quarter. I mean, again, the most growth in terms of subs, postpaid, without a doubt. By far the largest of them. But the EBITDA guide has given a couple of people pause because it was a bit broader than typical or wider. Some of that may go back to this program called the Affordable Connectivity Program.
Yes.
It's been in the news a bit lately because it's going to expire. We're talking about a federal program offering eligible households discount up to $30 a month to an internet service, $75 a month for households on qualifying tribal lands. and a number of other discounts as well. They've been a beneficiary of it to a certain extent in some of their service offerings, not pure T-Mobile, but their Assurance Wireless business. Charter is a beneficiary of it. Comcast, our parent company, somewhat as well. It may run out soon, in April.
Now, Comcast,
it may not be renewed.
The numbers for wireless.
Comcast Wireless was strong. This is broadband.
No, but I'm saying it was extraordinary.
And also, yeah. No, Comcast broadband was not extraordinary.
No, wireless.
Oh, wireless.
Wireless was extraordinary, do you think?
Yeah, wireless growth for both Comcast and Charter spectrum is very large, and is by far the most subs being added, so to speak, over time. But that may be one reason why you, and follow through yesterday from our parent company to the rally off those earnings, where again, broadband subs were better than had been anticipated.
Right.
They weren't really up at all, but they weren't down much. And that was very helpful.
David,
Video
T-Mobile
subs obviously continued to decline. Wireless was strong, to your point. Free cash flow was strong. Theme parks was quite strong. Back to T-Mobile.
I don't think it was that bad.
No, it wasn't that bad. And that's what the market's saying. That's why the stock is actually now up.
But you're right, Verizon is the winner.
Verizon surprisingly had the strongest quarter, and it may be that they're a beneficiary not just of fixed wireless, which we saw 375,000 additions, but also just some people saying, I get enough on my phone. And in my home, I watch everything on my phone.
You predicted this.
And I don't need to have anything else.
Do you remember when you predicted that and people laughed?
Well, it is a question as to whether it can truly replace broadband. But for some customers, perhaps it's doing that because the speeds are quite strong on some Verizon services. So anyway, wanted to point that out.
Carl, the price wars are over.
And they did raise price.
Price wars
sort of say, how did Verizon
some of the notifications on Verizon started coming out.
Oh,
I love how they phrase it. No need to do anything.
Yeah,
no action required.
I know, it's so nice. They send them to you like it's a nice little invite. It's an invite to your funeral.
Guys, the JetBlue Spirit deal may be in trouble.
Yeah.
Just wanted to share that.
You think so?
Well, this 8K from
JetBlue.
From JetBlue. Thank you, Carl. I'm just reading it here as well. The conditions to the deal may not be satisfied prior to the outside date set forth in the merger agreement. And accordingly, the merger agreement may be terminated on or after January 28th, 2024. JetBlue telling Spirit that in terms of those certain conditions being required, not being met, of course, as we know, given the opposition from the antitrust authorities, the agreement of a federal judge, they continue to evaluate their options. But you see what it's doing to Spirit shares, which bounced a bit on the fact that it appeared perhaps they were going to be moving forward with the appeal.
Yeah, I think people should move on. If you're in those stocks, I would move on. That's
and
not.
Most have already moved on.
Spirit, that's not going to work out there.
Also got a bankruptcy filing from the Brazilian carrier Gol.
Yeah, I saw that. I remember when that came public.
Layoffs, Jim. We want to get to the list, and it's growing the last couple of weeks, but Levi's in there as well, 10 to 15% after this quarter.
That's a tough one. That's Michelle Goss has come in there, taking over for Chip Berg. Look, I think it's a great brand. I don't want to say it. I'll just say it. They needed to do it, and that's good news. It's not good news, obviously, if you're laid off, but I didn't know they should run a leaner operation. So.
They do guide below, revenue miss, even though they beat bottom line by a penny. But the list includes Jim's CRM, a few hundred.
Well, Mark Benioff is still well
watching
below.
Paramount, Lowe's, Polestar with a report this morning as well.
No, I think that when I see Salesforce, they stay. David, they seem to have, it's very simpatico with what some of the tougher hedge funds wanted.
Listen,
and the stock's up on it.
Zuckerberg started it, man. I mean...
Oh, I have Zuckerberg stuff.
And he really started it.
Yeah, he really did.
I mean, just saying. That's it. And the others have now followed.
He really did. The year of efficiency.
That was a moment.
David, people are getting, if you're late, David, do you know that if you work from home, you're more than likely, when they do the efficiency thing, to be singled out?
You are, and it continues to be. It's funny. I know we all talk to plenty of CEOs, and I still talk. We don't talk about it nearly as often anymore on air, remote work, but I still talk to a lot of CEOs who continue to be frustrated. In fact, I was with one yesterday. He said we're back to 4 days, but I got 5,000 people who are not coming in. Now, percentage-wise, fairly large company, not that much, but 5,000 people. It's like, I don't know. Maybe we'll just replace them.
Really?
Yeah.
That's a major CEO.
Because they're working remote and they've been asked to come back. And that is a conversation I've had a lot.
That's very interesting.
With any number of CEOs who continue to be frustrated by those not being met. You saw that memo from B of A yesterday.
B of A, yeah, the letter of discipline, I guess is what we're calling it.
Yeah.
But this journal data today, they're basically saying last year, if you worked from home all 5 days, you're 35% more likely to get laid off.
Yeah, look, I mean, they're all trying to, I think most CEOs are willing to accept Friday. I think
that's right.
It's very easy to fire someone when you don't know who they are. Having had to fire a lot of people in my life, if I knew the person, indeed, it's just more painful. And mine were always to save the institution. Never fire anybody like make more money. Just fire, and you just prayed that you didn't know them. You prayed that you didn't know the person, even though, of course, that's a fatuous thing because you're taking someone's livelihood away no matter what. But it is a lot easier to fire a nameless, faceless person than it is to fire someone who's right there.
We spent a lot of time on Amex. We didn't talk Visa at all.
Well, Amex is up 12. That's why that's a good thing.
Any thoughts on Visa, which is down $537 billion market cap, one of the quietest $500 billion companies out there?
Well, they have expanded their Visa Direct relationship with Meta, launching the ability for content creators on Meta's family of apps to cash out their earnings to a debit card. They have a deal with Mark Zuckerberg. And I thought this was the beginning of something very interesting. Creativity, Visa, Meta. They bothered to Meta. They spent a long time on it. I thought it was very, very inventive by Meta and Visa. Very inventive.
How about Capital One not far behind, Jim?
Well, I mean, they know how to. They are such a disciplined lender. I mean, people don't realize that they. I once got schooled by Mr. Fairbank, who explained to me how it really works, which is that if you can lose a lot of money, but make it all up if you charge people cards. They're a better lender than people realize. I've liked that stock for a long time.
That's almost a 2-year high on a name where we've been watching like a hawk. Provisions, credit quality, low-end consumer stress.
They're just a great lender, and they know that they have to have a lot of provisions, but they figured out how to make money, even though they have a lot of provisions. Some people, David, are very good at their jobs.
Yes, that is
and then
true.
Then there's.
Uh-oh, really? You're going to say?
I have to.
Okay.
Intel.
Yeah, I knew you were going to say that.
I have to. Fool me once, fool me 7 times.
Intel shares are down 12% on that quite disappointing quarter.
And
of course, we led the show with it.
12 points.
And there it is right there.
Jesus, Mobileye me. Don't Mobileye me. What a call.
Were you not impressed yesterday by PayPal's 17-minute video on innovation? Didn't do it for you. The stock of PayPal was up 10% from the time of my interview with Alex Chris last week until yesterday, and then it reversed.
I'm going to be honest. I did not think it should have been down that much.
Really?
I was surprised.
What was it down?
Well, because he mentioned AI and it went down. ServiceNow mentioned AI and it was up and then it went down. I mean, yesterday was not the day to mention AI.
It's a bad day.
Bad day for AI.
Bad day to stop sniffing glue. Right.
David, honestly, it was not a bad presentation. I was surprised that Alex Chris was met with such negativity on that presentation.
Yeah. That stock's still down a bit. Up overall, though, over the last week or so.
Well, Jim, at least when it comes to AI, you've got these reports that the FTC is all over some of these deals. So you'll have more to complain about.
They were doing so good. You know, they were starting to be sensible. I was thinking they might be more rigorous, but it's no, the FTC's back in that role of torturing all the companies that America likes. Right? I mean, isn't that it? All the companies that we like, they go after. All the companies that have made our lives better. I feel bad that I said I can stop the auto. Okay, I have to like the Gatorade. I know how to stop the auto. That's something FTC's going to look into that. So I got to be.
See how
Kramer says he can't stop the auto.
All the companies
I know how to stop
then he thought of Amazon. Then he thought of what those things he said earlier about the Gatorade keeps coming, and now.
Well, because I don't want her to come after me. Come after Jassy. I know how to stop the auto. I can stop auto.
Just showing how your mind works.
Well, I can stop auto. I didn't mean that. I don't. FTC, don't blame me.
Meanwhile, the Dow definitely benefiting from Amex up 7% here, up 50 points. Check bonds as well. Pending homes going to be the last bit of data we get this week before we roll into next week and get some confidence data, the Fed decision, the jobs number. We'll be right back.
So in 10 minutes time now at 10 a.m. Eastern time, see the release of the US pending home sales change month over month. Forecast 2%, prior 0%. The pending homes index, prior read of 71.6.
A member.
If you're looking for some week-to-date S&P gainers, it's all about the consumer. Netflix is going to lead you. Americans in there, United. Further down the list is Amex and Discover on a week where we got those spending numbers today. In fact, the spending number coming in 0.7, looking for only 5. We'll get Stop Trading with Jim in just a moment.
So in 5 minutes time now at the top of the hour, we see the release of the US pending home sales change month over month. So this data here is for the month of December. Forecast 2% on the prior 0%. Pending homes index, prior read 71.6.
It's time for Jim and Stop Trading.
Yeah, Carl, there's a lot of talk about how positive Vision Pro is really going to be for Apple. Morgan Stanley, which predilection pro Apple, did say that they thought that they would only ship about 50,000 Vision Pro in the March quarter. Now they're saying, listen, they sold 160 to 180,000, and we know that. I don't know why they choose to make this note now, but they do imply that Vision Pro is going to be it.
I love this line: 1% of the iPhone penetration, $40 billion.
Well, isn't that unbelievable? I know. I read that. I said, well, look, I mean, this install base is big. It looks like that Mike Sievert is not going to be providing a Vision Pro to people who buy it.
No, because he's not a broadband provider.
No, I know. He made that point to me. He's kind of, Jim, you don't know what you're talking about. But
Jim, really quick, I want to get tonight, and I want to know Lions Niners or KC
so
Baltimore.
that Lions Niner line was 6.5, and it went to 7, even though Debo, is still listed as 50-50. I think Debo practiced yesterday. I think he's really good, and I think they're begging to take the Lions. So be very careful. Go with the Niners, and I do think that Kansas City always finds a way to win. It bothers me because the GM of the Ravens is sensational, but I've never made any money on DraftKings going with the other side of the trade.
All right. Well, you nailed last weekend.
Coach
We'll see
Andy,
about this one.
Coach Andy's unbelievable.
And then tonight you've got.
I have Coach Andy Reid. No, I don't.
You don't.
Peacock has them.
What?
No, they don't either.
Okay.
But I do have Rivian, which I think is very, very exciting, and those games are going to be incredible. But yeah, this is we're going to the Williamsburg store in Brooklyn. My wife and I are going to. Well, she drives. She's most of the drive. We're going to try to test drive one this weekend. See what it's like.
Cool. That's nice.
Yeah, pretty good, huh?
Oh yeah.
Intel?
No, not Intel.
Oh, not Intel? Yeah.
No.
Have a great weekend, Jim. We'll see you tonight at Mad Money, 6 p.m. Eastern Time. Dow's up 28. Back in a moment.
One minute remaining. I'll lead with the pending home sales change month over month. Ten seconds. 8.3%. 8.3%, that's higher than forecast 2%, with the index at 77.3, 77.3.
CNBC.
Good Friday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live for you as always from Post 9 of the New York Stock Exchange. Take a look at stocks here in the early action. Bit of a reversal here as the S&P goes negative on the session. NASDAQ, too, down about 0.25%. Overall, though, we're capping a strong week, and we're coming off of, 5 record closes for the S&P 500 and the NASDAQ 100. Dow remains a little bit higher. Take a look at Treasuries. We did get that PCE number, the Fed's preferred inflation gauge. We'll talk about it in a second. Treasury yields move up 4.16. Rick Santelli mentioned 4.12 as one to watch, which is where we closed last week. A little bit elevated on the year and on the week. We are 30 minutes here into the trading session. Here are 3 big movers we're watching. Intel, the biggest laggard on the S&P after the 2024 guidance came up short. More on Intel's outlook straight ahead and the recent rally in the semis. Results out of cognac maker Remy Cointreau boosting that stock along with the rest of the luxury names. We're going to tell you why later this hour, talk a little LVMH. And keep an eye on Tesla, rebounding today after coming off its worst day since 2020. The stock being removed from Wedbush's best ideas list. More on Tesla as well coming up.
Last major eco data print of the week, pending homes. Let's get to Rick Santelli. Hey, Rick.
Interesting features to this December read on pending home sales, Carl and Sarah. It's 8.3% up, 8.3%. That follows a revised downward revision from unchanged to down 0.3%. This is the best number going back to COVID-affected June of 2020, when it was nearly 15. Now, here's the oddity. If you look at year-over-year pending home sales, what you'll find is that they are down 1%. Why is that unusual? Because it's the 25th consecutive month of negative year-over-year change. Now, that isn't even a record. The record was the credit crisis from 05 to 08 when you had 34 straight months of year-over-year negative month-over-month changes. And one other thing, the highest intraday 2024 trade for a 10-year, well, that's 419. The highest close for a 10-year in 2024 is 417. And as Sarah just pointed out, last Friday we closed at 412. Yesterday we closed at 412. So there's a lot of important technical areas right here for 10s to pay close attention to. Sarah, back to you.
All right, watching them with your help, Rick. Thank you very much, Rick Santelli. As far as the other big data this morning that we got, just it's been said, but we're saying again, just inflation progress, right? Disinflation progress, the PCE, and we look at core, we strip out the more volatile food and energy, and you see that year-over-year number goes to 2.9%. And the Fed, we know, wants a 2 in front of that number. So progress for investors, progress for the Fed. The Fed itself did not forecast it would be at these levels at the end of 2023. And neither did the market, frankly. I remember talking to Fed Chair Jay Powell, remember last summer in Sintra, Portugal? He didn't think they were going to get to the target by the end of next year. Well, guess what? They're closer to the target. And if you
by the end of next year being this year.
This year.
Yeah,
right.
when he said it
When
last
he said it. And they very well could be with numbers like this. I think it surprised everybody. And, some economists look at the 6-month annualized number, which you can do to sort of smooth it out, 1.9% in December. And that trailed the 2% Fed target for a second month in a row. So by some measures that some economists look at, we know Lael Brainerd at the White House does, they're already at target, which is amazing because they've done it without stressing out the labor market or sending our economy into recession. Far from it.
Hence, does it change any of the calculations about when the first rate cut comes?
So we'll learn more next week, depending on what Fed Chair Powell says about it. I think March is still kind of a toss-up, around 50% odds, but the odds increase that they'll do something. Now I think the debate is, what is the destination on rates? You know, are we going to get all the way back down? Well, I don't know, probably not. Howard Marks saying the normal is not the 0% world, right? We got to get used to he thinks a normal closer to 3.5% in terms of the neutral rate, where it doesn't hurt the economy and it doesn't help the economy. But that's going to be a discussion, I think, at the Fed, which is, okay, inflation is letting us cut rates now. Where are we going? What do we need to be doing? As far as the progress, you know, Janet Yellen has been on the tape. She spoke yesterday, the Treasury Secretary. She has been firmly in the, we're going to have a soft landing. We're going to get away with this with lower inflation. Last mile is going to be okay. But then there's the question of, why does everyone feel so miserable? So here she says lately, the inflation is now near term at close to the lowest levels we've seen in the survey. And she's talking about the University of Michigan survey. That's what she looks at for sentiment. So I think Americans do believe inflation is under control. And I'm not sure Americans do, because if you continue to listen to the polls or the political commentators or talk to ordinary Americans, they don't feel it, which is just an interesting dynamic going into election, where the economy has been good and strong, and so is the job market, and so is wage growth, and inflation comes all the way back down, and it just doesn't feel that way.
Right. Prices moved up so far in a relatively short amount of time that the period of adjustment is probably longer until you feel like, okay.
And still higher from where we were a few years ago, which I think people feel as well. And as the excess savings kind of run out, that dynamic, you know, the savings rate was down, I think 3.7% on today's number as well. So that's still play. And then the other thing, guys, is we've had all these corporate results, and the outlooks from corporate America have kind of been mixed. Some very strong, some a little more cautious. Here's the Visa CFO, for instance.
Consumer spend across all segments from low to high spend has remained relatively stable. Our data does not indicate any meaningful behavior change across consumer segments.
Good read there. And then the Levi CFO sounded a little more cautious.
We have momentum entering 2024. We are taking a conservative approach to our outlook for the full year, primarily reflecting a cautious view on the macro environment, especially in the U.S. and Europe.
Cautious view. Here's one from Capital One, because, you know, we've all been watching these delinquency rates. On domestic credit, according to the CEO, we believe that normalization has run its course and credit results have stabilized. The 30-plus delinquency rate has been stable on a seasonally adjusted basis for a number of months now. Monthly auto credit began to stabilize even earlier than domestic credit card results. On a monthly basis, auto delinquency rate and charge-off rates have been tracking normal seasonal patterns since the first half of 2023 and continuing to do so in December. So that might make you feel a little bit better about the delinquency rates. Although I would just note that it's very mixed to get commentary, even from consumer names like a Levi's versus a Visa. I don't think the visibility is very strong in terms of whether the economy is cooling and how much. And I think it just depends, again, on the income segments and on the categories, as we've been talking about throughout this recovery.
Yeah, we mentioned in the 9. That's almost a 2-year high on Capital One, which has been a name that has been at the center of the discussion about the low-end consumer, balance sheet stress, on the lookout for higher provisions. You know, it's hard to get a 2-year high with all those things in acute mode.
Yeah, we're listening for the Amex commentary as well, because people are watching these delinquency rates. The rate on credit card delinquency, early ones, is higher than where we were pre-pandemic. Auto's kind of around that. And the question is it normalizing or is it deteriorating? And that is going to be something that we and the Fed is probably going to discuss. Next week is going to be crazy because we get the Fed meeting, the jobs number, the JOLTS number. We'll learn a lot more about the underlying state of the jobs market.
All right, well, we've learned a good deal more given earnings from a number of companies this morning in terms of what it's meant for their stock prices. For example, Intel's on the move after results. Spirit Airlines actually taking a hit right now. We'll get to that. And Boeing shares, we've been watching them for quite some time, trying to hold on to some gains there, you can see, after it fell another 5% so far this week. So we're all over all those names. Let's start with Christina Partsinevelos. Philip Buzz also here to break things down for us. Christina, though, let's get to you right here on set. Intel. I mean, people were hoping for the turnaround story. This first quarter guidance maybe
was
not.
what really disappointed. If anything, a lot of analysts were expecting this weakness, but it was the plunge of the Q1 guidance that caused this just major 11% drop in the stock right now. But like I said, much of the street was anticipating a weaker quarter, but not to this magnitude. Revenue guidance was 18% lower quarter over quarter, below every single analyst estimate. So for Intel, they have three core businesses: PC, servers, networking. All of those are forecast to drop about 11% in Q1, the quarter we're in right now, which is actually a little bit worse than seasonality. The company also warned of $1 billion impact in Q1 because of three major factors. Mobileye, which we saw that there was weakness on Thursday. They make autonomous driving technology. Intel's the main shareholder, so of course that's going to impact Intel. The second point is programmable solutions weakness, which is really just these specific chips made for specific tasks. IT budgets are shifting towards AI, moving away from some of those specific chips. And lastly, the foundry business that Intel's still working through. The company did promise, though, revenue and earnings would increase quarter over quarter and year over year throughout 2024 after they get through the bottom or trough of Q1. But the street still isn't sold. And I say that because there's quite a few downgrades, price cuts. Needham downgraded to hold on data center weakness. Goldman Sachs maintains its sell ratings. It seems like a lot of analysts right now are just remaining on the sidelines. I'm going to pivot right now to another maker, equipment maker, KLA, also posted weak guidance yesterday. Much like Intel, and to your point, Sarah, analysts are noticing just this weak guidance that's coming through. And for KLA, though, it seems like there's a little bit more confidence about a path to recovery. That's why Morgan Stanley uses recovery as a justification for its big price target bump of $635 from $500. But you can see the stock is still down 6%. And lastly, I'll leave with shares of data storage firm Western Digital, also lower despite the inline report. Concerns weaker memory shipments. And that's why you're seeing the stock down 3%.
I mean, the stocks have been strong, right? They've led the market to start the year.
Yeah, there's really a divide between compute, which would be AMD, Marvell, Broadcom, obviously NVIDIA. Those guys have been doing really well. And then the analog, Texas Instruments, a little bit weaker. A lot of concern about, double ordering within the auto sector. So On Semi would fall into that category, Mobileye. And then Intel, that is promising this year of transition. And it seems like this year of transition keeps getting pushed out.
Data center, they're just not there.
Data center revenue in Q4 was down 10% year over year. And then, for Q1, they're anticipating further weakness. The problem with that is that they have lost market share to AMD. But they're promising that things are going to improve, Q2, Q3, Q4, so that they'll still see a year-over-year increase.
Also had a big run-up into the results.
Yeah, that's a good point, too. It was actually a larger run-up than the SMH and the SOX. So I think expectations were a little bit too high going into the earnings, which is why you're seeing this massive 11% drop right now.
All right, thank you, Christina.
Thanks.
Christina Partsinevelos. A lot of news on the airlines today, including Spirit, which is dropping 15% right now. Let's get to Phil LeBeau with the latest. Morning, Phil.
Good morning, Sarah. And the reason Spirit is down is because of an 8K that was dropped within the last hour from JetBlue. It was a very short 8K, essentially saying that they are looking at the merger agreement with Spirit and that if certain conditions, certain terms are not met, they can terminate the proposed merger on or after the 28th, which is Sunday. I bring this up because not only is that in the 8K, but remember that next week we get JetBlue's quarterly earnings announcement or financials. And so you get the question here, and I know it's going to be coming, is this them setting up, say, Sunday or Monday or Tuesday? We're done with this merger. Then they have the financial announcements, and they can, to a certain extent, wipe the slate clean and go from here. Again, no indication that they have decided to terminate the merger, but the language in the 8K says that they have that option as of the 28th. They are assessing all of their options when it comes to this proposed merger. That's one story in the airline industry. The other story has to do with the 737 MAX 9 and the return to service. You've got Alaska Airlines bringing its first MAX 9 that has gone through the enhanced inspections that were approved by the FAA. It will go into service a little bit later on today. Yesterday, we talked with Ben Minicucci. He said that he expects all of the grounded MAX 9s to be back in service within a week. The total number of MAX 9s that have been grounded essentially for the last 3 weeks, 171 worldwide, but the bulk of them are flown here in the United States, United having 79, Alaska with 65. Speaking of United, and as you take a look at shares of Alaska and United, going back to January 5th, the date of the incident where the plug door was ripped off that Alaska Airlines plane, This is what the shares have done. The United 737 MAX 9s, those inspections have begun, and the first of those MAX 9s is expected to return to service on Sunday. Finally, take a look at shares of Boeing. And remember that Boeing next week will report its Q4 results. Curious if they pull their guidance, their long-term guidance, which is to get up to 50 MAX 9s per month being built in 2025, 2026, also $10 billion in annual free cash flow. That's the long-range guidance that they have had out there for some time. Does that stand? We'll find out on Tuesday, or on Wednesday, I should say, when the company reports its Q4 results. Guys, back to you.
Hey, Phil, it's David. On JetBlue Spirit, I don't have great insight there in terms of reporting, but there is a possibility that they're going to use this JetBlue as leverage to get a price cut, then they pursue the appeal. That's always a possibility here. But I wonder...
That's a possibility, too.
From a larger perspective, do investors think JetBlue would benefit at some price from acquiring Spirit, or even the price as is currently constituted?
I don't think they think it at this price. I think investors do not think it's a good deal. I think if they can get a much lower price, sure, it's probably a good deal. Remember, the appeal of Spirit for JetBlue is in the aircraft, and the fact that JetBlue needs to grow. It is confined in terms of how it can grow, in terms of adding aircraft, adding pilots. This is one relatively quick way, I say relatively quick, once it's all approved and so forth. If it were to go through, this immediately bumps them up to more than 10% market share. That's what they need in order to grow. And so it'll be interesting to see if, in fact, you're right, David. Is this their way of saying to Spirit, you know what, we want a lower deal? We'll stick with this on appeal, but we want a lower deal, or if they just walk away from it altogether. Because an appeal, David, most believe it's 4 to 5 months. Do you want to go through this for 4 to 5 months? And do you think you're going to have a different outcome?
Yeah, exactly. No, and certainly possible they do get a price cut at the very least here. To your point, though, of course, they couldn't just walk away. It's only a couple of days. Thanks, Phil.
Spirit bonds are getting hammered, too, as people wonder what the future is.
Yeah, listen, I think those who believe that there will be a bankruptcy in its near future, I mean, Phil will tell you, they've got enough liquidity. It's not that, but certainly they're hobbled.
Yeah, hobbled. All right, the saga continues with Spirit down almost 16%. As we head to break, here's our roadmap for the rest of the hour. The S&P comes off another record closing high. Next week is a crucial one for the market, shaping up to be the busiest week of earnings season, plus a Fed rate decision and a jobs report. We're going to discuss the setup for your portfolio.
Plus, it is the worst performing group this year, but could we see a bit of a turnaround if and when the Fed starts to cut rates? We'll take a closer look.
And Tesla shares coming off their worst day in about 4 years, struggling to keep up with the rest of the Mag 7, which Cramer's already kicked him out of. We'll talk about where the street stands on the stock and its valuation when Squawk on the Street continues.
Taking a look at the Fear and Greed Index, 77 out of 100 equaling extreme greed, and the Crypto Fear and Greed Index, 49 out of 100 equaling neutral. And looking at the VIX, currently up 0.52% at 13.52.
Dave.
Welcome back to Squawk on the Street. The S&P comes off another record high. That's 5 in a row. And of course, next week is shaping up to be a critical one for the markets. We're going to go into the busiest week of earnings season. We've got a Fed rate decision to navigate, a jobs number on Friday. Let's help you get set up with Morgan Stanley Wealth Management Chief Investment Officer Lisa Shallett, who's back with us. Lisa, always a pleasure. Good to see you again.
Great to see you, Carl.
So, market's done a lot of wood chopping here. It's been hard to shake you off of your cautious stance. Where are you on that?
Well, look, I want to be super clear. When we talk about our caution, what we're really talking about is the market cap weighted S&P 500, which, as we know, has become extraordinarily concentrated in those, top five, top 7, top 10 names, however you want to define it. But we're not, cautious about things to do, right? We know that the U.S. economy has been extraordinarily strong, surprising almost all expectations, including the Fed's. And that, tends to be good for value-oriented styles, for cyclicals, for industrials, for parts of consumer discretionary. And so, we're encouraging opportunities there, and we're encouraging opportunities, quite frankly, in investment-grade bonds as well, where, we've been in the camp that says these rates are gonna hang in there. Yes, we're biased, that rates are to the downside, but with yields where they are, they compete very effectively with stocks. So lots of things to do. We're just not, jumping on chasing that market cap weighted index right here.
When it comes to the Fed, I think we had a graphic a moment ago. I think you're still in the May-June camp. I am curious, though, how you expect the rhetoric, at least, to begin to shift so as they prep the market for that time, if in fact that's what happens.
Yeah, look, I think the Fed is going to have a tougher time because the data flow, certainly since December, has not, on the growth side of things or on the labor side of things, suggested any signs of weakness. The inflation data has been certainly a bit more cooperative. And we have said to folks that may have gotten a little bit too much good news on that score, where the fourth quarter related inflation numbers may be exaggeratedly flattered by very low commodity prices, by the tailwinds on oil and gasoline prices, and manufactured goods disinflation that really has been accelerated by weakness in China. So we think inflation might be lumpy. So to answer your question, we think the Fed's going to have to do a little bit of a rhetorical dance, certainly leading into March. But, to get closer to mid-year, that's when this lumpier data, I think, could be challenging for them. And I think they're going to have to start talking about cuts in the context of a broader program that includes potentially tapering their quantitative tightening program, which I believe is what this is all really about.
Yeah, I mean, the market's excited about all of the above. Lisa, what do you say to people who have been putting money into those money market funds, right, that are getting high rates, into cash? We were expecting in 2024 that would start to come out as we've seen rates come down, but it really hasn't. So should people continue to do that, or should they chase yield elsewhere?
Look, I think we've been very clear, 5.4% or those types of rates are at a 17-year high, and we understand why they're attractive for people. But we've also signaled that they're likely to be short-lived, and we can't time these things. And so as we go into a rate cutting cycle, that really is when you want to put your cash to work. We have encouraged folks to put that money to work in a very diversified manner, as I said, buying stocks, but buying them in a little bit more of an equal weighted or actively managed stock selection type approach, buying into investment grade credit, maybe adding some of the real assets and things of that nature. And certainly for our clients who tend to be on the wealthier side, they can participate in alternatives like hedge funds or the private markets.
Well, next week is going to be a busy one. A lot more information headed our way, Lisa. Look forward to working over that with you. Good to see you again. Lisa Shallett.
Take care, Carl.
Still to come, a look at one of the worst performing S&P 500 sectors over the last year. Could lower rates ahead mean a big rebound for this group? We'll explain and tell you what it is right after a break. Welcome back to Squawk on the Street. Before we hit the break, we showed you a mystery chart. It is of the utilities sector. It's been a big underperformer, at least compared to the S&P. That's over the last 12 months. Let's get over to Pippa Stevens. She has more for us. Pippa.
That's right, David. Utilities were the worst sector in 2023, dropping about 10% compared to the S&P's 21% gain, making it utilities' worst relative performance in the last 45 years, according to Wolfe Research. The losses came as higher rates took their toll, but with rate cuts on the horizon, now could be the time to buy since the sector typically outperforms before the Fed starts to ease, according to Wolfe. Now, utility companies are forecast to post year-over-year earnings growth of 34%. That's the second highest of all 11 sectors and far ahead of the overall market. Now, on a stock-specific level, AES, NextEra, and Sempra Energy are trading at the largest discount to the average analyst price target you can see there. And with the sector's valuation around 15 times forward earnings, American Water Works, Constellation Energy, and Southern Company are the most expensive, while Eversource, AES, and NRG are the cheapest. Carl?
Pippa, thanks. Talking a little bit, Pippa Stevens. Still to come this morning, more on what this morning's inflation print means for the Fed next week with Moody's chief economist Mark Zandi and why he says the economy is, quote, crushing it. Stay with us.
Welcome back. I'm Courtney Reagan with your CNBC News update. The United Nations highest court ordered Israel today to take all measures within its power to prevent acts of genocide in the Gaza Strip. However, the ruling stopped short of ordering the ceasefire requested by South Africa. Former President Trump stormed out of the courtroom this morning during closing arguments as the attorney for E. Jean Carroll was telling jurors that Trump is a liar who thinks the rules don't apply to him. Writer E. Jean Carroll is seeking at least $10 million from the former president for the harm to her reputation from the comments he made after she accused him of sexual abuse. Trump called her allegations a hoax and a con job during brief testimony yesterday. Well, the estate of late comedian George Carlin filed a lawsuit to pull the plug on an hour-long AI-generated special uploaded to YouTube. The video uses the technology to mimic the late comic's voice and style of humor. Carlin's family says it equates to theft of his work and called it computer-generated clickbait. I'm sure this is not the last of stories like that we're going to hear. Sarah, back over to you.
I was just going to say, this is a whole new can of worms.
Yep.
Thank you, Courtney.
Thanks.
Courtney Reagan. The Federal Reserve's preferred gauge of underlying inflation today, rising at its lowest annual rate in nearly 3 years in December. Traders now pairing bets on a March Fed cut. Moody's Analytics chief economist Mark Zandi joins us now. Mark, it is hard to believe that we are here with 2.9% on core PCE. We just got this GDP report at 3.3%. Annualized, even higher nominal GDP. I mean, I always give you credit because you said soft landing when everyone else was calling recession. So what does the Fed do next?
Well, a cut, it's just a question of when, Sarah. I don't, March, May, that's 6 weeks. I'm not sure it makes a difference. I wouldn't argue with anyone who said March, but, my sense is that they'll probably, push comes to shove, wait a little longer, just make absolutely sure inflation is at target or headed to target before they make that move. But, we're here. And you're right, very surprising. I mean, even for me, I didn't expect we'd be at 2%. I mean, in fact, if you look at core consumer expenditure deflator inflation over the past 6 months, it's less than 2% on an annualized basis. So we're here.
We're here. How do they, will it last? It's hard to believe that they managed to get the soft landing that they wanted, but I don't know. Too much of a good thing?
Yeah, I think we're, there's always going to be a struggle, but I think there's good reason to believe that inflation has come back in. Inflation expectations are well tethered and anchored. Wage growth is moderating, consistent with productivity growth. All the things that one would look at to gauge whether inflation is going to remain stable and low are in place. So I think we can state with some confidence. But, things happen. One thing I do worry about is oil prices. Very hard to forecast where they're going. A lot of cross currents there in global markets and given all the geopolitical threats. So if oil prices go back up, I could scramble things at least for a while. But, barring something unforeseen, it just feels like, inflation's back in the bottle.
Is it back in the bottle, though, for ordinary Americans? Because, I talk about all this progress all the time and how Secretary Yellen is very thrilled with these results and President Biden should be very happy. And then everyone says, you don't know what it feels like. We're still paying much higher prices than where we were several years ago. We're still not at the point we're all the way back down. People still are feeling the effects of high inflation, and they're pointing their finger at the administration for fueling it.
Well, you're right. I mean, inflation, the rate of growth has slowed back to the Federal Reserve's target, but the level of prices is obviously a lot higher than it was 2-3 years ago.
U.S. natural gas,
particularly for staples. I think food is kind of at the top of the list of pain points for many Americans, particularly lower middle income Americans. Rent is also a lot higher. I mean, rents have gone flat to down over the last year or so, but they're still way, way above where they were 3 years ago. In energy also to some degree. So, the staples that people need, prices are a lot higher for those things. So I get it. It is a lot of financial pain. Good news, though, is that people's wages across the wage distribution, high wage workers, low wage workers, their wages are now rising much faster than the rate of inflation. So with each passing month, that financial sting that people are feeling should feel less painful going forward. And I think 6 months from now, a year from now, people won't be as concerned about inflation as they were. Now, just really quickly to your point about blaming the administration, I don't think that's fair. I mean, I do think early on when we got the fiscal support, that did support juice up inflation, but that was hard to remember back then. But back then, that was desirable inflation. We had been through a period of a decade or more of suboptimal inflation. Here we were, we got the inflation we were all hoping for. But since the last year, 2 or 3, it's more about the pandemic and Russian war. It has nothing to really do with the fiscal policy.
Mark, I'll end on geopolitics. So we report, obviously, every day on new attacks in the Red Sea. Thankfully, not coming to much, but diverting a lot of traffic. Price of oil's hit a recent high. Any thoughts there in terms of what that could mean overall for economic growth if it continues to fester?
Yeah, well, lots of scenarios, but the most likely scenario is that while disruptive, it's not going to get to a place where things completely shut down, the trade doesn't completely get disrupted here. And if that's the case, if what we're seeing now is what we're going to see going forward here, it's an irritant. It adds to goods inflation, but it's really on the margin. I mean, at the end of the day, goods prices are only 20-25% of the consumer basket. So if you kind of do a little bit of arithmetic, it's no big deal. Now, having said that, obviously, you can construct darker scenarios, and if trade gets completely shut down, that would be a bigger deal. But, I don't think that's the most likely scenario.
Mark Zandi, good to check in with you on this fresh batch of data. Thank you for joining us.
Take care.
Mark Zandi from Moody's Analytics. Still to come, Tesla's post-earnings plunge, erasing more than $80 billion in market cap for the name. Is the dip a buying opportunity or indicative of tougher times ahead? We're going to discuss with one former board member of the company after the break.
Tesla shares trying to get back some energy today after their steep drop yesterday. Worst day in a few years, but still on pace to end the week down more than 10%. Let's get to Dom Chu and see where things stand. Hey, Dom.
All right, so Carl, we are still a far cry away from where we were at the peak market value for Tesla back in the early part of 2022 when it was worth close to $1.25 trillion in market cap. Now under $600 billion now. For Tesla, though, still over the last year up 15%. But again, we've seen some movement down to the at least shorter to medium term to the downside here on Tesla. So how exactly do things stand after the earnings report and then where analysts have kind of tilted their coverage? Well, it turns out that a lot more of them are a little bit more neutral on them these days. Currently, Tesla shares and the analysts who cover them have about 39% of them saying buy, 45% say hold, and roughly 16% have a sell. They've got a $221.25 average target price. That's according to data from FactSet. That implies roughly a 20% gain from current prices where we are. So we'll see if that trend holds. And then if you take a look at the way things stack up with regard to Tesla's valuation from a price to earnings perspective against some of the other mega cap technology and communication type names out there. Forward price to earnings ratio, so what you pay today in price for every year or every dollar of expected earnings in this past year. Meta Platforms is currently at 22 times. NVIDIA is at 29 times. Microsoft at 33. Amazon at 42. And Tesla currently trades with a forward valuation of 55 times earnings. So, David, when you talk about the relative valuation, yes, these are not apples to apples. They all do kind of different things. But to put it in kind of that mega cap technology perspective, it still trades at a relatively rich valuation compared to other mega cap tech stocks. I'll send things back over to you, David.
Particularly as estimates come down for this year and next. Don, thank you. Our next guest saying when it comes to Tesla, he doesn't always agree with Elon Musk, but he made the company what it is. Let's bring in a former Tesla board member, Steve Wesley, to discuss. Steve, always good to have you. You've been positive and rightly so for quite some time on the company, on the stock to a certain extent, but I do wonder after listening to yesterday's call, obviously, the competition that has come to the fore, the price cuts, the lack of any real catalyst in 2024, seemingly, where you stand right now.
Well, look, let's give Tesla credit where credit's due. They've just posted not one, but 3 consecutive great years. They grew 71% in 2020. They grew 51% in 2021. Last year, 19%. Those are great numbers. The challenge is going to be 2024 because they're in between new product offerings. The Model 3, Model Y, phenomenal successes. Model Y today, the largest selling vehicle in the world, gas or electric, stunning. But what about 2024? What they really need to catch up growth-wise with the BYD that grew proportionally 70% last year, delivered 1.6 million vehicles to Tesla's 1.8. They're going to pass Tesla this year for sure. Tesla desperately needs to get that $25,000 model into market by late next year. So for this year, you know, they've got 3 shots on goal here that they're telling analysts. You know, the first is the $25,000 model, but how soon can you get that out? The second is they're clearly a leader in autonomous driving robo-taxis. I think that's at least 3 to 5 years out. The interesting play that few people talk about is the Tesla Energy division did $6 billion this year. It's growing at 54% a year. They're working on being essentially the world's largest utility. That's an interesting play. Those are numbers most auto companies would die for. But 2024 is going to be a tough year. Tesla's going to have to execute on everything they do, from opening the plant in Mexico to getting the plant in India built to selling some more Cybertruck. It's going to be an interesting battle, and the Chinese are coming.
Yeah, the Chinese are coming. BYD has an automobile out there that is a real competitor, not just in the Chinese market, of course, but in Europe as well. Probably never going to be here. So I wonder, are they up to it? Do you think that, you know, again, that timetable, Musk has typically been optimistic when it comes to the timing of things and sometimes wrong. Do you think they can get there in terms of that model you're talking about to make them competitive as soon as the end of next year?
I think they'll get initial sales out by then, but they need to do better. Here's the big picture most investors don't fully understand. We're living in an international world. Tesla dominates the U.S., 51% market share, more than everybody else combined. But we're now the second largest market in the world after China. China sold 8 million EVs last year. All of Europe together did about 2.6 to 3 million. U.S. and Canada did 1.6 million. So where do you want to be number one? China. So U.S. dominating, Tesla dominating in U.S., dominating, frankly, in Europe. But they've got to get out to that rest of the world because that is where the money's being made. But there's one other issue investors need to look at, and that is for the last 10 years, when it comes to EVs, it's all been about range and price. Now it's moving over to being about tariffs and privacy. Because as you point out, will Tesla and will BYD come to the U.S.? They're absolutely coming to the U.S. They're already selling buses here successfully. They've started selling in Europe. But consumers are increasingly going to ask the question, do I feel comfortable driving a car with a Chinese IoT device that knows where I'm going, maybe listening in on me? That's a big issue. And then the tariff issue is another big one. U.S. needs to be careful on tariffs because we may feel good with the 25% tariff we've slapped on, but there's a much bigger auto market in China than there is here. And if China reciprocates, we may think twice about that.
Yeah, I mean, Musk alluded to that. Steve, what about just the promise of growth in the U.S. market? And that was, I'm thinking back about Dom's PE lineup about how it's even richer valued than some of the big tech stocks. I mean, don't even try to compare it to some of the auto stocks in terms of valuation. And the idea was that Tesla is dominant, it's a leader, and there's just so much growth. Are there questions now about the kind of growth for electric vehicle adoption in the United States? Like, are Americans going to get there? Is that our future still?
There is no doubt every auto company in the world is going all electric. And the simple reason for that is battery prices went down 14% last year. They're going to go down another 10, 12, or 14% next year. They're simply put, not only going to be better, they're going to be cheaper. But the big issue is you've got to, because Tesla's done so well in the luxury market, in the middle market with the Model 3 and the Model Y, they need a market for people that are first year out of college,
That's 11
teachers,
a.m. Eastern time.
firefighters, and so on.
Budget balance.
They need that $5,000 mark. They took a little too long to get there. They may pay a price for it. Longer term, I think the company looks great.
Steve, real quick, if you were on the board right now, how would you react to Musk's discussion slash asking for this more voting control? Would it be something you would say, sure, you can have more voting control?
Well, thankfully, I'm not on the board right now. But look, we just lost $80 billion of market cap. I think the shareholders have spoken on that one. Look, it's tough for the board because Tesla has, Elon's made this company. But do I see them giving him, $80 billion bonus or 25% control of the company? I think that is a longer shot. But plus, he has his own AI company, so there's an inherent conflict. I think that one's a stretch. We'll see.
All right, Steve, always appreciate it. Thank you.
You bet.
After the break, shares of Remy Cointreau on pace for their best day in over 2 decades. Other luxury stocks also following suit, including LVMH. Take a look at that. What is that saying about the consumer? We'll have that next.
White House economic advisor Brainard says the very strong disinflation on goods is tempering. House Speaker Johnson says a pause on liquid natural gas permits is outrageous.
Good day so far for luxury stocks after results of out of multiple companies this week. Let's bring in Robert Frank for more from the man, of course, who knows all things luxury. Robert.
Good morning, Dave. We're looking at an $80 billion rally in these luxury stocks today. You look at LVMH, that's having its best year in 15 years. Remy Cointreau having its best year in 20 years. LVMH adding nearly $50 billion to its market cap, about $20 billion in wealth just today to Bernard Arnault. And this was because there were so many questions about luxury at the end of last year. LVMH answered those yesterday. Asia ex-Japan up 15%. China is really strong right now. No one really expected that. And the U.S. was strong, up 8%. So this is even carrying Burberry, which had a terrible quarter. But now others looking into these other results saying maybe things will get better the rest of this year, David.
Yeah, I mean, explain some of this to me then.
At 11 a.m.
Particularly
Eastern
China,
time,
where we continue to hear the
balance
economy is
prior,
weakening,
minus
consumer demand is not particularly strong. What explains this?
I wish I could explain it, David. I was very surprised at these numbers. You look at the macroeconomic data in China. When I hear about what the wealthy are doing, they're trying to get as much money out of the country as possible. But they are spending on luxury. They're not spending in Europe as tourists as much as they used to. That is still down about 30% for LVMH from pre-COVID. They're hoping that comes back. But within China, maybe it's because the wealthy don't have many investment opportunities right now. They are buying a lot of luxury.
And what explains Burberry? Again, to your point, it's up today, but it did not have a good quarter.
No, Burberry created a new line. They raised prices dramatically without proving there was a sort of commensurate increase in quality or design. So they've got their own sort of creative problems, but the rest of the sector, especially these must-have brands, Vuitton, Dior, Cartier over at Richemont, they are having a great beginning of 2024. We'll see what the rest of the year looks like. But LVMH in its guidance yesterday said the trends continue, at least as they've seen it in January. So investors like that as well.
Yeah, I mean, earlier this week, remember we were talking about this with Ralph Lauren, CEO, who I spoke to, who is very bullish on China this year. They're coming off of a lower base, but continues to see growth. I also thought the Sephora numbers inside that LVMH number, Robert, 25% growth. I mean, its business is surging. Is that in the U.S.?
It's the best performing part of the LVMH. Many people don't even realize LVMH owns Sephora, but beauty, health, wellness, that is a strong trend in every company right now. Sephora just crushing it in the quarter.
Robert, thank you for the update. You can see many of the names right there. And again, interesting strength in China and here, as we just pointed out, in the U.S. Speaking of strength, the markets continue to show some resilience as well. The S&P is up. NASDAQ underperforming a bit there versus the broader market, but nonetheless up as well. We'll have a lot more coverage of our markets and the European markets. That's when they close next hour. Live market coverage continues right after this.
1 minute remaining. -10 seconds. -4.01 billion, -4.01 billion. According to a poll, remaining 10 analysts
Good Friday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live on the floor of the New York Stock Exchange. Today, former IMF Managing Director John Lipsky joins us now at NBER on why the Fed will be slow to cut and his reaction to this week's strong data.
Then, is the EV revolution already starting to lose its charge? The B of A economist behind that call is with us this hour.
Later, can today's debut spark a return to form for the IPO market? Former NASDAQ CEO Bob Greifeld joins us to weigh in.
Meanwhile, while we were watching some other stuff, all-time highs here intraday on the S&P 4906. That's, of course, following 5 straight record closes. We'll watch that as a lot of things are working today, including some financials, Amex and Capital One, even Visa to a lesser degree helping out on that front.
Yeah, I'm watching Treasury yields as well because the 10-year note yield is a little bit elevated, certainly from where we started the year and where we started the week, 414, despite the fact that the inflation numbers continue to come in sort of benign. We got that PCE number, 2.6% year-over-year inflation growth, core 2.9%. Investors are bracing for another week of big data and big events. We've got the Fed rate decision, consumer confidence, the jobs report, add to that earnings from Apple, Microsoft, Alphabet, Meta, and much more. What will be the biggest drivers? Let's bring in CNBC senior markets commentator Mike Santoli. How are you preparing for next week?
I mean, the stakes are pretty high, and what I observe in the market is that there's at least an awareness of upside risk as well, right? You're not seeing urgency to sell the highs in the S&P 500, even though arguably a relatively messy start to earnings season. Not so much that, big bellwethers are failing on the earnings, but that there's been a little bit of a muted guidance, and you could make the case that the macroeconomic numbers aren't fully reflected in a lot of the earnings reports of cyclical companies. I mean, I'm not saying it's something to worry about, but you could make that case, but the market's not seizing on that right now. I think it is because the burden of proof is so high on somebody who says, we don't have a soft landing, because all the numbers are moving in that direction. You mentioned Treasury yields. I don't know. We still have room until I think we get to the worry phase of 4.25 above on the 10-year, and just stacking up all the things we know about the Fed's posture based on what they've told us. It's hard to come up with they're not going to look for an opportunity to ease pretty soon.
Meantime, oil's set for its best week since October. This will be 2 winning weeks. We got some news of fresh attacks on the USS Carney by the Houthis, we believe. That said, I mean, there's more discussion about an undershoot if rent starts to play along here in the coming months.
On inflation, for sure. Yeah, and I think that's what has everybody very confident about directionally where we're headed on inflation. We're at 4,900. You're up 20% in 3 months on the S&P. Let's think about that for a second. And so therefore, one of these 3% wobbles can come out of nowhere. But next week is really when the drivers of S&P earnings show up. And that is the big, the big 7, whatever you want to call it. The big NASDAQ stocks are not just the better performers in the market. They're the ones that are driving the overall earnings picture. So that's going to determine whether we can justify valuations.
And their CapEx guidance, I imagine, just
all of it, right? I mean, the economic heft of those companies, combined with the seasonal stuff. And, if we get into February, it gets a little choppier. You have new, year ahead money coming into the market right now. But right now, I'm I'm looking for cracks in how the market's behaving, and you're not really seeing a lot just yet.
Well, keep us posted on that, as always, Mike Santoli. Those economic indicators telling a pretty good story today. Jobless claims yesterday rose a bit, but still remain historically low. Durable goods orders flatlining, but on the plus side, GDP beating estimates by 130 basis points. And this morning saw beats on consumer spending and core PCE coming down. So what will the data mean for the Fed as it gets set to meet next week? Joining us now is NBER Director, former Deputy IMF First Managing Director, John Lipsky. It's good to have you, John. I mean, I remember having you on last week saying, are you guys going to say this is a recession? Is this going to be a recession? Is this going to be a recession? I guess it's a good thing that you never came out and did, because who would have thought we would have seen these kind of numbers right
positive, now? Last up, 0.3%.
Absolutely. The conventional wisdom certainly was that there was going to be a recession. There were reasons for thinking that, but that kind of interpretation was trying to apply standard analysis to what the pandemic, which was a completely unique situation. Right now, there's no obvious sign that for a recession in sight. There are risks, but I would say at the current time, the risks are more politics and geopolitics than economics.
How do you think about the geopolitical risk on the economy? Is it high?
Well, first of all, one of the surprises, and surprise for most economists and certainly for the Fed, is that at a very low unemployment rate, you've seen continued solid job growth, but declining inflation. That's not a conventional outcome. So it's taking them some time to think about this. But going forward, things are going to certainly likely to slow. And the question is, can they continue to see this solid job growth and declining inflation at a very low unemployment rate without producing price pressures or signs of a corporate cutback in expansion?
John, given all that, we just mentioned rent, median new rents down 8 straight months. We're looking for signs that maybe hiring trends are moderating to a degree where there's more discussion of an undershoot, at least on PCE. Are you on the watch for that?
Oh, yes, certainly. But I don't know about an undershoot relative to good forecasts, but it's been recognized for some time of the lag in the housing component in the price indexes that suggests we're going to continue to get good news on overall price indexes. The question is, will we continue to see favorable news on core measures excluding housing that will give the Fed comfort and investors comfort that inflation really is coming down? And the old argument that the last mile between 2 and 3% is going to be very sticky is going to turn out to be as wrong as the earlier pessimism about the prospects for declining inflation without rising unemployment.
Right. Atlanta Fed took a crack at that a couple of weeks ago. I think they did a paper, that said, is the last mile more arduous? And their general take was no. Do you agree?
I do. It's not. I've never quite understood why that last bit is going to be so much harder, when, after all, for most of the decade before the pandemic, prices undershot the Fed target. So it's not as if the Fed has some fine-tuning ability with regard to the economy and inflation. And the economy was less inflationary before the pandemic than the Fed had wanted. In fact, Fed policy was really geared toward trying to get inflation up, not the other way around.
Yeah,
anyway,
remember? They changed their framework.
Yes. Oh, yes, exactly. And which is why they virtually had guaranteed us that they were going to be late to the party in hiking rates. And the good old Fed, they always keep their word. Now, it seems to me that they've pretty much guaranteed in their approach, which still clings to a Phillips curve kind of conceptualization, that they're going to be late to start. But there's no doubt that their policy today is restrictive. They recognize that. And the question is, in the current environment, how long does that make sense to be maintaining a restrictive monetary policy?
Yeah, and I think the question on jobs and how long the strength can continue, we are seeing sort of layoffs here and there, certainly in the tech sector. I think Salesforce, the latest, it's hundreds, not thousands or anything. And it does feel like it's in a way to pivot around prioritization of AI, unless because of the economy, but belt tightening mode, margin preservation. I mean, these are big themes right now in corporate America. And I wonder, John, how long you expect the labor market to remain so strong?
Oh, I suspect that there is going to be a slowdown in both the corporate investment and corporate hiring in the coming year. It's going to produce a slowdown in job growth, and that's going to make the judgment on the economy a bit trickier. But for sure, or I should say, all signs point to slower growth than in the past year, but it doesn't. There's no clear sign of imbalances that would lead you to expect recession.
Hey, finally, John, on that layoff front, a lot of companies are restructuring workforces using AI productivity as an excuse or a push. On the other hand, a lot of people argue that the early experimentation in AI means you still have to correct the things it gets wrong. I wonder where you are on the notion that it's going to bring us a new wave of long-term productivity.
Hard to know in the short run. It's easy to think that the experts who see big effects from AI in terms of productivity hopefully are correct. Some of those are pessimistic about jobs, but it seems to me that in the long run, the history of a market economy is improving productivity ultimately expands both wages and employment.
John Lipsky, always good to get your thoughts. Thank you for weighing in from the
Thanks.
NBER.
Always happy to be here. Thanks.
Sticking with next week's Fed decision, our next guest does expect 100 basis points of cuts this year, beginning in June, watching for some opportunities emerging in emerging markets, small caps, and the S&P outside of the Mag 7. Joining us here at Post 9 today, Lazard Chief Market Strategist Ron Temple is back. Ron, it's great to have you.
Thanks. Good to be here.
It does sound like you think the Fed is going to tell us we need sustained evidence that this thing is for real.
Right, and I actually lean now more towards a May 1st reduction, and the data today even arguably puts March a little more back in play, but given what John Lipsky was just saying, I do agree. The Fed was late to start fighting inflation. The last thing they want to be is too early in terms of pulling off the brakes, and so I think May is the most likely case. That gives them a couple more indications of inflation, labor market reports, and just the confidence to know that that's the right time to start. But if I look at the PCE deflator this morning, the last 6 months are below 2% on a core basis. So this is what Jay Powell told us to watch, is the 6 months. Look at 3 months, we're at 1.5% core PCE. So the direction looks good.
Yeah, I mean, they're at target if you look at those kind of numbers. I guess the question is, and I brought this up earlier, what the path they're going on looks like. Where are they headed? With an economy that's doing very well in the face of higher interest rates, how much will they have to lower?
Well, I think that's where it gets a little more controversial. I'm thinking 100 basis points this year and maybe 100 basis points next year. But I'm assuming the trough of this easing cycle is maybe around 3%, 3.5%. And I do think the Fed wants to have that dry powder. If you think back a long time ago, pre-GFC, this was the normal level, was kind of bounding between 3 and 6 in different cycles. And I do think, by the way, that inflation will probably be a little bit higher over the next 5 to 10 years, because some of those structural dynamics that held it down before the pandemic are basically going to be shifting more towards the dynamics around the energy transition and the cost of that, and also changes in global supply chains, which will nudge up that inflationary pressure. So I think the Fed's going to be keeping rates a little bit higher than the market might anticipate.
Speaking of that, does any of the Red Sea or the supply chain, does that keep them on guard in other ways that they wouldn't be otherwise?
I think really when you look at the shipping cost, it's such a small part of the cost of goods sold. Just within the core PCE, goods are only 26% of the weight of the index. It's really the service sector they're going to be watching. And core goods prices have been going down consistently. You see it in the CPI, you see it in the PCE. I think we've got another 6 to 12 months of core goods prices going down. So we've actually got deflation there. So I don't think that's going to end up moving the needle very much. And Christine Lagarde said basically the same thing at the ECB meeting this week.
So as far as equities go, you are looking for a broadening. You're not that you're shorting large cap tech, right? How broad can this get? And where would people search for first?
Well, the way I'm thinking about it is we've had a huge run in the Magnificent Seven. And by the way, next week will be really interesting. We got 5 of the 7 reporting earnings. But the only way that momentum can be sustained is if the other companies in the market who are buying the products from these 7 companies find that they increase productivity and increase profitability. And back to your prior line of questioning with John, I do think there's a case to be made that this will be a bumpy road. We have to figure out how to use AI in the workplace. All of the workers, me included, have to figure out how to use it in our day-to-day life and how to make it improve our efficiency. I think that's going to take some time. And so the broadening out, we'll have to wait and see. Do companies get the benefits? And oh, by the way, in the interim, we've got a good economic backdrop. So, the 7 companies in tech are not the only companies that are going to grow earnings this year. And I think that's the bigger story of 2024 is macro being de-emphasized and the micro company-specific increasing in importance.
Although the outlooks from the companies have not been as rosy as you might think, given some of the economic data. Kind of a mixed picture there.
Yeah, and to be fair, I do think growth will be slower in 2024 than it was in 2023, but let's acknowledge 2023 was really good. I mean, I and a lot of people expected that recession risk was high. We were wrong. The economy is in a very good place. We should expect some deceleration.
Finally, the debate we keep having is about sideline cash, right? And how much equities benefit from whatever allocation changes people make to their cash. Do you believe in that?
I do believe that should add a positive leg to the story. Earnings growth should be good. Economic growth is good. Valuations of the broad market, the equal weighted S&P, are below 17 times, so not stretched. And then add on to that well over $6 trillion of cash and money market funds. Is all of that going to go into equities? No. But some of that probably will move back in. And we're having a lot more conversations with people thinking, maybe I need to figure out what to do with that cash because 5% is going to go to 4 and go to 3.
Really quickly, since you're at Lazard, I mean, what are you guys expecting for capital markets activity this year, given the very benign backdrop you just laid out?
I think this is a backdrop that is good for fundraising, whether it be equity capital markets or debt capital markets. Credit spreads are very narrow, so if you need to issue debt, you've got lower rates than we had not too long ago, tight credit spreads. On the equity side, it's a market that's a lot more hospitable to new issues, so I think you're going to see activity there. And if you think about M&A drivers, a lot of this comes down to confidence and visibility. Visibility around the economy, check. Visibility on rates, check largely. It's really just a debate of how quickly and how soon. And then valuations.
And regulation.
Yeah, and I do think, by the way, again, a number of the investment banks have talked publicly about seeing positive alignment of these factors. It looks like an improving environment.
Ron, thanks as always. Good to see you again.
Thank you very much.
Ron Temple.
When we come back, is the EV transition already starting to lose its charge? Tesla's uninspiring results could be a turning point. The economist behind that call joins us on the other side of the break. Stay with us.
Download the app today.
We are watching shares of Snap today. Deutsche Bank upgrading the stock to a buy this morning, nearly doubles its price target from $10 to $19. The firm is bullish on incremental revenue from its Snapchat Plus feature, Snap's partnership with Amazon, and also a rebuilt ad platform that is seeing contributions from China. Snap ended 2023 up 89%. Shares are up today about 1%.
Meantime, the electric vehicle market in the U.S. does seem like it's losing some charge. Redburn Atlantic's EV demand model estimating earlier this week the market will be oversupplied by more than 1 million vehicles through 25, even after manufacturers like GM and Ford announced their slower rollouts. Tesla, of course, did warn during its lackluster earnings report that vehicle volume growth, quote, may be notably lower than last year's rate. And then there's Hertz, announcing earlier this month it's selling about 20,000 EVs as demand has waned. Our next guest is a little more optimistic, noting that hybrid loan originations are up and could help bridge the gap as EV affordability improves. Joining us today, BofA Institute senior economist David Tinsley is with us. David, it's good to have you with us. You know, J.D. Power's out today. They did say the first 3 weeks of the year have started slowly for EV retail share. But talk about what you're seeing in some of these loan originations.
Yeah, it's really interesting. So we use the 69 million Bank of America customers to dive into some of these issues at Bank of America Institute. And when we look at loan originations on autos in particular for new cars, what we've seen is that the electric vehicle share, it rose pretty steadily to about the middle of 2023, and then it started to flatten off. And what's really interesting, I think, is when you look at this by generation, so you look at baby boomers, Gen X, millennials, there's a real difference opening up. So the millennials, the younger gens, that share's continuing to rise and is order of magnitude higher. The older generations, they seem to be developing some hesitancy and the share is easing back.
Do we know why?
Well, there's a couple of reasons, we think, and our autos expert at BofA Global Research, John Murphy, has revised down his forecasts for the overall penetration of EV vehicles out to 2030. I mean, some of these reasons are, you know, they're kind of familiar. Range anxiety, the bad rap that EVs are getting with those pictures of people stranded in the cold. And probably most fundamentally is the choice and the affordability of EVs for the average mass market consumer. So John's team looked at the 62
Intel
EVs
CEO
on
says the
sale in
market
the US
reaction to the
right now,
Q1
62
forecast
models
is
of EVs.
overstated.
Only
Intel
about
ticker
20 or so
INTC.
have a sticker price below 45K. So, you know, for a lot of people, that just puts them out of reach. So the premium end of the market, fine. But really, it's not until 2025 that some of these CapEx investments and model rollouts will start to bring more affordable EVs online, I think.
I have an anecdotal reason why. So we had an EV for several years in New York City and just traded it in recently because we were able to save money, because the only reason we needed to have a garage in New York City was to charge the car. And without that, we can park on the street and save the $700 a month that you have to pay for a New York City garage. That was a huge savings, actually. So the whole infrastructure and convenience thing, I think, factors in.
Yeah, exactly. And when you look at the charging infrastructure across the states, it's still there's a lot of disparities. So California, that's fine. Other states, much less so. So the rollout is clearly weighing on people's minds. And as you say, your ability to charge at home and maybe any costs incurred from doing so are factors in all of this. I mean, I think as you were saying at the start, the good news from this, particularly if you're worried about the emissions, etc., is that we're seeing hybrid originations rising in our data, hybrid loan originations. And your plug-in hybrid has about 30% of carbon dioxide emissions of a regular gasoline car. So, at the end of the day, you can skin this cat to net zero in a number of ways. And as long as there's a mass market adoption of hybrid, that's not so bad in terms of the trajectory.
Have you done much work thinking about how much the United States might one day depend on Chinese imports, or whether that's even politically possible?
Well, that's not a question that we've put in this work. And of course, loan originations only see with the models that are available now. But I think it comes back to affordability ultimately. So everybody, imports and the domestic market, needs to produce these more affordable EVs in order for that penetration rate to continue to rise.
David, pretty fascinating. It's a tough market to read. That adoption curve is really long. We'll do our best with your help. Good to see you. David Tinsley, Bank of America Institute.
Thank you.
Coming up, is the luxury consumer back? Results from the parent company of Christian Dior and Bulgari may provide an answer. Our story abroad and the European close coming up right after a quick break.
According to a Slovak transmission system operator EU Stream, European gas buyers may agree to take over Russian gas at Russia-Ukraine border if Ukraine transit contact with Russia is not renewed. The Intel CEO says the company will be able to tap 100% of the AI market.
Crash courses.
European markets adding to their post-ECB gains, with the stock 600 hitting the highest level since January 2022. The luxury sector also giving the market a jolt here on the back of strong earnings. LVMH rallying as fourth quarter sales beat expectations, also raising its dividend. Going into the report, investors were concerned about sales specifically in the China region, but the company's CFO said they were, quote, not particularly concerned about China. French drinks maker Remy Cointreau also jumping on a smaller than expected drop in sales. The stock's really bouncing back in a big way. And speaking of bouncing back, in China, the central bank unveiling broad plans to guide money into sectors of national importance to boost the economy. Bank of America noting today that Chinese equities saw the largest inflows since July 15th, the second highest ever, of course, coming off the backdrop of a lot of outflows and negativity. Clearly, the Chinese authorities, the government, Beijing, has determined that they want to instill some confidence here into the markets and into the economy.
A lot of pieces this week on the tape about the political vulnerability, even of President Xi, and then the sort of drubbing that these retail investors have taken on these so-called snowball trades, where it's a derivative bet, where you're betting the index will not go up or down that much, and it's hurt them.
Right. I think it shows that if there's a will, there's a way. If they have the resolve, then they have the firepower to help fight it. Although, some of the China bears worry that the problems run pretty deep as far as property concerns and debt problems and geopolitical risks and friendshoring and all of those sort of risks for the Chinese.
And even the Red Sea now. On these reports, they're asking the Iranians to help assist that situation because they rely so much on exports.
Yeah, for sure.
Meanwhile, we're coming just slightly off of those all-time highs, 49.02. Let's get a news update this morning with Courtney Reagan. Hey, Courtney.
Hi there, Carl. U.S. Central Command said the Yemen-based Houthi rebels fired a missile toward naval destroyer USS Carney today. The ship, which was traveling in the Gulf of Aden, shot down the missile, according to CENTCOM. Today's attack comes as the Iran-backed Houthi militants continue to carry out attacks on ships in the region in retaliation for Israel's offensive in Gaza. House Speaker Mike Johnson warned a Senate deal addressing border security and aid to Ukraine is dead on arrival in the House in its current form. A bipartisan group of senators reportedly plan to unveil the deal's text next week, but the Republican-led House has warned it won't approve anything that it doesn't feel goes far enough to address the southern border crisis. And the former Spanish soccer chief lost his appeal to remove a 3-year ban from the soccer governing body FIFA. The decision came out one day after a judge ruled Luis Rubiales would have to stand trial for giving a player on the country's national team an unwanted kiss following Spain's World Cup win. Carl, back over to you.
Court, thank you. KKR-backed healthcare company BrightSpring making its public debut today. Many investors hope it will jumpstart a relatively muted IPO market. Former NASDAQ chief Bob Greifeld will weigh in next with his outlook. Stay with us.
According to IIR, Shell are to shut its 208,000 barrels per day crude unit and its 49,000 barrels per day FCC as part of a planned maintenance in the Pernis oil refinery in late January, again according to IIR.
Athletics.com.
Oppenheimer's pretty bullish on Coinbase today, upgrading the stock to outperform and citing the 30% plus sell-off it's seen in the stock to start the year as an attractive entry point. Oppenheimer also points to the Bitcoin ETF approvals as a positive catalyst for shares. Price target goes to 160, up almost 4% today.
Let's turn now to the state of the IPO market with Birkenstock, Instacart, Kava, some of the high-profile companies that went public last year. So what should we expect in 2024? Today we got BrightSpring, which did price below the range, and next week we'll get Amer Sports. That's the company behind brands like Wilson tennis rackets and Louisville Slugger. Joining us now with his outlook, Bob Greifeld, former NASDAQ CEO and co-founder of Cornerstone Financial Tech Management. Bob, welcome back. Nice to see you.
Good to be back.
So what do we make of this? This was supposed to be a big comeback year. The market's hitting record high after record high. There's excitement about the Fed cutting rates and the economy having a soft landing or not even a landing right now. Why so sluggish on IPOs?
Well, I don't believe we're going to stay that way. And I think NASDAQ has done a great job of coming up with this Pulse Index, which I've had time to study. And to simplify it, if you think about it from a common sense point of view, a factor that matters is the market last year was up dramatically. The second factor is you see interest rates are going to come down this year, which we'll talk about later. And the third factor is investor sentiment, which is actually increasing. So if you take those three factors, that leads to a good score, and it leads to higher IPO activity. And we've seen the highest score since 2021. So I predict a recovering market for IPOs in 2024. And obviously, the stronger the company that leads the IPO, onslaught, the better. And I always think back to how Google single-handedly changed the sentiment of IPOs back in the day.
Well, while the market conditions might be right, Bob, the performance of recent IPOs is not particularly inspiring. With a lot of those that I mentioned, I mean, it's not like they got out of the gate and went up.
Well, Sarah, so I focus a lot on fintech this day, fintech technology companies. What's interesting, and I think it's very important, is all fintech IPOs since 2019, the vast majority are now trading above their IPO price for the very first time. So what you're expressing has been very true in certainly the fintech world, right? You have an IPO, it trades below the IPO price. It certainly will dampen the enthusiasm for subsequent companies to go public. But that's not the case in 24, right? The vast majority of these fintech companies are now above the IPO price, meaning the early stage investors who came in are now in the black, right? They might have underperformed the overall index, but still being in the black is a positive feeling. So I think that's also one of the catalysts you'll see, which will help the IPO market going forward.
Any debate, Bob, about which part of the globe is the most attractive in which to list? Is the U.S. far and ahead number one?
Far and ahead, right? Far and ahead, number one. It is the deepest, most liquid capital market. It's also the market with the most informed investors who really want to understand the investment story. So there's no close second like there was 10 years ago, 15 years ago. It is the U.S. market, and NASDAQ has done a phenomenal job leading that effort.
I do wonder about, the so-called valuation overhang where these private companies got such high private market valuations in 2020, 2021, 2022, that the public market is just not going to give them, and whether that makes companies apprehensive or even hard to afford going public.
Well, I think that's one of the reasons we had the great stall in the market. You really had a Mexican standoff with respect to valuation. But you did see in 23 a number of large private companies do down rounds in valuation, even while they were doing well. So I think we've seen a general, as I watched in 23, we saw a convergence of public versus private markets. You still have some gap, but it's not near the gap that it was, let's call it 18, 24 months ago.
So you're saying kind of taking your medicine before you come to market?
Yeah, that was surprising last year. We saw a number of private companies take medicine in subsequent funding rounds, which we hadn't witnessed in the years before that.
Who do you see as a potential bellwether? I mean, some of the names in the pipeline that we're watching, Shein, Skims, Kim Kardashian line. I mean, There's a lot. Chobani, Panera. Which one are you excited about or most anticipating?
That's a great question. In the world that I focus on, it's interesting. You see Stripe. PitchBook has this great AI tool they pay a lot of attention to that ranks the probability of a company coming public. And it's machine learning AI, and it comes up with a various number of factors. And they have Stripe at a 97% chance of coming public this year. So we look in our world, Stripe is probably at the top of the list. You have Rippling and a number of other companies that are well positioned to come public.
Hey, finally, I wonder if you think, I'm just thinking back to the years where you had names come public, Bob, that literally sucked the oxygen out of the room. There was argument that it was going to hurt the rest of the market. From a marketing standpoint, it was big and splashy. Do you see a return to those days, or is it going to be a more modest coming out party?
Well, I think the answer is somewhere between the two. The larger IPOs tend to suck the oxygen out of the room, but I still think that's good in that it gets more people in the room and it allows the subsequent companies to come into a more hospitable environment. So I think the market needs a hot bellwether name IPO to really ignite it going forward.
Do you have to be profitable to go public right now in this higher
It's
interest rate
helpful,
world?
right?
Yeah.
We're still, that's the last stage when the IPO market gets frothy, where you don't need to see profit. But we're not in that stage right now. So profitability, I would say that's basically table stakes. You need to be there. And certainly, if you have remarkably high growth, you can, talk about less profitability. As a balance, I like to look at the rule of 40 and things like that. But in this environment, profitability is key.
All right, Bob, thank you very much for the insight.
I appreciate the time. Thank you.
Bob Greifeld, looking forward to a robust year on IPOs.
Meanwhile, a 4-year deal for $20 million, what was once a contract reserved for professional athletes, now being commanded by leading AI researchers. Tech Check's going to detail the incredible sums being offered by Altman, Musk, and others in a minute.
NBC.
US crude
A lot of
futures
titans in the
fall by
tech
more
industry
than
making
$1
headlines
per
today
session,
as they
low
look
at
to raise huge sums of
$76.31
capital to
per
build
barrel.
their AI startups. Our Deirdre Bose is watching that today on Tech Check. Hey, Dee.
Hey, good morning, Carl. Let me name just a few of them. Elon Musk, Brett Taylor, Sam Altman. These are already the biggest names in tech, but they're not complacent running some of the biggest existing companies in the world. They want to build the next generation of Gen AI companies, and it certainly helps that they have established, proven track records because building AI companies, that is extremely expensive. The FT reports that Elon Musk is in talks to raise up to $6 billion to finance a challenger to the Microsoft OpenAI juggernaut. Brett Taylor, that's the former Salesforce CEO and OpenAI chairman, he's reportedly close to finalizing an $85 million investment for his startup called Sierra. And then there's Altman, of course. He may be chasing billions of dollars to build AI chips. Now, we've talked about the billions of dollars needed in compute power, and that is for building the actual models. Reporting from The Information says that Anthropic's gross margin was between 50 and 55% in December, and that's actually far lower than the average gross margin for cloud software stocks. Talent is another massive expense. I was at a dinner last night with the CEOs of Databricks, Box, and Salesforce AI. One of them, Ali Ghodsi, he said that the going compensation package for a senior AI researcher is $20 million over 4 years. Hire 5 of them, that's $100 million like that. And then there's making the actual chips, arguably the most ambitious. NVIDIA and TSMC have put in years and tens of billions of dollars into research and development, while the mega caps like Google, Amazon, and others, they're still using NVIDIA GPUs despite their own in-house chip efforts, which are costing huge sums of money as well. But even if you're not building the foundational models or the semis to power them, and you're building AI applications like Brett Taylor is, there's a race to get scale. Clara Sheed, the Salesforce AI CEO, likened last night at dinner, to AI in 1997 during the dot-com boom. She said she sees a lot of similarities over the last year. So that means winners are starting to emerge, even if we don't yet know who's going to be Alta Vista or Google, and Alta Vista or Yahoo, excuse me, and who is going to be Google. But clearly, you want to be in the latter camp, and that's what some of these tech titans are trying to do.
I mean, I want to hear more about your dinner. I'm intrigued because, of course, you're going to AI dinners with top AI executives in San Francisco. So what else did you pick up?
That's what you do here.
Yeah. What else did you pick up about where we're going this year and how fast we're moving?
I mean, it was such a fascinating dinner. I'm still trying to run through all of the information last night, but it was basically, 3 of the top enterprise CEOs talking about what's ahead. And one thing was absolutely unmistakable is that they're moving all forward at as fast as they can. And Clara, who was the CEO of Salesforce AI, she says that they're looking at it in every part of the business. There's the AI division, but they're looking at it in marketing and sales, and they're having hackathons, and they're just trying to figure out how it can improve these different businesses that aren't necessarily AI focused, but can benefit from those efficiencies. And just that price tag for a senior AI researcher, I knew that they were being paid large sums of money, but I did not realize it was that much. And when you think about a Google that has thousands of them, right, on their workforce, that's just hundreds and hundreds of billions of dollars.
On a day where B of A, did you see that chart calling AI a baby bubble, along with Bitcoin and SPACs and memes?
I mean, that was also part of the discussion. And Ali Ghodsi, every time I talk to him, he says that, yes, we are in a bubble, and there's so many of these foundational models. The price is going to go down, and some are going to be weeded out, right? So that's also part of the conversation. Everyone's trying to get there and figure out how they can use AI to improve their businesses. But there is also this idea of, like, who's going to be left behind? Who's going to be the Alta Vistas? Who's going to be the Google? And it's not clear that the incumbents, that it's actually going to be Google or Microsoft. There's going to be some new players, too. I think that was also one of the takeaways.
All right, Deirdre, thank you. It's really good color. Appreciate it. Deirdre Bosa. It's been an ugly quarter for regional bank earnings so far as higher rates take a toll on profits. Did East West Bank buck the trend? CFO is going to join us on the results next.
Taking a look at some names hitting all-time highs today. Meta, Ross Stores, Merck, Berkshire again, and TJX. We're back in 2.
a trial.
Let's close out the hour with a look at East West Bank. Shares moving a little bit lower here after the company reported Q4 earnings, delivering a beat on net interest income, raising the dividend 15%. Yet another regional bank marking a pretty strong close to 24 following the turbulence that hit the sector last spring. Joining us today, East West Bank CFO Chris Niles is with us. Chris, you guys have a really interesting lens given your exposure to both the U.S. and the China markets. And I guess the obvious question is whether China uncertainty is impacting things like loan growth.
Carl, thank you, and good morning. As you know, we are an American bank, and so the reality is 96% of our business is driven by the American market. And so we've been very pleased to see the reception of up over 5% this week of our earnings week to our results, and are very focused on continuing to drive that cross-border activity that makes us a unique player in the market.
So that's not made its way into, say, the Chinese-American community here?
No, our Chinese American community here has proven remarkably resilient, remarkably loyal, and is supporting the growth and activity that happens cross-border between the two countries, and we play a unique role in that. But the reality is the strength of that community here domestically, and despite the challenges perhaps abroad, the growth trends are still positive in both and continue to drive our business forward.
But a lot of the analysts did note the softer loan growth guidance and wondering what that's about and whether you're seeing credit concerns.
Now, the softer loan growth guidance really is about the outlook here in the United States. And so our loan book is 96% in the United States, and a portion of our loans is here in U.S. commercial real estate. And as we look at the current environment, we're not seeing the level of transactions happening that would support strong growth in commercial real estate over the next couple of quarters. In fact, we think that business will slow further. And since that's historically been part of our growth, when you slow that down, our growth will naturally slow. We're going to keep pace with the economy on commercial and industrial lending, and we're going to continue to outpace on residential lending. And we've grown that book very nicely here over the last several quarters, and we'll be a growth bank. We just won't be growing commercial real estate the way we have in the past in this environment.
How long do you think it's going to take for that to inflect back higher? Is it going to be about time, or the absolute level of rates, or transaction volume, or something else?
It's a meeting of expectations on the part of sellers and their cap rates and the financing levels where new deals can be put on. So that probably has to be when the Fed works its way down a few, maybe 100, 150 basis points until we get to a better place where transactions can happen again, where people aren't underwater and they're comfortable moving property again.
Chris, you have a heavy exposure in California, and I'm curious what you're seeing in that economy, and also if there's any fallout still from the Silicon Valley Bank collapse, whether it led to anything different for you in terms of market share or different expectations among depositors.
Yeah, it led to a number of things. East West emerged from this stronger than ever. We're the largest state chartered bank in California. We have seen a number of our competitors disappear, literally, and we've seen a number of them be acquired. And so the reality is the market share landscape has shifted to our favor over this past year, which is part of the reason why we added net new customer accounts and we grew to record levels of deposits and loans, driving record revenues, record net income, and allowing us to increase the dividend by 15%.
Finally, Sarah mentioned we're going to be lapping the anniversary of the regional bank crisis in a few months. Are you at this point sort of satisfied with the level of regulation, supervision, those looking over your shoulder in the business?
Yeah, I think we have grown our bank, and as we have grown in complexity, we've had an increasingly strong dialogue with our primary regulators. We have a great relationship with them. The reality is the regulatory environment changes for all banks relatively at the same time. We have kept pace with those changes. We have a good capital base as one of the strongest capitalized banks in the industry to work with our regulators on whatever changes come. And our ultimate goal is to deliver strong returns to our shareholders in any environment, including any regulatory environment. And if you start from a position of strength, which we are, and with a strong capital base, you're prepared to take on any challenges as they come.
Chris, really appreciate it. Such an important element of the economy and the markets for sure. Chris Niles over at East West Bank. Thank you very much.
Thanks, Chris. We are getting ready for a big week ahead. We've got the Fed, a jobs report at the end of the week. Of course, big earnings from Apple, Microsoft, Alphabet, Qualcomm, and the oil giants. We get the JOLTS report as well, job openings.
Some productivity in
I always
there,
like.
yes.
And we're going into it with this idea that the Fed is really getting the soft landing. What will they say about it? Will they declare victory? What will they say about cuts and how soon they may come, given these benign inflation reports that we've been getting?
Next week's going to be fascinating. Everybody have a good weekend. Let's get to the Post 9 and the Judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Walker, front and center this hour. Goodbye, Mag 7. Hello, AI 5. We'll trade and debate the new most important names in the market, at least according to one well-known tech investor. Joining me for the hour today, Josh Brown, Bryn Talkington, Jenny Harrington, Jim Lebenthal. Let's check the markets. We are green across the board today. We have the S&P sitting above 4,900. Dow's above 38,000. We had a good PCE. The 10 years at 414 or so. And Josh Brown, we get ready for a big week. Mega cap earnings, the Fed meeting. There's your 10-year note there. So how should we be thinking about the week that was and the one that will be?
I think probably the big tailwind that sends us into next week. And, of course, those earnings will be pivotal just mathematically. Those stocks are really big. They really move the market when they go up and down. The commentary that you'll hear out of those management teams will absolutely impact the way people are feeling about the outlook for other stocks that they own. But we don't know what's coming out yet, so let's put that aside. I think the thing that's really going to send us into those reports with a decent tailwind is this core PCE number. Remember that the Fed focuses more on this than they do on CPI. And now you've got basically a 6-month and a 3-month annualized sub 2% inflation regime. And that's like, at this point, I think that could clinch the rate cut cycle beginning. So right now, the street is only assigning a 53% probability to the first cut happening in March. That's down from a month ago, but up from a week ago, I guess is the best way to put it. I spoke with Neil Dutta from RenMac. He's the only Wall Street economist who told you a year ago no recession in 2023. We had this huge debate all year, hard landing or soft landing. He said, how about no landing? Neil thinks they go in March, and this print that we see today gives them cover to do that. Even better, though, I want to point out the 10-year, 2-year spread. This is about to uninvert. It's been trending in that direction for a while. Right now, it's at negative 0.14. Outside of the negative 0.13 that it hit in October, this is the closest we've been to an uninversion. We've had an inverted yield curve for what seems like years now. To me, that becomes really important also, especially when you think about all of the negative sentiment around whether or not, okay, we didn't have the 23 recession, maybe it's a 24 recession. I think that uninversion happens probably coinciding with this rate cut cycle getting underway, and I think we should be keeping our eye on it.
So, Jimmy, we're going to get to mega caps and the earnings and all that, but I love what Leisman posted today by way of Capital Economics. Quote, immaculate disinflation nearly complete. It's time for the Fed officials to take the win and start dialing back the level of policy restrictiveness soon. Now, I know the market has sort of further backed away from the idea of March. It's, as Josh said, a touch less than 50%. But I wonder what kind of clues we might get from the Fed chair this week or next week, excuse me, and how that's going to impact the trade in the days and weeks ahead.
So great macro analysis from Josh just now, and I like Steve's comments as well. I can't overstate the importance of the two handle on the PCE, both on the headline and the core level. But here's why it matters to me as a stock investor. It's not actually the macro environment, because I think most of us have been for quite some time on the soft, or if you want to call it a no landing scenario, that's fine. Here's why it matters to me, though. I'm going to be honest with you. I'm not very happy with the earnings season so far.
It's not been good. Let's just not
kid ourselves,
right?
It's out there, right? We're talking
talking about it now. We can be honest.
Which sets the stage for next week even more so.
It does, but let me also just say this. Just said it, right? The earnings season so far is not good. But if you have further indications, as Josh and Steve were just talking about, that the Fed really should be taking the wind and taking its foot off the brake pedal, then that means that the stock market can give a little more time, like another quarter or so, for earnings to start to increase. They haven't. I'm looking right now at calendar year 24 estimates from the macro analyst community. They're at the lowest they've been, around 242, actually just under 242. We need those revisions to start peaking up, not down, which is what they've done for a year. And I think if the Fed can take its foot off the brake, you'll start to get those revisions going up. That's why today's news matters to me. Profit growth.
Yeah, Bryn, the market is a bit looking through some of these disappointing earnings reports, too. We said the S&P is at 4,900, above that now. And Dow is, nicely above 38,000, 38,174 with today's gain. It does set the stage, though, for a pivotal week, whether Powell moves the market or these mega cap earnings do.
Right. I mean, I think ultimately the PCE today is the information that we needed, that, yes, inflation is slowing, that the Fed can start. I don't think the Fed's going to go in March. That's my guess. I think they wait another meeting just to make sure, because once again, I know that Jay Powell definitely has the memory of Arthur Burns and doesn't want to repeat the proverbial 1970s. I don't think we will. So I think they wait a little bit longer. But listen, really, I mean, technology is such a big part of the S&P. It's such a big part of earnings. When the mega caps really start coming out with earnings, I think they're going to be good, and I think they're going to be ebullient in their conversation around AI. And I think that's really when things are going to start fleshing out. I do think the biggest date will be February 21st, though, when NVIDIA comes out. To me, that's going to be the pivotal moment if we can continue to go higher in tech, or we're going to start to take a breather.
Jenny, I almost feel like we need to get away from this idea. I think the market is telling you this in some respects, that a strong economy means that the Fed's worried that inflation's going to come back. Like Bryn makes the Arthur Burns reference from the 70s, et cetera, when the evidence would almost suggest otherwise, because the economy is strong, the data continues to be good, and inflation continues to go down, okay? The PCE is the latest evidence. It's the Fed's favorite read, and that suggests that, which is why the Fed decided and made it clear in the past that they're not so worried about choking off the economy anymore at all. They're more worried about getting inflation down, and it is in their favor. They are winning.
So what I think we're losing sight of when we're talking about the Fed starting to cut and when they cut, what does that really mean? And I think we've become so accustomed to thinking of Fed cuts as stimulating, right? And all they'd really be doing.
They will be.
Okay, but they shouldn't be.
They will be.
You know what they should be? What they really are? They're normalizing. So if we get three,
which
right.
is when you're normalizing from the degree at which they hiked. Yes, that's stimulative.
But it really shouldn't be, right? It's not them rejuicing the economy. It's not them bringing rates back down to zero and saying like, hey, you get to borrow for nothing forever and just go crazy and unbalance the risk reward scenario.
No, but 2% is better than 5%.
It is better, but it's not what we were at. It's not. I really think that people out there, when they ran the market up in December and people were talking about and the market was kind of pricing in like 6 rate cuts, that was pricing in active, intense stimulation ahead. And that's not what really we should be looking at. We should be looking at normalization, which then says to you, what's the right market multiple? And I would argue it's not what it was in a highly stimulative environment that we were in. It's not 21 times. It's not 20 times. You know what? It's probably somewhere between 17 and 19 times, which is above the 16 times that it was. So I'm really cautious going into next week. And in our equity income strategy and the dividend portfolio, right, that we've got about 10% cash. In our growth strategy, we've got about 7% cash.
Why are you so cautious going into next week?
Because I think I know we'll get into Intel later, but I think there's a lot of hope and expectation in shares. And so when we say it's not been a great earnings season, actually the numbers are coming in okay. But there was so much.
Depends what stocks you're in. That's the problem.
Absolutely, but there was so much anticipation in so many stocks that I don't think whatever's said next week, it's hard to imagine it can keep up. I mean, we're talking about the AI 5. That sounds super cool, right? It sounds like MI5. It sounds really, really, I don't know. I don't want to say bad words on TV. It just sounds really cool. So, but there's an excitement, there's a euphoria, there's an irrationality for what those valuations should be. And when we get later in the show, too, I'll tell you something we sold. It's a great company. But the problem is that when something trades at 57 times earnings, no matter how great it is, the story and the valuation no longer work. And I think that that's what we might get into next week, which is seeing like great story. But you know what?
But see, that's the argument. I don't know, Bryn. That's the argument that people who haven't been in the right stocks continue to make. They justify it by the valuations are too rich. Whereas the valuations have been justified in many respects by the guidance and the promise, and in even a greater degree, the monetization that's already being realized. If you look at an NVIDIA and a Microsoft, for example.
Right. I mean, so like NVIDIA, in terms of one would never have bought NVIDIA if they focused on the valuations, because it would have just been too expensive. I mean, Jenny obviously runs an equity income, so that aside. But I think it's important. Valuations and multiples are really a terrible timing mechanism. I think fundamentally, if you're like, well, this is just too rich for me, I get it. But I think that what you're going to see, especially in certain companies, and we'll get to Intel, but I mean, you could drive a bus through the difference between an Intel and an AMD and an NVIDIA. And so I think you're going to continue to see a dispersion within these companies. And if you don't deliver, whether it was Tesla 2 days ago or it was Intel today, the street's going to cut your legs out underneath you and will have no mercy.
Well,
I think we're going to continue to see the Netflix, the winners get bigger, and the losers, the market will not suffer fools.
That's why, Josh, you have people like Glenn Kacher of Light Street, who yesterday on Closing Bell coined that AI5 and said, you know what, get Tesla out of here in terms of the Mag 7. He owned it. He doesn't own it anymore. Sold it at the end of last year. Obviously been a dumpster fire this year in terms of the stock, and then this week it's been horrible, down 12 to 13%. Go with the AI5 from here forward, he says. Microsoft, NVIDIA, AMD, Taiwan Semi, and Broadcom. Those are the ones you should be focused on. Now, I'll also say he likes Meta a lot still, and he's in it. Obviously, conspicuously absent is Alphabet, which we can debate too. But what about this so-called AI5? Focus on those stocks over what was the Mag 7.
Listen, that dude is really smart. I'm not gonna out technology Glenn. I would just point out we could have made that same list in 1998, and none of those companies still exist in their form from back then. Some of them do, but many of them spent decades as a shadow of their former selves. I'm looking at you, Intel and Cisco. So that's really, really tough to do that kind of thing. It's easy to say, here are the companies that right now have the most sales growth directly as a result of the AI revolution.
That's what he's saying.
All right,
let's
fine,
take it for face value at that.
Yeah, but everyone knows that.
Whatever. Well, I don't know. I don't think a lot of people were focusing on Taiwan Semi, for example.
They weren't.
Some were, but the stock's up 13.5%. Year to date. Were enough people focused on Broadcom, for example?
Judge, maybe not, but you're talking about some of the biggest market caps in the world. They're not $4 trillion, but they're not 20 billion. They're not like undiscovered gems. This is what I would tell you. The most likely outcome of all of this AI spending is, number one, a lot of startups are going to come along. Some of them will become really important, but a lot of money, a lot of them will go to zero. That's perfectly natural and normal. That's how that end of the spectrum works. At the other end of the spectrum, you have $4 trillion companies. Maybe some of them should be $5 trillion. We'll find that out. But where the real money is going to be made is in the middle, by the types of companies that Jenny owns, the types of companies that Jim owns. If you have companies that are normally spending X dollars on labor and related overhead that can cut those numbers over the next 10 years, that money will drop directly to the bottom line, even if you assume a higher CapEx or tech spend in order to get there. The true promise of AI may not necessarily reward the shareholders in the most AI relevant companies. The true promise is probably going to be a profit margin story for all of the other companies that have nothing to do with AI. And that, for me, is a reason to be bullish, but not be focused on just 5 stocks.
Well, I just think it's so cool that we're finally changing the conversation from Mag 7 to AI5, because you know what that is? That's leadership rotation. And so when Josh says you could look back to 1998, I think Microsoft was actually one of them in 1998. But we need to be really aware that the leadership rotates. And so when Bryn, I think you were a little callous in saying valuation's a trap, but actually it's not. Because for the last 3 years, I've been saying Tesla should be priced more like a car company. And there are all these arguments. No, it's a technology company. No, it's a battery company. You know what? It's behaving like a car company and it's being priced like a car company.
I think Bryn, to be fair, I think her greater point is don't buy or sell or trade stocks around just because of valuation.
You have to have it both working. Yep. You could make the argument for valuation on Microsoft and the story. You could make the argument for valuation on NVIDIA and the story.
No, but if these things are different. If NVIDIA's valuation is lower now than it was 6 months ago.
Right, so you just
the stock price is higher today than it was 6 months ago. If you would have sold it 6 months ago,
the expectations are higher.
Right, but of course, but that's what my point is. If you would have sold it 6 months ago based on a valuation you thought was elevated,
this is my point.
This is the exact reason why you don't.
Okay, but you had to, even 6 months ago, say, is the story working and is the valuation working? And for the last 3 years, I've been saying on Tesla, the valuation's working. Sorry, the story works, the valuation doesn't.
Yeah, but you telling me that Microsoft's story isn't working because the valuation's at 35?
It is. That's why it gets to stay in the AI 5. That's why it gets to stay in that group, right? So who's been kicked out? Meta's been kicked out. Tesla's been kicked out.
Meta is working. It's not really kicked out.
It's working, but it's not going to be the leadership. I mean, at least according to the AI 5.
Well, I don't know. Meta just had its best year ever.
For sure.
Now coming off its worst,
but
still.
It's not going to have that kind of year again in the future. And so what are we talking about now? We're talking about AMD and TSMC in ways that we haven't before. Leadership is rotating, and that's how it should be. But you don't sell something just because of the valuation. You don't sell something just because of the story. You don't buy it just because of both either. But you have to look at the valuation. Otherwise, you're going to sit in a Tesla, ride it down 50%, and be like, well, it's a cool story. People like buying it still.
Bryn?
I think you have to look at both all the time.
Yeah. Well, so first of all, on Tesla, I mean, Tesla's one of the best performing stocks of all time. In the last 5 years, it's up over 800%. So let's just not pile on Tesla because the past 2 quarters, they're in a transition. They didn't have a great call the last 2 quarters, but come on, this is one of the most innovative, not only automobile company, manufacturing company, technology company, et cetera, of our time. So if you don't want to buy Tesla, that's fine. But to say it's a dumpster fire not done well, that's just not accurate, by the way. It's been an amazing performer, okay? And I think that when it comes to valuations,
well, it's a dumpster
you can't
fire
actually
recently,
look at Microsoft.
so I'm not talking about a 5-year, 20-year chart.
Yeah.
You know what I mean?
Yeah. But I think when it comes to valuations, really where I stand is that really it's not, do I think the valuation is too cheap or too expensive? It's what multiple is the market willing to pay for stock X? And that's really where the hard work comes in to say, I think the market's mispricing it or overpricing it. It's there's no reason Microsoft should trade at a 35 or whatever it is. It's just that the market thinks that's the multiple it should be. A year from now, it could say it should be at 20. And so that's where I think that valuations can be a trap because you just don't know the whims and the sentiment of the market and the multiple the market wants to price on an individual name.
Well, I mean, the market was obviously mispricing Intel because the stock had a 30-some-odd% run-up into the print, and today it is getting crushed on the outlook. Christina Partsenevelos is sitting at the desk with us today to sort of give us a sweep of that. You know, expectations, I guess, were up going in because of the stock appreciation.
You guess. Going from $32 early September to $50 in December, the expectations were definitely there, and I think it was reset after this earnings report. And much of it had to do with the Q1 guidance and not Q4 performance, because it wasn't that bad Q4. They actually did pretty well, but it's the guidance that was 18% a lower quarter-over-quarter, lower than every single analyst estimate out there. The company, so I caught up with some management on a call before their earnings call, and they listed 3 things they reiterated on the call. They blamed Mobileye because they are the majority shareholder. Mobileye does autonomous driving technology. They blamed their programmable chips department, which is a little bit weaker as more people shift their money towards AI-related chips and maybe away from other specific ones. And then lastly, the foundry business. So that's actually an argument for the bears. Hey, those 3 items that they listed are not part of their, let's say, core business. So it's an opportunity for Intel to turn themselves around. But then you have the bears out there that's saying, how long do we have to wait for this transition period?
Well, Stacey Rascon of Bernstein says, quote, how many times can Intel push the reset
Exactly.
button, right?
So now I think Stacey's pushing it to 2026, I think, in his note. But a lot of people are just staying on the sidelines, hoping for this change. And there's still some, like, hope. That's the key part with Intel. They're still on their roadmap for their product launches. They signed a new foundry customer. But how long do you have to wait? And so to your point, starting this conversation, people got into the stock maybe not realizing the timing of this turnaround and the timing of things to progress, even though Intel promises that every quarter after Q1 will increase incrementally, sequentially, as well as year over year in 2024.
Hope is a dangerous thing.
Well,
said
it's better
Red,
than
said Red in Shawshank.
Yeah, but it depends on the timing of entry.
You still have
From
hope?
this point, I do. I don't think we're going to have
Why?
a year like we did. Okay, so first of all,
Why?
you're totally right that expectations were too high, and that's why I'm nervous about next week. So why do I have hope?
Yeah.
Because we need to remember that what Pat Gelsinger is doing is taking a strong page from Jamie Dimon, which is under promise, over deliver. Right? So when he resets these, we need to remember they actually just beat Q4 earnings by 23%. And so I don't really, and I was actually surprised by the magnitude of decline today. Just in that, I thought like data center had already been accounted for. Yes, I knew there was a lot of hope in the stock. The thing's up 100% since February last year. It was down at 23. It's at, well, it was at 47, last night. It's up about 100% in the last year. That says there's a lot of emotion, a lot of stock in there. But why did I stick with it last year? Because we thought they can return to $2 of earnings. This gets back to the hope. They can return to $2 of earnings. They're on track to do that. Last year it was trading at 12 times when it was at $23. Now it's trading at 25 times.
Yeah, I figure you take the gift of the stock appreciation and say, God, I was waiting for this and
we
bounce.
might get there, but I'm not selling it down 10% today because I think that this is a little bit overdone. I think it was actually kind of a fine quarter. I think they're doing, at this point, more than I expected they would be doing last year. Things are getting better, faster, but it can't be a straight line, right? Not everything's seamless. But I really do think if we look back since Pat Gelsinger's been there, he has under-promised and over-delivered almost every single quarter. There might have been one where it wasn't quite perfect.
I don't have in front of me what the performance of the stock is since Mr. Gelsinger came back, but maybe we can.
It's not good.
I know it's not, but
Josh, it's like flat.
We can work it up in the control room, perhaps,
Yeah.
if we have time, guys. If you can do it, great. If not, totally get it. What do you want to say?
Let's compare it to the sector.
Okay, but
hang on, we can do both. But Christina,
Wait, compare Intel to the sector. But just to your point, February 21st, the Foundry Day might actually be an opportunity to get out if you would, because they may announce a new customer. I don't know this, but there's an opportunity to see the stock regain a little bit. Comparing it to the sector, Intel actually outperformed at the SMH and the stocks over the last 3 months leading into this earnings report. SMH is a whole other story that it may be in overbought territory, but. It's part of that category when you divide the compute versus non-compute, and Intel was sort of in between both, and now we're seeing that negative reaction to this weakness in data center revenue, loss of market share to AMD too.
Christina, you know my thesis, which is that the overall semiconductor industry has bottomed, okay, and that we're seeing growth in end market demand, whether it's laptops, whether it's smartphones. Now, there's a thin line between hope and expectations, all right? My expectations are that it has bottomed, and it will eventually support Intel and Qualcomm and NXP. But here's the thing. When a market or an industry bottoms, not everybody comes out at the same time. It just, there's only so many incremental orders. The first incremental orders have gone to Taiwan Semi, right? They're the biggest foundry. The incremental orders are not going to go, I'm sorry, Jenny, to Intel, which is just getting started in foundries. But if the expectation is correct that those end markets have bottomed, and I really think based on economic strength they have, then it's just a matter of time before the positive news that you saw at Taiwan Semi come through to Intel, come through to Qualcomm, come through to NXPI, taking nothing away from AMD or Broadcom or NVIDIA. How do you feel about what I just said?
I agree, but then you are taking that thesis that this is longer than anticipated, that you have to stay on the sidelines for a little bit longer. And then even for AMD, AMD is on Tuesday, right? You're seeing the stock down ever so slightly, down less than 1% today. Why is that? Because AMD has a grand exposure to PCs. You saw weakness in servers for Intel. So this bottoming is happened here, Q1, whatever you want to call it. I agree with you on that. I just wonder, how long do you have to wait for that? That seems to be the question that from investors' point.
Okay. I'll go back to the Shawshank thing. Only because I think it fits, is that, Jimmy says, why bother having to tunnel through the wall to, crawl through 5 football fields of foulness to get to the other side when it's uncertain what's going to happen there, where AMD, Broadcom, NVIDIA, those are proving to be, Taiwan Semi, others are proving to be the places to be. By the way, to answer the question, thank you, Control Room. We have it down 29% Intel since February 15th of 2021.
When he took over. Okay, interesting.
That's great.
It's not great, it's sad.
Right? You're willing to tunnel through the wall, to climb through all this garbage, and
it was cheap the whole time.
And hope that the other side's going to be better.
Yeah, and Josh, if I'd sold when you and I were having an argument about it last year and you were telling me it was irrelevant and nobody cared about Intel anymore, and I said to you, yeah, but they're still doing $60 billion in revenues, if I'd sold, I would have let 100% return on the table, which is why you start every day. Don't even, we'll catch up on that later. It's going to turn into a bickering match.
Josh, go ahead.
Jenny, no, it's not. No, it's not.
Go ahead, Josh.
No, it's not. Listen, 3 years ago, we were having debates, and just generally, Intel was always a value stock, always cheap. Here's the problem. 3 years ago, NVIDIA's expensive, Intel's cheap, therefore, blah, 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 cash flow, et cetera, buy Intel. Intel is down 3% over the last 3 years, ending yesterday. NVIDIA is up 350%, but the semiconductor sector is up 62%. You literally could have thrown darts, and there is not one other large cap semi company that would have been worse.
But here's the answer to Scott's question. Like, do you really want to slog through it? The reason I slog through it is because this is in our disciplined growth strategy, where there is a very, very disciplined process, which is look for companies with a 5% or better free cash flow yield where there's earnings growth on top of it. So I'm going to have a whiff on an Intel, but I'm going to have total home runs on things like Palo Alto and United Rentals also. And by maintaining that process, you miss some, but you also hit some huge home runs. And so you adjust the positions in the portfolio, you get a black eye here or there, but you also reassess, why do I own this every time? So last year at this time, we thought it had a lot of upside, and it did.
Okay. We'll make that the last word of that segment. Thank you, Jenny. Christina, thank you as well. When we come back, we do have more committee moves to discuss. We have trades on Visa, American Express, Snap, and more. Jenny is out of a big winner. We're going to tell you about that, too, when we come back.
humanly possible.
All right, let's hit this move that I referenced in the tease going to break. You sold Palo Alto.
Right.
Massive
White House
winner.
economic advisor
Why sell it now?
Boucher says
So we bought
will
this in
drive
2016 for
productivity and
$43
jobs
a
for
share.
years.
It's trading at 340-ish now. We looked at it on multiple different valuation bases. 57 times earnings, 2.9% free cash flow yield, 12 times revenue. However you look at those, it's expensive. And you look at Palo Alto, right, the story part of it. The story is fantastic. We think they'll still have 18% earnings growth ahead. But it's a really different company than we originally bought. When we bought it, it was $12 billion market cap. Now it's 100. They had 1,800 employees. Now they have 3,800 employees. They have 14,000. The needle is going to be much harder to move. So I don't really want to own a company in our disciplined growth strategy that maybe is going to squeak out 10% market-like earnings, market-like returns ahead. I think we can do better. So we took the position off the table. It was hard to do, but it was the right thing. We're going to sit on cash. Some cash still. We reinvested some into existing positions. We're going to sit on some cash and look for something that we think has better upside.
Okay,
from
so
here.
This was a topic as well yesterday with Glenn Kacher, as I mentioned, of Light Street, was on Closing Bell with me, who did the same. He sold it at the end of last year. Listen why.
I don't own Palo Alto anymore. I think that sector had a tremendous run last year. CrowdStrike was up almost 200%, and the whole sector was up 80 to 100%. So that's a sector we have pulled back from, even though those companies, the leaders, are likely to be able to adopt AI and utilize that in their business.
Okay, Josh, I'd love your opinion too, because he references CrowdStrike. You have that. I know you like it. These stocks have a lot of love. They also have a lot of gains, and the valuations have expanded. So what do we do?
It's difficult. So I'm definitely not adding to CrowdStrike here. And if I had no position, I'm not sure that I'd be racing to buy it at 300. But I also think you can look at this and say, this is a decade-long opportunity. It's possible you buy it here, it declines by 20%, but it's not the end of the world because the holding period is not 90 days. So if you miss these companies, today is probably not the best possible time to buy them. Expectations have gone much higher, and so have valuations. So when Jenny says she's exiting it, she's being responsible. It's not the same opportunity as it was when she first bought it. So I'm sympathetic to the idea that if you've got huge gains in these stocks, it's not the worst time to take some off the table. In terms of the future opportunity, though, I think this is one example where elevated valuations are justified because of how much these companies still have left to do as this world just completely becomes digital, AI forward. Like the opportunities just seem boundless. Not every one of these companies will win. I think Palo Alto and CrowdStrike are the number 1 and 2 market caps, and I think that's for a reason. So I like those two names. I don't think that I would race out to buy them here.
All right. You want the last word here?
No.
Real quick? You good?
No, thank you, Josh.
See? We take, we give. All right, let's get the headlines now with Courtney Reagan. Hey, Court.
Hi, Scott. Former President Trump returned to the courtroom for his lawyers' closing arguments in the E. Jean Carroll defamation trial. It was shortly after he stormed out of the court earlier this morning as the attorney for E. Jean Carroll was telling jurors Trump was a liar who thinks the rules didn't apply to him. U.S. and Chinese officials will meet next week in Beijing for high-level talks to curb the flow of fentanyl into the U.S. This comes after a November meeting between President Biden and Chinese President Xi Jinping, where they agreed to work together on the issues. And a man accused of stalking Taylor Swift was ordered held without bail after being arrested 3 times in recent days in front of her home in Manhattan. He was arraigned on charges of criminal contempt and was also ordered to take a psychiatric exam. Prosecutors say he violated a restraining order to stay away from Swift and her home when he was found near her Tribeca townhouse hours after it was issued on Wednesday. Scott, this is not the first stalker that she has had and had to deal with and get law enforcement involved. Back over to you.
All right, Court, thanks. Courtney Reagan. Coming up, AI and your money. Josh gives you his top takeaways from the Wealth Tech Conference in Las Vegas. You want to hear that. And later, we're singling out more key earnings next week beyond tech. Stay with us.
BC.
All right, we are back. One of the key questions about the emergence of generative AI is what impact it might have on the wealth management industry. Josh, you're just back from T3 in Vegas, and you wrote your newsletter about this. So clearly it had you thinking, and it's going to have us talking.
Oh, for sure. I think generative AI is coming to brokerage, wealth management, asset management in a very big way. And not just people talking about ideas, but actual products are starting to find their way into people's practices. I think the main takeaway that I had was that there's two ways this could go. People from the technology realm have this belief system where all of a sudden AI is going to replace human fill in the blank. Accountants, lawyers, doctors, financial advisors. Obviously, it never works out that way. That instinct is always wrong. What I think you're going to see in reality is AI tools being purpose-built to help advisors scale up, serve more clients, and do a much better job for their existing clients. That's where the trend seems to be headed, and that's what I wrote about at downtownjoshbrown.com. And I think we're just at the very, very early innings of a huge revolution coming to Wall Street. And I'm sure Scott will talk about that throughout the course of this year.
Well, I mean, it all depends on what sort of services I suppose you're looking for, and also the degree to which, you know, the type of assets that you have and the level of them for certain. For example,
yes,
Goldman Sachs, for example, I think the average person there has, you know, $40 million of investable assets, okay? Uber wealthy people who
probably
are
not
never
the
going to
average,
let,
but
who
yes.
are never going to let, I think that's the average, who are never going to let robots make decisions for them because their wealth planning and wealth management involves so many other things beyond just picking stocks and sectors and this, that, and the other thing. It's taxes, it's estate planning. It's a whole thing. But I mean, I could conceivably think that at the lower level of the investment scale, it may have a more dramatic impact.
I think that's exactly right, Scott. And I would take it a step further. When we were talking about the robo-revolution 12 years ago, in 2012, Betterment and Wealthfront hit the scene, and then Vanguard and Schwab said they were going to build a robo product. We were talking about that in terms of it's an industry takeover. That's not actually what happened. What happened was the robo-revolution enabled people who didn't have access to quality financial advice to finally have a platform that would be better than the industry standard. The industry standard financial advisor for somebody with 50 grand 12 years ago was an insurance guy selling them an annuity. So the robo-revolution worked. It didn't take any money from the high end. And honestly, at this point, I think we all know it's never going to. It's already been too long for that to ever happen. This will play out the same way. There will be some B2C AI tools that get embedded at places like Fidelity Schwab. Nobody with a straight face thinks that a rich person wants to talk to a robot about his problems. It doesn't happen in the legal realm, doesn't happen in medicine, certainly not going to happen here. So AI will be transformative, but only for firms that are willing to pair AI with experience and wisdom and personality and the types of people who thrive in wealth management already. I would look at it as augmenting what financial planners do, not replacing.
Okay. We're going to take a quick break. When we come back, I'm just learning of a new move as well from Josh on a stock he's talked about a bunch lately. We'll do it next. right, welcome back. So I teased going to break that I just saw that Josh had made a new move. You bought more Snap, which got upgraded today, by the way, to buy from hold, which is an interesting call. I think it was at Deutsche. Yeah, Deutsche Bank. They raised the price target to 19 from 10. Talk about a stock that's just ripped lately. I mean, you upgraded it yourself on this program many weeks ago.
I've never liked it since it came public up until a couple of weeks ago. I've been gradually adding to it. They have a quarterly report coming up. I think it's the 6th or the 7th. I should probably have my head examined for adding to it before the quarter. But here's what Deutsche Bank had to say. They're talking about this ad platform rebuild. If you recall, Snap is as bad or worse than Twitter at the advertising business, which is their main business, so that's funny. But they just have never gotten that right. However, they've been making some really key hires from places like Alphabet in recent history. And Deutsche is looking at recent ad checks that they think tell them there's momentum from Q3 into Q4 and possibly a reacceleration into Q1 on the back of that. When is the last time you've heard of anything like that? In addition, the Snap Plus product, I think, is the key to the whole story. They now have 7 million people paying $3.99 a month to get friendship superpowers. And we're talking about kids, but Snap owns that market. If they're talking about 14 million by the end of this year, if they can confirm that they're still on track to have 14 million paid subs and the ad platform story remains intact, that revamp, I think the stock's okay. So I'm in it. I don't trust them at all. I would probably add to it if they have a good report. I would rather pay up. I'd rather pay up with some confirmation.
I don't trust them at all.
I really don't.
We should frame
I'm being honest. I'm being very honest.
I know you are. That's the beauty of it, is that you're being that
always
honest. Yes, you are.
To a fault.
Let me highlight, or not. Let me highlight another move. You trimmed United Rentals.
Right.
Tell us about that.
Do you remember we did this 3 weeks ago, too? So we bought this in 2015 at $77 a share. 3 weeks ago, we trimmed it when the stock was at $5.53. We trimmed it again yesterday after they announced earnings at $6.53. And it was wild because when we trimmed it yesterday, the shares were up $75 a share, which is basically what we paid for it way back. And what was interesting was they have a long history of earnings reports that are like really good, and then the stock just goes down for no good reason. What happened yesterday was it was a good earnings report, not the best, and the stock went up a lot. And we thought, okay, so this is a stock that's now trading at 15 times. Historically, it's traded at 8 to 10 times. We think the growth is still there. It's not going to make for another 60% year like we had last year. Let's take some off the table. Let's get it back down to a 3% position in the portfolio. Sit on that cash on the sidelines, repurpose it later.
Isn't it funny? It's so much easier to sell a stock on a pop than one on a drop.
So much easier.
This goes back to the Intel conversation we're having, because you still have that tinge of hope that you're going to get a chance to actually sell it with a little bit of a bump back. It's inside the psyche of the investor pretty good, these two examples, I think.
But it's beyond just the psychology, too, which is, and it gets back to Bryn's comment about valuation and how careful you need to be with that being a trap, both on forcing you to stay in and forcing you to sell out. Right, so when I'm looking at Intel last year, I'm like, well, it's only 12 times. Historically, it's traded at this. As the stock comes down, frequently the valuation becomes more and more compelling, causing you to double down on wanting to stay in it.
Okay, so we'll take a quick break. We come back. Mike Santoli is standing by with his midday word. Lots to talk about as we look ahead to that pivotal week next week. We'll do it next.
US natural gas futures turn positive. At 1 p.m. Eastern Time, we get our weekly US Baker Hughes data, oil rig count prior 497, and total rig count prior 620.
Business.
Senior markets commentator Mike Santoli is at the desk today for his midday word. I just see GDP now at 3% for Q1.
Yes, exactly.
That's a big number.
Came into the year
to
pretty
where
hot.
Expectations kind of were at, right?
Yeah, it's actually an interesting reminder of 1 year ago, too. If you remember, everyone was sort of jolted that we started the economy really humming. We did get a bit of a surge in the S&P, although it was a different character. It was low-quality stocks. It was beat-up stuff that was mostly leading the way last January. So I don't think it's easy to quibble with the macro fundamentals right now very much. That said, you know, we bumped our heads against S&P 4800 for a few weeks, ping pong between 47 and 48 for about a month, mid-December into last Friday. Maybe something similar is happening at 49, but in general, it feels as if the dips are not really given a chance to get too deep at this point. We could have a sell the news on some of the Mag 7 earnings next week. We got the Treasury supply announcement on the 31st. You've got the Fed. We could start overreading into what Powell says, but I don't think any of that's going to change that the market is set up pretty well, and it is in tune with the macro fundamentals at this point.
Can you get your arms around the from the Mag 7 to the AI 5? Do you like that?
Yeah, I mean,
Microsoft,
hey,
NVIDIA, AMD, Taiwan Semi, Broadcom.
Let's just keep subdividing and
Why not?
recategorizing. It
Works
works
for us.
Thematically, there are a lot of ways to characterize what's going on. Sure.
Yeah, no doubt. I wanted your input on that, of course, more than anything else. I'll see you on closing bell. All right, it's Mike Santoli. Final trades are next.
At 1 p.m. Eastern Time, we get our weekly U.S. Baker Hughes data, oil rig count prior 497, and total rig count prior 620.
A trial.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
I hope you'll join me on Closing Bell, 3 o'clock Eastern Time today, because we have Dr. Jeremy Siegel of the Wharton School. That's going to be a good one because there's so much to talk about, what this market's doing and what it might do in the weeks ahead of the Fed, mega cap earnings, and everything else. So I'll see you then. Let's talk about a couple movers, if we could. Jimmy, let's do Visa earnings. They beat. Take a look at the stock. Give me your take here. You own the stock.
Down a little bit just because it's been up so massively over the last several months. I really wouldn't worry. Great company. Great company. Easy to own if you believe the economic thesis that I have.
Bryn, can you give me something real quick on Visa? You own it as well.
Yeah, I mean, Visa and MasterCard are the toll booths for the financial ecosystem. I will say this. I saw some headlines about, they said January growth was slow, but make no mistake, they said it was because of the freezing weather, and so they have seen no consumer slowdown. Right. So I think it's a great way to own financials.
All right, real quick on Amex.
Okay, so Amex.
Real quick.
It is by far the industry leader in terms of credit quality. While things like Discover have 3.9% delinquency rates, they have 1.3. They guided for 13 to 17% earnings growth ahead. That's why the stock's up 6%.
Okay, that was quick enough, I think. Final trade.
Okay, one I should give more often.
Let's
Hercules
do quick.
Capital. It's a publicly traded private credit lender, 9% yield.
Okay. Jimmy, have fun skiing. Chalet Jim.
Yeah, right. GM on earnings next week.
Okay, Josh.
Look at Toast right now, bro.
All right, Brandon, quick.
Jeppy, income is the outcome.
All right, guys, I appreciate it very much. You all have a good weekend. I will see you on Closing Bell. The exchange begins right now.
Scott, thank you very much. I'm Tyler Matheson in for Kelly Evans. Here's what's ahead this hour. Intel down double digits, weak guidance there. But one of our guests still believes in the company's turnaround story, and she is bullish on the stock. She'll tell us why and what else she's buying in tech right now. Plus, we just got the last key data point on the economy before the Fed meets next week. But did it change anything on what we can expect and what the market hopes to hear from the Fed from here? We will discuss that. And it's been a bad week for several high-profile names. Our trader is bailing on 3 of them, but buying on one she calls seriously cheap. But we begin with today's markets and Dom Chu. He's got the numbers. Hey, Dom.
All right, relatively calm, Tyler, and we are on pace right now for a decent 1% gain in the S&P 500 if things kind of settle where they are right now. But it's been a mixed picture so far. Tech is underperforming. The NASDAQ composite at 15,441 is down 69 points, or roughly 0.5%. The Dow Industrials modestly flat to slightly higher at 38,053, up just 4 whole points. That's not a lot. And the S&P 500 is at 4884, down about 9 to 10 points right now, 0.25% declines. It's been a fairly tight range so far, but we're trending towards the downside of things. At the highs of the session, up 12 points and down 12 points at the low. So, again, a decent range that's fairly tight, still tilting towards the lower end of that. The week overall has very much been focused on certain key names that have reported earnings so far. If you take a look at the overall picture for the last week, the communication services and energy sectors have done the best. Communication services being helped a lot by that big jump in Netflix shares over the past week. Meanwhile, consumer discretionary is down about 2%, the worst performing sector in the S&P for the week, and that's due in large part to the drop in Tesla shares tied to earnings. So keep an eye on those particular sectors over the last week. They're the ones that really stand out. And then, Tyler, you mentioned Intel. Just to kind of put things in perspective, this is a Dow component, big chip company out there, down 12% on the day. That move right now still kind of underscores a little bit of what's happening, even though it's still up 45% for the year. But as you point out, the outlook is what's got people worried. And by the way, even last quarter, they saw a slowdown in their unit that handles things like data center chips and artificial intelligence applications. So keep an eye on Intel. Big move for a Dow component. I'll send things back over to you, Ty.
All right, Dom, thank you very much. Intel is where we begin today, and CEO Pat Gelsinger's messaging that things will improve over the course of the year. Here's what he told John Fort.
We don't see any unique inventory issues outside of the non-core areas that we've already talked about. So we think the Q1 guide is just where the market is right now in terms of its outlook. And we see our products are well positioned, our competitiveness is good, our market share is solid, and we believe that we'll be improving in all of those metrics as we go through the year.
All right, for the full interview, you can tune into Closing Bell Overtime at 4 p.m. Eastern today. Now, the stock, we should note, is down nearly 30% since Gelsinger became CEO of Intel. Despite that, our next guest says she still believes in the Gelsinger turnaround story, which she says isn't near its end yet, and she remains bullish on the stock long term. Let's bring in Kim Forrest, CIO at Bouquet Capital Partners. Kim, welcome back. Good to have you with us. The issue here is not the company's past performance. Their earnings beat. Their revenues were higher than expectations. It's all about first quarter guidance here, and that's why the stock is getting taken to the woodshed today. Correct?
Sure. And, you know, this is what happens when companies set a really, this is what happens when companies set a really low bar. And I think they're setting it appropriately. Some of their caution has to do with the chips that they sell into the telecom area. That is an area that's been very soft for the past, I don't know, maybe 12 to 18 months, and it continues to be soft. But more than that, I think he doesn't want to overpromise. And that is what they've really done here, is definitely not overpromise.
Yeah, they're underpromising, if anything. And as Dom pointed out there in his report, I don't know whether you were able to hear it, He said that there was, I guess, some weakness in AI chips and data centers. Well, those are the two buzzwords these days, right? And if you're not hitting there, if you can't say we got AI chips and we got data centers and we got it covered, you're going to get penalized. You seem to think, though, that in the long run, this is a stock to own, right?
We do, for two reasons. First is AI is white hot right now, and specifically NVIDIA chips are white hot. But here's the thing: if you could get performance to NVIDIA at less than the price of an NVIDIA chip, I think you have a winner. And that is why I like both AMD and Intel, because that's their goal. The second reason is AI is going to create a tremendous opportunity for downstream chips, and that includes data center build-outs, which they are either being built and soaking up all the chips, or the companies are taking a break about build-outs. So it is an erratic kind of cycle.
All right. Well, speaking of erratic, I'm afraid the audio is a little bit erratic on your feed, Kim. We're going to break away. Thank you for your perspectives today. As always, we appreciate it. We're going to slip away now, however. Thank you, Kim Forrest. Let's turn to the economy and core PCE. That is the Fed's favored gauge of inflation. It ticked up a bare 0.2% in December. That was in line with expectations. Year-over-year basis, it was up 2.9%. That's the core. That was slightly less than the forecast. Our next guest says inflation is starting to cool, but the consumer remains resilient, defiant, and she doesn't expect the Fed to start cutting rates until May. Joining us now, Diane Swonk, chief economist at KPMG, and senior economics reporter Steve Leisman joins us as well. Diane, welcome. Steve, welcome to you. Take me through what these numbers tell you and what they imply about what the Fed might do and or say next week.
Well, the Fed has got to be really happy with these numbers. They're just stunningly good. And the cooling of inflation through productivity growth, you just couldn't get it a better way. There's almost a tinge of the 1990s boom in here, and I think the Fed's got to be feeling pretty good about itself. That said, it still has sort of put itself in this position where it's not ready to cut rates in March, but I think by the time they're going to start discussing rate cuts in earnest at the January meeting, and then the debate's going to get really heated in March to have that May cut instead of waiting until June. This is, at the same time, we have some people rotating into voting positions who've already sort of staked themselves out as wanting later rate cuts out there. And I think that's what the navigation is going to be. But it's going to be hard for Chair Powell to contain his enthusiasm at the press conference once again after this statement comes out next week.
Steve, once you throw in food and energy costs, the headline inflation 0.2% for the month, held steady at 2.6 annually. The Fed would like to see it maybe a little lower, but this is pretty doggone close to their target, isn't it?
Yeah, Tyler, where are the party hats and the kazoos? I'm just wondering. I mean, here we are. The thing that was the first good thing that happened was that we have the core with a 2 handle on it for the first time in, well, who knows how long it's been that low. I'm looking at the 3-month annualized core rate as 1.5%, and then Powell's super core, which is services ex housing, at 2.16%. The problem is not where it is now. The problem is how long it's been there, Tyler. And I think the trouble is I only have this one statement by the Fed to go on, which is when they're going to cut rates, and that is that inflation is heading back down towards the 2% target sustainably. And that, you can't really make the sustainable argument, especially just to undercut the data I just gave you. Some of this 3-month and 6-month annual stuff can be very volatile because of things like seasonal adjustments. Bottom line is you're going to have to see it there for a little bit. I don't think March is enough of a little bit for the Fed to have that confidence that it's headed down to 2% on a sustainable basis. So I think it needs a little bit more time, but the numbers are all real good.
Diane, I see you nodding there, so you must agree.
Yeah, so we're actually, Steve and I have not always been in agreement, but we respectfully disagree at times that we are 100% in agreement right now. The idea that the Fed wants to see, we were getting 0.16, so we got 0.17 on that core, so we were getting 2.9%. The Fed had to be getting similar numbers. They knew it was going to crack below 3 on the core PCE on a year-over-year basis at the end of the year. If we knew it, they had to know it. That's the good news. But, they want to see it down there for a little bit. And you're absolutely right. They want more proof that it's not only going to get to 2%, but stay there. They also don't want to get to 2% before they cut. And they want to cut before they get to 2%, which is that sort of difficult sort of balancing act they're doing. But I don't think they're going to get to 2% on a year-over-year basis by May. So I think we're in good shape for a May cut, and that's when we've had it. That is not necessarily where a lot of people think it will be. The biggest bet is on June, but I think May makes much more sense, and there will be very heated debate about really getting that cut into May. And I think you're going to see in March them setting it up with an additional cut instead of just 3 cuts. We've always had 4. They're going to add a cut into the sort of summary of economic projections, the dot plot as they call it, for the year of 2024.
Steve, why don't you jump in here? And I'd like to get your thoughts on the growth numbers that came out, what was that, yesterday, 3.3% in the fourth quarter?
That's exactly where I wanted to go, and I'm fascinated by Diane's take on this, too. I'd like to point out that I always respectfully disagree. You can just ask Rick Santelli about that, but when we do disagree. But here's the thing. I'm looking at the wage numbers.
I know you do, Steve.
I'm looking at the wage numbers, Diane, inside the personal income numbers. 6.7, 6.8%, and rising. The question the Fed has to ask itself is whether that is something that should stay its hand, or whether or not some of the better productivity numbers we've had recently say, you know what? It's okay. People can be making more and it not be inflationary if indeed we have these productivity numbers to back it up. I bring that up for another reason, which is that people keep pointing to the government stimulus as the reason why the consumer is doing well, but they're ignoring these wage numbers that are there, which to me does a lot better job of explaining what Tyler was asking about, which is the strength of the economy and the consumer.
Diane?
Absolutely, and I agree with you on that. And it is one of the things that is the great debate. Are wages a problem or not for inflation in the service sector? Will a floor form under inflation? And that's what they're worried about, and that's why they need more time for exactly the reasons that you said before. They need more time to know that inflation's not only moving towards 2%, but going to stay there once it gets there. That's price stability, and I think that's very important. The elevated wages are justified if we have continued productivity gains, but I do also think it's important. January is going to be, there's real upside risk to the January employment number. We laid off, on average, every January in the 2010s, 2.87 million people. That is a big seasonal to go against. Last year, we only laid off 2.5 million people. That's what gave us the strongest month of the year in January for 2023, which was over 400,000 job gains. So we could see an upside surprise on job gains, and we still have those union negotiated contracts, which buoyed wages in the month of December and had a slight uptick on those average hourly earnings. We could see those spill over into more increases in the month of January, and they're going to be watching that very closely. So I think these are the reasons why the Fed doesn't go in March and why we never had a cut in March, but why we've stuck to May, but also very moderate cuts, only 1% over the whole year, rather than the 1.5 to 2 that we've seen markets fluctuate between.
I'm going to get Steve's reaction to my question, and then I'll turn back to you, Diane. What did the recent numbers say to you, Steve, or more pointedly to those in the chatter sphere who expect the economy to slow down imminently? Now, we've seen some warnings on corporate earnings from a variety of companies. Some of their guidance has been a little soggy. But what do these numbers tell you about the prospect for a slowing economy in the first half of the year?
The first thing, Tyler, is to be humble before your predictions here, because economists and forecasters have been extremely humbled over the past year or two. And I think that speaks to a dynamic in the economy recovering from the pandemic that has not been one that's expected or followed any of the models that they had. This number, 2023 GDP accelerated from 2022 amid one of the most ambitious rate hikes cycles the Fed has ever been through. So you got to throw a lot of that stuff out. What we do know is that the economy seemed able to grow with these high interest or higher interest rates that we had. A consumer kept on keeping on, in part because of the government stimulus, but also because of higher wages. So I think to sit here now and say, yes, the economy is going to go into recession would be foolhardy. At the same time, you do have to suspect that there is some payback from these higher rates. I think the economy will slow. We haven't really had a quarter below potential in a long time. I think maybe the second and the third quarter might shape up to being below potential, but that will be a pause that refreshes.
All right, quick final thought, Diane, on that point.
I actually agree. I think, first of all, there's a lot of momentum. Momentum is a very important thing. Consumers not only have healed their balance sheets in help from the COVID aid, but also we've got wage gains, as Steve said. That's, once you start going, it's very hard to stop someone from not only regaining what was lost to inflation, but want to improve their living standards. And that's a lot of momentum to really stop. There will be additional feeling from a pinch from the rate hikes down the road. We're seeing debt compound much more rapidly on consumer balance sheets, on the credit cards that they're not paying down as rapidly now. Right. But we are in a still very solid position for 2024.
Diane Swonk, Steve Leisman, a lot of respectful agreement
Tyler,
there. Yes, sir.
I don't know what you're doing. Tyler, I don't know what you're doing this weekend, but at the Leisman family, we're taking out the party hats and we're celebrating the core with a two-handle on.
Good. Break out the kazoos. I'm with you, man.
I'll do that myself with some champagne, Steve.
All right. Diane Swonk, Steve Leisman, right. Thanks, folks. All right, coming up, Stifel shares hitting a 52-week high after an earnings beat, but CEO Ron Kruszewski says 2024 is going to be a, quote, transition year for the economy. We'll ask him why and what he expects from next week's Fed meeting after the break. Plus, the Biden administration pausing approvals of pending applications for new LNG exports. Former Energy Secretary Rick Perry calls it, quote, an act of economic hostility that will empower Russian President Vladimir Putin and hurt jobs in some key states. He'll join us to make his case. And as we head to break, here's a check on markets with stocks well off their highs. The Dow was up 166 points, now just 25. The exchange is back after this.
This is The Exchange on CNBC.
Welcome back to the Exchange. Shares of Stifel Financial hitting a fresh 52-week high this week after reporting strong fourth quarter results on Wednesday that beat on the top and the bottom line. The firm also reporting full-year revenue of more than $4 billion, third best year in history on that measure, thanks in part to record wealth management sales. Joining us now for a CNBC exclusive to talk about those results, the Fed, and more is Ron Kruszewski, Chairman and CEO of Stifel Financial. Ron, welcome. Good to have you with us, and congratulations on a very successful year. Against some headwinds in the business, it was not a simple one at all. Let's talk a little bit about investment banking, which was kind of a soft spot for a lot of your competitors and your company as well. What do you see happening in investment banking this year? Is it going to be a better year than 2023?
Well, I think it is going to be a better year. You know, it is. We did have a good fourth quarter relative to trend, but it was a difficult year, 2023, especially in equity investment banking. You know, capital raising was down, over 70%. M&A was down 50%. I mean, that was a tough year, not only for us, but across the industry. So as we look forward, because of many of the things we've been talking about on the economic front, we think that activity in our institutional investment banking will be better in 2024 than 23. That's not saying a whole lot, though, but it's definitely going to be better.
Yeah. Well, tell me about wealth management has been a strong part of your game for a long, long time. What percentage of total revenues does wealth management represent, as opposed to investment banking?
Well, last year, probably 65 to 70%, historically about 60%. So, you know, wealth management had a record year last year, and of course, our institutional business was down almost dramatically. So wealth management has been the foundation of Stifel's results for decades and continues such today.
All right, let's talk a little bit about why you say this year could be a transition year as opposed to any other kind of year. What does that mean for your company and for the markets generally?
Well, you know, look, I was listening with interest to your prior interview, and I think that the street, and certainly I, running an investment bank and a bank, would cheer for 5 to 6 rate cuts. And, you know, but I think that bringing out, the party hats and the kazoos, and I often agree with Steve, but on that one I really don't agree. I think that it might be a little early to be saying that inflation is conquered and rates are going to come down and we're going to do that. Hence, I think it's a transition year. Look, inflation's bottoming, but it's bottoming at 2.5 to 3%. And so what's it go when it starts trending back up? I just feel that we just had 11 straight rate increases, and to think that we flip into 2024 and we're going to have 5 to 6 rate decreases on 1 or 2 inflation numbers, especially with wages growing as strong as they are, I think is overly optimistic. Now, trust me, I'm talking my own book. I'm hoping for it. But as we advise investors, we think that sometimes you got to look at the consensus and look at the downside. And the downside is you only get maybe 2 maybe rate cuts. Remember, you got an election coming up, and I don't think you're going to see something happening right before the election. I don't think it's going to happen in March. So you're dealing in that middle part of the year. We see 3, maybe 4.
May, June, July.
Cuts.
So, but still, lower rates, you would applaud that, I'm sure. You also are a little more, I think, maybe personally, or maybe the firm is. You think that the street estimates of 11% earnings growth on the S&P 500 are a little ebullient.
We think so. We actually think 6%, and that makes our forecast really for the S&P 500 to be sideways in the first half of 24. Look, it's easy financial conditions, which the market thinks is going to get easier. We think are fully reflected in what is an expensive PE ratio, especially, you know, again, that we think earnings will be 6%, kind of half the street at Stifel. That's not just my view. I think that's our company's view.
That's the company view. Let's talk about the equity market, which you characterize as, or the firm does, as relatively fairly valued right now. and you like some of the sectors that were not really the superstar participants last year, like capital goods, energy, financial services, those among them, I guess you're looking for a broadening out of market returns this year.
We do. We think that those sectors, including financials, will benefit from a growing economy with sort of sticky inflation. So we see that with only 3 to 4 rate cuts, those will benefit the financials and cyclical stocks for sure.
Ron, thank you so much for joining us. We always find it a pleasure to spend some time with you. Thanks.
I appreciate it. Keep those party hats in
we'll keep the party hats
just for a little while.
How are the Cardinals going to be this year? Are they going to be better?
The Cardinals are going to be a lot better, okay? So I'm going to make a prediction they'll make the playoffs. Of course, we help sponsor them, so I'm talking my own book. Have a great day, and thanks for having me on.
One of the best baseball towns, probably the best baseball town in the country. Ron, thank you very much. Ron Kruszewski of Stifel. Coming up, it's been nearly 6 months since the devastating fires in Hawaii, and since then, companies, celebrities, and others have donated $1 billion. But where's the money going? We sent Jane Wells to find out. Jane?
Tyler, I'm outside the fire zone. We're going to go in later today, but all this last week I've been asking, who got the money? Who got the money? Show me the money. We got a few answers when we come back.
All right, welcome back to The Exchange, everybody. Nearly $1 billion destined for the Aloha State as it recovers from those devastating wildfires nearly 6 months ago. And amid all the pledges from celebrities in corporate America, Jane Wells is in Maui following the money. Jane.
Hey, Tyler. Yeah, the Lahaina remains closed to everybody as the Army Corps of Engineers finally just now begins debris removal. Nearly 6 months after the deadliest fire in modern U.S. history. We've been trying to track the nearly $1 billion in government and private money that's come in or been promised so far. For example, a lot was made of celebrities. Guy Fieri reportedly raised over $2.5 million, though my request for information on where it went has been unanswered. Oprah and The Rock started the People's Fund of Maui, and I've told they've given $50 million in $1,200 monthly stipends to over 8,000 people. And finally, yesterday, I talked to someone who said, yes, it's true. She's gotten it. People are getting it. They love Oprah. Jeff Bezos and Lauren Sanchez promised $100 million. Their spokesman says they've handed out 15.5 so far to various organizations, including the Maui Humane Society, where they are still caring for 300 animals and pets from the fire.
We spent about $2 million since the fire on fire-related animal care.
Much help for small business owners, though the SBA says it's approved almost $300 million in loans. Danny White owned Maui Memories in the heart of Lahaina. It's now a total loss. She was underinsured like a lot of people, but she's opening a new store on another part of the island, hoping she can make enough to cover the rent.
I have employees who are waiting to come back to me, and I want to support them too.
The biggest problem remains long-term affordable housing. Over 5,000 people are still living in hotels like the Royal Lahaina Resort, but every suggested solution here is challenged. Tyler, it's very difficult to get anything done in Hawaii. So many cultural issues, sacred ground everywhere. In fact, they haven't even figured yet where the final resting place for the debris is going to go. It's a lot of work ahead.
Jane, what's happened to tourism in Maui?
Well, it is coming back. It just, dropped off like a cliff. Some of the resorts were closed for 3 months. It was over like 60% drop. It's now down about 14 or 15%, but the good news is so many other people are going to other islands. Overall tourism in the state of Hawaii, which is its #1 industry, is only down about 1.5%.
That's interesting. Thank you very much. Jane Wells, appreciate it. Now to Courtney Reagan for a CNBC News update.
Hi, Tyler. The State Department said today that they will pause funding to the United Nations Relief and Works Agency. Israel said 12 of its employees were involved in the October 7th attacks on southern Israel. The statement also said Secretary of State Blinken spoke to the United Nations Secretary General to say that there needed to be a thorough investigation. The agency's Commissioner General said that investigations have already begun and that the employees were fired. The Biden White House is losing a top advisor next week after playing a key part in President Biden's immigration strategy for 3 years. Katie Tobin served as the senior director for transborder security and is leaving at a time where border policy is at the forefront due to the record levels of migrants crossing the U.S.-Mexico border. And King Charles is doing well and will be spending at least a night in the hospital after receiving treatment for an enlarged prostate today. That's according to Buckingham Palace. Before going in for the procedure, he visited his daughter-in-law, Princess Kate, who also had surgery at the same hospital last week and is still there recovering. We wish them all the best. I follow that story closely. Tyler, back over to you.
Indeed, we do. Thank you, Courtney. Courtney Reagan. Coming up, the Biden administration pausing approvals for new LNG exports, with the president pointing toward the climate crisis as, quote, the existential threat of our time. We'll look at the fallout with the former Energy Secretary Rick Perry. That's next.
CNBC.
Welcome back to the Exchange. President Biden hitting the pause button on new LNG export projects in what's being seen as a victory for climate activists. And while critics say this will embolden Russia's President Vladimir Putin in the Ukraine-Russia war, which has disrupted gas supplies in Europe, the administration says the plan includes exemptions for national security should U.S. allies need more nat gas. Joining us now with more on this move is former Energy Secretary and former Texas Governor Rick Perry. Mr. Secretary Perry, or Governor Perry, welcome. Good to have you back on CNBC. We appreciate your time. The president has characterized this as, among other things, a pause that sees the climate crisis for what it is, the existential threat of our time. I assume you don't agree with that.
Well, nothing that I can think of is going to put more coal plants back to work than this pause, if you will. This is just bad public policy for a lot of reasons. If you really care about the climate, then you ought to be using clean burning American liquefied natural gas if you're a European. They're going to keep the lights on over there. There's not any doubt about that. So they're going to replace these gas burning plants with the old coal plants. They're going to put them back into production. So what does that mean for America? Well, it means not only are we going to see a lot of economic impact in a negative way. We're going to see jobs lost. And these jobs aren't just in Texas and Louisiana, where most of these plants are. It's in Ohio. It's in Pennsylvania. So the political fallout of this is going to be pretty substantial, I will suggest to you. While, Biden's worried about, he's fallen in the polls and he's looking for ways to get the left, if you will, back supporting him. And this is what this is about. So,
yeah, I was going to ask you that, Mr. Secretary. Do you see this then as really rather purely a political play to prove to environmentalists in the Democratic Party that the president's bona fides in environmentalism are pure here? And it's ironic because, as you point out, some of the biggest producing areas for LNG or for natural gas is Pennsylvania, a key swing state. Ohio, another one.
Yeah, good point that you bring up, Tyler. It has the added benefit of being true from the standpoint of how this action is going to be affecting the United States. You look at this administration and they make decisions and put these orders into place because they can't get them through Congress. They can't get the American people to support them. So he does them unilaterally. And I will suggest to you, the American people are going to send a message in November, a pretty strong one, that, we want the border closed for one thing. We want immigration policy that is thoughtful and not this open border. I know that's a whole different issue, but it's the same concept. You can't get something done through Congress. The American people don't support it. But this president, to play to his political base, goes out and puts these things into place, whether it's this anti-American energy policy. And the other thing it's doing is sending a terrible message to our allies in Europe. We're supposed to be supplying them with the power that they need so that they're not held hostage by Russia.
I suspect
the Russians will use this as a weapon.
I suspect, Mr. Secretary, if an environmentalist, broadly described, were sitting next to me right now, she or hers or his response might be something like this. Well, we are already the largest exporter of LNG in the world. We have already grown our LNG exports by a factor of 3 in the past 5.5 years. And oh, by the way, these plants or installations that would participate in the export transshipment of LNG, they're not just 5-year projects. They are things that are going to set in place LNG use for a generation. And we are trying to decarbonize, to step back from. Now, listen, natural gas is a cleaner fuel than coal. It is cleaner than oil. It's cleaner than a lot of alternatives out there. But these installations would set in stone then a level of carbon emissions that we want to back away from. Could you just respond to that? Am I all wet there, or would that be kind of what an environmentalist might say?
I suggest that's probably what they would say. It needs to have some basis in truth and fact. And the issue is the Europeans are going to keep their lights on. They're not going to go live in the dark and the cold. And the way that that's going to happen is they're going to be using coal plants. We've already seen this. This transition's already back to coal is already happening. So the idea, if you care about the environment, as we make a transition over the next 20 or 30 years away from these fossil fuels to small modular reactors, speaking of, where are the environmentalists when it comes to zero emission small modular reactors? Well, they're against those as well. So they're really hard to pin down, other than to say we don't like American natural gas being sold. It's okay for the Russians and the Qataris and the Iranians, but American natural gas, no, we're going to stop that. Well, I will suggest to you that that is the head in the sand approach that will get you in trouble, both short term and long term.
It's too irresistible to have you here and not ask you about politics, domestic politics, and where you see, would presume that you see former President Trump sort of waltzing to the Republican nomination and into the fall's election. You happy about that?
Yeah, well, I don't see any roadblocks in the way to that happening. I think President Trump is on his way to the nomination, and frankly, I hope to the presidency, because I know the people that he will put into place. I know the policies that we will see there, and whether it's an economy that's growing, whether it's America being energy independent again, whether it's our allies being able to count on us and America being strong in the world again, which one of those do you not like?
If Nikki Haley were sitting next to you right now, what would you advise her to do?
Stay up to date with the latest.
Well, I'll leave that up to her. I've been in that position of coming up a little short, and you know, I made the decision to step back and look towards the future, and I think that's what my advice to her would be. It's very clear that Donald Trump's going to be the nominee, and we need to come together, work together. The issue now is, do you want the continuation of the Biden policies that are strangling this country in a lot of different ways, or do you want to go to policies that are economically strong, energy policy strong, national security strong? That's the choice that the American people have.
Well, I suppose I need to push back a little bit there. The economy's doing pretty well, 3.3% in the most recent quarter. Job growth has been pretty good. That would be the defense that the Biden administration would make. Governor Perry, former Secretary Perry, thank you so much for your time today. Appreciate it.
You're welcome.
All right, thank you to Rick Perry. Coming up, you can't spell fundraising without AI. The eye-popping sums being raised by some of tech's biggest names to capitalize on the hype. Next, The Exchange will be right back.
CNBC.
There is a new funding frenzy in the startup world, this time led by tech titans, the likes of Elon Musk and Sam Altman, now looking to raise billions for projects separate from their existing companies. Deirdre Boza has the story for today's Tech Check. Hey, Dee.
Hey, Tyler. So apparently it's not enough to be running the biggest existing companies in the world. These guys, they want to build the next generation as well. Where else but generative AI? You mentioned Musk and Altman. Let me run through. And these are reports. Elon Musk is in talks to raise up to $6 billion for his startup. Brett Taylor, of the former co-CEO of Salesforce, and now he's on the OpenAI board. He is reportedly close to finalizing a $5 million investment in his firm, Sierra. And then, of course, there's Sam Altman, who is reportedly raising billions of dollars to build out a network of AI chip factories. Now, these are not small ambitions, nor are they cheap. It is very expensive to build in this space. I mean, we've talked about the compute power that is needed that has led to billions and billions going to companies like OpenAI and Anthropic. So that's needed. But also, there's this question of talent, and the race is on as well, right? I was at this dinner last night with some of the key players in enterprise AI, the CEOs of Box, Databricks, and Salesforce AI. And we were talking about sort of what is needed to build and develop. They're all very excited. The CEO of Salesforce AI said that this is a moment like 1997. We're going to start to see the winners, but the winners right now may not even be the winners a few years from now, kind of like how Google displaced Alta Vista and Yahoo ultimately. And this was really interesting from Ali Ghodsi, the CEO of Databricks. He said that a senior AI researcher was commanding something like $20 million over 4 years. And those are just astronomical levels, Tyler. That's like athlete level of compensation.
What is your reaction? I'm looking here at an Axios report indicating that the FTC may start to look at big tech's investments in AI.
Yeah, so we talked about this yesterday, and this follows sort of European regulators doing a similar thing, but they're looking into these deals, the type of deals that Microsoft inked with OpenAI, and looking to see that if it's kind of hindering the smaller startups in this space. Is Microsoft, by investing, $13 billion into OpenAI, is it giving it an advantage? And that's probably relevant for some of these tech titans, although probably some of the smaller guys, because they start from such an advantage and they have an easier time raising money. But it just goes back to this whole idea of who's going to win this massive shift that some say is as big as the internet or the industrial revolution. Is it going to be the incumbents, the Microsoft, Googles, Amazons, that are able to spend these billions of dollars from their balance sheet, or is it going to be new players?
Fascinating stuff. Deirdre Boza, all over it. As always, thanks. All righty, coming up, this name is the second worst performer in the S&P 500 this week. But does the dip present a buying opportunity? We'll get the trade next when we reveal our mystery chart.
the app today.
Welcome back to the Exchange, everybody. Major averages saw record highs this week, but that tide didn't lift all boats. Some stocks posting major losses, and we're going to look at how to trade those dips in a 3 bails and a buy week edition. Here with our trades, Gina Sanchez, Lido Advisors Chief Market Strategist, CNBC contributor. Let's start with a stock that plunged after the company pre-announced mixed fourth quarter results, disappointing guidance. That's been the story for some companies this week. DuPont shares down 12% this week. Two firms downgraded their ratings to their hold equivalents. But Gina, you are steering clear altogether. You call this a sell, right? DuPont.
Yeah, so DuPont is suffering on two fronts. One is that they do have some cyclicality to a lot of the end users of their chemicals. Now, given the GDP numbers, that should be fine. But the other double whammy for DuPont is that China just is not taking up their destocking, and it's just hurting them, and they're not able to get over that. And I think that that's something that's probably going to continue.
All right, so that's a bail. All right, next up on our list of bails is a member of the so-called Magnificent Seven that Jim Cramer said should be removed from the group. Magnificent no more. Tesla missed on the top and bottom lines after the bell on Wednesday, had its worst trading day in over a year. On Thursday, $80 billion in market value wiped out. That could pay for a couple of Twitters right there. Your take on Tesla, Gina?
Yeah, so Tesla's a tough one because they have such an advantage in terms of charging, the charging network that they've built out. The car that they've built is beautiful, but they have, Elon Musk has started to go off on these tangents. The Cybertruck is, in my opinion, ugly, and quite frankly has actual safety issues that may prevent it from being sold in Europe. That's a problem. And you have Elon Musk himself sort of going on these tangential ideas that are taking away from his focus on Tesla. This is a problem. While I think they have the strongest charging network and they have the best car, their growth will naturally start to slow if they don't keep building on that. And there's a lot of reasons why that the focus is just not there.
Some very tentative guidance out of Tesla earlier this week. Final bail is Humana, having its worst day in 2 years yesterday. Shares sliding more than 10%. Surprise fourth quarter loss and weak full year guidance as more Medicare patients opt for surgeries they put off during the pandemic. That raises Humana's costs. Gina, you're not buying the dip.
No, I'm not buying this one because Humana is blaming costs and Medicare, the Medicare Advantage program, on their miss. But if you look, for example, at United Healthcare, which is the largest issuer of Medicare Advantage programs, they're able to manage this better. So I think this is a problem within Humana, not a problem with the Medicare Advantage program.
And now we're going to get a buy, and that would be PayPal. Shares down fell yesterday following what the firm called an unforced communication error, when new CEO Alex Chriss told CNBC his reveal would shock the world, but then just formally announced projects that had been teased last spring. Some shock. Now down 25% this year. Gina, you think this is an entry point on PayPal? That, I think, is our mystery chart, down 5% for the week so far.
It is, Tyler, and I feel like I'm going to go to my grave. On my gravestone, it's going to say, she said PayPal was cheap. But, what they were revealing were things that were already in the works. It actually cost a lot of money, and it was one of the reasons that they had problems really managing their margins and their earnings last year, or earlier this year, I should say. But those are really going to start to pay back. The features and the functionality that they're bringing out, in particular the fast lane, the ability to very quickly pay for things, that's important, and I think that will be beneficial.
Got to leave it there. Gina Sanchez, Lido Advisors, thanks very much. That does it for the Exchange. Contessa Brewer getting ready for Power Lunch. I'll join her on the other side of this quick break. Welcome to Power Lunch alongside Contessa Brewer with Shaky Nick on the steady can. I'm Tyler Matheson. Coming up, the Fed's favorite. Look at how smooth he is. Inflation gauge, the core PCE, rising slightly and up nearly 3% from a year ago. Between that and credit card company results, we have some interesting consumer insights to dig into. More on that shortly.
You know, we laughed, but if you'd been funnier, he would have laughed.
He would have laughed and gotten a jiggle out of that.
We have a looming labor strike in Las Vegas, which could threaten the biggest sporting event of the year in more ways than one. First, let's get a check on the markets. Tyler, you want to do that?
Yeah, the Dow slightly higher, as you see there, by 0.02%. That's really slightly higher. The S&P 500 down about 1/5%. The NASDAQ down 65 points, about 0.4%. A number of names hitting new 52-week highs. You got your Meta, you got your Netflix, Ross Stores, TJX, and Merck.
Well, on the negative side, though, you've got Intel slumping after issuing some weak guidance. There you're seeing it down 12%. Is that 2%? It is 12%. There it is, 12%. We got it right. It's right on the line, isn't it?
Right on the seam there, right on the seam.
It's not a great sign, though, for the chip space. Western Digital, KLA also lower following those results.
Let's start with some insights into the consumer we're getting today. Credit card firms say the consumer is resilient, but some signs casting doubt on whether that will last for long. Plus, we'll find out soon whether that holiday spending will stick or if retailers are seeing higher than normal returns. And a lot of eyes are on another key area of consumer spending. That would be restaurants. We've got full team coverage on these stories. We're going to start with Kate Rooney on those credit card earnings results. Kate.
Hey, Ty. Yeah, so the theme of credit card earnings so far, it's been all about consumer spending, and that has still been strong. It's boosted quarterly numbers for Amex and Visa. American Express, though, is the winner so far, at least if you look at the stock reaction. The company's positive outlook been the main driver. It forecasted better than expected profits for this year, and it boosted its dividend as well. I caught up with Amex's CFO, who told me the higher income consumer that they serve is looking strong. He pointed to restaurants as a bright spot there, topping $100 billion for the first time. Spending was up 11% compared to about 6% across the board. Airline spending, though, did slow a bit. He also said they're gaining traction among younger people, Gen Z in particular. And then Apple Pay's growth he talked about, said it's a win-win for Amex while it's been a negative for companies like PayPal. Amex did see record revenue, although that and earnings were light of expectations. And then you got Visa. So by most accounts, Visa had a really strong quarter, beat estimates, saw pretty strong cross-border volume. The reason for the stock drop was the slowdown we've seen in U.S. spending, at least in January. The company actually partially blamed severe weather conditions, keeping people inside and spending less in the last few weeks. Also forecasted disappointing second quarter revenue. Growth has been up double digits, but it does appear to have plateaued a bit in recent quarters. Management once again calling the consumer resilient. That is deja vu. We've heard it from Visa before, citing holiday shopping and travel. Guys, back to you.
All right, Kate Rooney, thanks very much. And joining us now for the rest of the hour to talk about this and a whole lot more, Steve Grasso, CEO of Grasso Global. Steve, welcome. Good to have you with us.
Good to be here. So much fun to be in a different studio.
Yeah, you've got the window seat here, so we reserved it for you. Let's talk about the credit card companies. I guess the big three are Amex, Visa, MasterCard. There are others, but...
So if you look at it, just to pick up where you left off in that segment, American Express has the highest the most affluent clientele. And that's where, if you're worried about recession, where do you want to go to? The most insulated. So that's the 50,000 foot up on that name. If you look at Visa, the revenues weren't that bad. Up 9%. So it was their guidance or the way they felt about the transactions. I don't know what to make of that. I don't know if it is a weather issue, but we're willing to give it to them because the consumer hasn't cracked yet. What does the consumer still have? A job.
Yeah.
What do you do when you have a job? You still spend. So I think all of these, and if you look at the charts on all of them, the technicals are all intact. The technicals on American Express look actually the best. That's the most momentum. Visa, a little bit waning, and MasterCard is somewhere in the middle.
You know what is getting under my skin and almost causing me to put my credit card back in my pocket is the fact that more and more merchants are trying to recoup the charge that they have to pay to the credit card company. So they're charging you 3% if you use your credit card, or 2%, or whatever it is.
But now we're getting a window into how these payment providers make money, right?
Sure.
Like if you're a consumer, all of a sudden you're like, oh, right, it costs money to use my Visa.
True. But think about what is the alternative, though?
Well, it's to pay cash, I suppose.
Right. So you better get a big rubber band.
You
That's what
gotta
I have holding my credit cards and my cash in my pocket. I am carrying, to your point, more cash than I've ever carried before because what do they normally do now? The first one to go is American Express because it has the highest transactional fee. And then it's the Visa and the MasterCards. But there's a lot of companies that don't accept any credit cards these days.
Yeah.
I feel like I'm back in the 1980s.
There's also a lot of companies that don't accept cash at all. They are cashless, and that creates its own set of problems. Can we move? Let's move on.
Let's move on.
Let's go.
We'll talk more.
Let's go with our consumer check-in time of the year that retailers are closing their window for holiday returns. It's a sign of relief, not only because the practice costs them money, but because of growing fraud. Courtney Reagan has that story for us. Hi, Court.
Hi, Contessa. So it's not the increasing cost of returns that concerns retailers the most, even though the cost of processing an online return averaged at least 21% of an order's value, according to Pitney Bowes.
Fraud is number one, and it's not even close to number two. And number two is really the cost of doing something with those returns, because that's a very manual, labor-intensive thing.
Retailers expect 16.5% of holiday returns to be fraudulent this year. That's $24.5 billion worth, up from the annual average of 13.7% of returns that are fraudulent. This is according to APRIS Retail and the National Retail Federation. Now, Saks CEO Mark Metrick told me at the NRF Big Show that fraudulent merchandise not received complaints have doubled over the last several years for his retailer in particular. Now, other fraud tactics include shipping back a different item than was received. That's actually number one, like a box of bricks instead of a TV, returning stolen gifts, and or using counterfeit receipts. So here's an example from APRIS Retail of one person netting more than $224,000 from fraudulent returns. They returned 1,000 fraudulent items, 215 stores across all of these states using a variety of some of the tactics I mentioned above. Now, return fraud has caused a number of retailers to tighten their return policies writ large. Some, though, are using AI to personalize their return policies. That includes retailers like Amazon. So my return policy for the same item, Contessa, might be different
I
than
know.
yours.
It's going to be far superior to what mine is, Courtney.
Contessa puts bricks in the return.
Well, like I go find them in my Manhattan apartment.
Yeah.
Courtney, thank you.
Thanks.
I mean, that's a fascinating look. It's got to be expensive for one person to go in all of those places to return that, too.
It's got to be expensive to ship a brick back.
Yeah, exactly.
It's probably more expensive than the actual item anyway.
I totally concur.
Right.
We have heard a lot from the retailers about returns, shrink, fraud, all of this. Give me your big picture sense on retail and where it's a good investment.
I hope in 2024 we start to crack down, and I hate when they call it slippage. It's crime, right? You're walking into some place and you're stealing something. They have to crack down on that because these are big numbers now. They're not little incremental numbers, and they just keep exponentially getting larger. But let's talk about stocks. So my favorite stock in the space is Costco. When was the last time you guys went to Costco? I would assume it's pretty often.
Every night.
Right around Christmas time.
And your membership, above 90% on membership renewal.
Oh, I'm sure.
It becomes an annuity.
Yeah.
They do better than Walmart. But now let's slide a different way. Amazon, mega cap tech. What do they have that Costco doesn't have? AWS. So the number one in cloud computing, followed by Microsoft. So if you want that kicker of mega cap tech and you get the retail strength, you go with Amazon as well.
Love them both.
And then you flashed up before I came on, TJ Maxx and Ross Stars. So those are, if you think about the pandemic, what did we have a lot less of? Supply, right? With the supply chain was halted. So those companies get the excess in supply and they sell them at discounted rates. Now the supply chain is more intact. Those companies have things to sell.
All righty, finally, let's move to the restaurant space. Three key issues are in focus this earnings season: value for customers, AI, and wage hikes. And Kate Rogers has got it covered for us. Kate.
Hey there, Tyler. First up, value. As mentioned, TD Cowen's Andrew Charles says he expects a pickup in value pricing at restaurants, but not necessarily a spike. BTIG's Peter Saleh says it's already upon us. That also could continue into the spring as restaurants look to grow traffic this year. Remember, grocery prices are rising at a slower rate than restaurant food prices are. So analysts say that restaurants may do some targeted value offering on their digital platforms as names like McDonald's set ambitious goals to grow there. Another area of focus, of course, wages and and minimum wage hikes. 22 states raised their wages to start the year, and industry watchers are looking to April, when California out here will have the highest wage in the country for fast food workers at $20 an hour. Earlier in January, Pizza Hut franchisees in the state began driver layoffs in advance of that, so you can expect that higher prices for fast food operators are going to make up for that labor inflation, or a move into another theme, which is AI and automation. Del Taco is one example that TD's Charles points out, already using AI in its drive-thrus for orders. Other big names like Chipotle, which warned of higher costs in California, have been testing out robotics to ease kitchen operations prior to this wage announcement. So that could be another theme this year to combat wage inflation in the future. And a quick final note on the restaurants, the Middle East and the war there. Papa John's and McDonald's have already warned of potential impacts from the war, and Starbucks will be another name to watch, guys. Back over to
Kate,
you.
thank you very much. Steve, some thoughts on restaurant stocks? I see that you like a couple that my son likes.
Yes. So Shake Shack has been a favorite of mine. I'm actually long the stock today. Chipotle is the second one. I'm not long that one. But if you look at the price action in Chipotle, if you see the chart up there, that price is astounding. And now I know that a stock split does nothing for shareholder value, but what does it make people do? Go out and buy the stock.
Yeah. Because it seems cheap.
Because it seems cheap, and they figure, oh my gosh, I'm going to get 10 for every one that I own. That's a bargain. I want that. I want the right size stock split. So Chipotle and Shack will benefit from international expansion. Very few stores in both of them are outside the United States.
They're U.S. centered.
Is that an opportunity?
I think it's an opportunity. And if you look at it, that's where they've perfected, especially.
We're new.
That's good.
That's your delivery from Chipotle.
Yeah, I always have it on silence, but I let my family slip through my thing just in case. So when you look at a Chipotle in particular, you want to perfect the operational skills that they have in the U.S., and then you want to bring that to the other countries. They've done that. Shake Shack, much smaller scale, but the same opportunity internationally.
All right.
Good.
Thanks. Great to have you with us. You're going to stay with us for the hour. Coming up, a growing viral debt debate. Consumers still spending for now. That may be fueling another problem, debt. And as that continues to grow, a lot of people are turning to social media for help. We have that story next. Plus, further ahead, between constant strikes and layoffs, tensions are growing throughout America's labor force. We discuss those issues when Power Lunch returns.
So U.S. Treasury Secretary Yellen says U.S.-China Economic Working Group are to meet shortly for larger discussions on China's macroeconomic situation. Says the U.S.-China Financial Working Group meetings are focused on pressures in financial sector and banks stemming from local governments' debt problems and real estate. And Yellen says the U.S. economy may see some spillovers from China's financial turmoil if it leads to slower growth in important Asian trade partners. So, U.S. Treasury officials visiting Beijing last week received assurances that Chinese banks are doing well. It says she does not think that the potential spillovers from China's turmoil to the U.S. will be very large, so doesn't think that. U.S.-China Financial Working Group meetings focused on pressures in the financial sector and banks, again stemming from local government debt problems and real estate.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
As we discussed before the break, despite some hiccups, credit card stocks still boasting resilient spending. On one hand, good news for the economy, also raising some worries about America's massive debt, consumer debt. Credit card debt sits at over $1 trillion in the U.S., and discussions around that growing debt are prominent now on social media. On TikTok, many financial influencers have made careers on helping people get out of debt and change their spending habits. However, some call this debt shaming, encouraging people to have no debt at all, putting a moral value on it, leading to a debate on the financial side of TikTok, aka FinTok. Here to discuss America's debt problem is Jade Warshaw, a personal finance expert and co-host of The Ramsey Show. Steve Grasso here as well with us. Welcome. We appreciate it, Jade, you're being with us. So,
thank you for having us.
What are people saying on social media that has some folks saying this amounts to debt shaming, that we're making people feel worse than they ought to about carrying some levels of debt?
You know, I don't think it is about debt shaming. I think it's about bringing a very real topic to the forefront, or at least it should be. I mean, we do see that 78% of Americans are living paycheck to paycheck. We know that, 49% of Americans have reported that the state of their finances is causing them mental distress, right? It's a negative effect on their mental health. Most Americans, they can't afford a $1,000 emergency. And so this truly is the reality of the situation. And we should be shining a light on that and offering solutions, not shaming people. And so, if it's me, I'm giving you solutions. I'm telling you, listen, let's stop borrowing money. Let's get on a budget. Let me teach you how to start paying off your debt. And shame is really the last emotion that I want people to feel.
It's interesting because we often talk about how that kind of education should start much earlier in elementary or middle school, or for certainly in high school, before money becomes a problem for instance, those who graduate from high school and then get themselves in a lot of credit card debt. I was interested in your 5 pillars of personal wealth. You're saying not only to get out of debt and to live on a budget, but also to have the proper amount of insurance. I mean, is any of this going to, do you think, really carry through to kids who, and I say kids, but a lot of times it's even older adults who are like, I can't afford to put gas in my car this week, much less think about, am I carrying proper insurance?
Yeah, I couldn't agree with you more. We're not taught this in schools, and I do think that's a problem, and it's a problem that we're working to solve. We have a curriculum that we're introducing to more and more schools, foundations in personal finance. And so we are offering that, but I think you're right. People are looking to social media because they're like, what is the first place for me to start? And I do think that if you're going on social media, you want to look for any credible source, right? And a credible source is one that's going to be teaching you those 5 pillars, right? To get out of debt, to live on a budget. You need to carry those insurances. Obviously, we want you saving for an emergency fund, for retirement, and prioritizing generosity. But to your point, the order in which you do those does matter. And so for people who feel overwhelmed and think, oh my gosh, I can't, afford to do all those things. Of course you can't. We want you to start at step 1. And for most people, it's just getting $1,000 saved and getting on a budget.
Jade, we started off the show talking about having credit cards or cash in your pocket. And when you look at the younger generation now, everyone has Apple Pay. And I asked my children, even when I use Apple Pay, you have to be cognizant over what you are spending. So do you encourage people to use less Apple Pay and use more paper money because you're cognizant over what the bill actually is at the register or online? Obviously, you can't do it, but they don't even know how much they're spending, including myself, when you're using all cards.
That's right. You're exactly correct. I mean, we know that the studies have been done that when you use cash, it lights up those pain centers of your brain. You actually feel it leaving your body. And now, don't get me wrong, a lot of people aren't walking around with loads of cash in their wallet, although we have seen that cash stuffing is a big trend on TikTok and Instagram. And I'm a proponent for that. Listen, if you can pull out cash from the ATM to pay for things like going out to eat, to pay for your groceries or gas, you are going to spend less money. But even going and using a debit card, that even helps. For the first time, my husband and I've never used Apple Pay, and we used it for the first time last night to pick up Indian food. And my husband said, wow, you're right, Jade. I didn't feel that at all.
Yeah,
so there's
really
zero
true.
friction, and we want to create friction.
When I was working way back when in the world of personal finance, there were two sort of things that we said if people are trying to get on a budget. Number one was pay cash, because you will feel it when you pull out the wallet and you pay cash. The other is to pay by check, because the act of actually writing down what you're paying and then maybe balancing your check register there. You're not going back. Let me ask you this, Jade. When is debt good?
You know, I have to tell you, I don't really think the only time that I would say debt is okay is if it's your primary mortgage and you're purchasing it the correct way. Other than that, honestly, I think the only good debt is a paid off debt, again, with the exception of that primary mortgage, because in that case, it's really acting as a forced savings account, right? It's something that is an asset, it's going up in value, and that equity belongs to you.
I take your point on mortgages, but what about automobile debt?
Never that. I would advise anybody, the first thing to pay off should be, if you have a credit card or if you have a car loan, that is what's keeping the middle class. For most of us, it's the car payment that's keeping us broke. No wonder people say, I don't have money saved. No wonder they're saying, I can't save anything for retirement. I'll give you a hint. It's in your car payment. So add that to your debt snowball and get it paid off as quickly as possible.
Although if you're paying 29% on average on your retail credit card, that'll get you poor really fast, too. Jade, it's great to see you. Thank you so much for joining us.
It was my pleasure. Thanks for having me.
Still to come, a Patriots wide receiver arrested in Louisiana for sports betting violations. We break down what it means for the industry. We're back in 2.
I'm a member.
Welcome back. Key economic data out today. Let's check in to see how it's affecting the bond market. Rick Santelli is tracking the action from Chicago for us. Hi, Rick.
Hi, Contessa. And you're asking the exact correct question because the market does have an input here. Now, if you look at rates from 2s to 30s, all of them are up on the session. So if the numbers this morning were as cool as so many people have been saying, why are rates up? I don't think the numbers were as cool. We've definitely made progress, but the job doesn't seem to be finished. Now, here we are at 4.16 in 10s, which happens to be the high yield today. And boy, the next couple hours are going to be really important. Why? Okay, let's look at a one-week chart. Okay, you see to the left there, that spike, that's 419. Okay, that was the 2024 intraday high. Okay, now let's look at a year-to-date chart of 10s. You see on the right side there, that spike, that's 4.17%. That's the 24th. That's the high yield close for 2024. So you can see how it's all jumbled together. And here we sit basically right below both those levels. And should we start to see yields move up a bit and price move down, you could see some action today. These are important levels. And finally, if we consider that the 2-year break even, which I don't have a chart for, unfortunately, is at a 9-month high, just shy of 2.4%. Finally, the year-to-date of dollar index, it's already up 2% on the year. None of these seem to augur with the notion that inflation is ready to be, put on ice and easing to start. We have a meeting coming up for the Fed. It's going to be interesting to see how they frame the recent spat of data. Tyler, back to you. Have a good weekend.
You too, Rick Santelli. Thank you. Let's get to Julia Borston now for a CNBC News update. Julia.
Tyler, a Russian judge once again extended the pretrial detention of Wall Street Journal reporter Evan Gershkovich. It has been pushed until the end of March, meaning Gershkovich will spend at least a year behind bars since his 2023 arrest for espionage. Gershkovich and the Wall Street Journal have strongly denied the accusations that he was trying to obtain defense secrets, and the U.S. government has declared him wrongfully detained. Uber filed a legal appeal against a plan in Paris to restrict access to tourist vehicles on 2 major streets in the central part of the city. The ride-sharing company is trying to overturn the restrictions and warns that if they remain in place, it could cause big problems with transport for this summer's Olympic Games in Paris. Work productivity took a hit this afternoon. Thousands of people reported on downdetector.com that they lost access to Microsoft Teams. It's not clear how widespread the issue is. Microsoft said on social media platform X it identified a networking issue impacting team service and is working on a fix. Guys, I hope it hasn't impacted your workflow. Back to you.
Has not at all. Julia, thank you very much. Have a good weekend. Coming up, Las Vegas Culinary Union 1 week away from a potential strike just ahead of Sin City's first ever Super Bowl. We will break down that and all the labor issues across the country when Power Lunch returns.
So seeing NYMEX WTI crude March futures settle at $78.01 a barrel, which is up 65 cents or 0.84% on the session. Diesel February futures settle at $2.84. Gasoline February futures settle at $2.29 as well. Natural gas futures at $2.71.
A trial.
Las Vegas Culinary Union is just a week away from a possible strike ahead of the first ever Super Bowl in America's gambling capital. Contracts lapsed last summer for workers at more than 20 properties, and the union is asking for record wage hikes, better pensions, and built-in protections when it comes to automation replacing human jobs. Workers today are holding informational pickets outside Circa, Golden Nugget, and Fremont. Those are all casinos in the downtown area of Las Vegas. The union, of course, struck a deal with Wynn, Caesars, and MGM. They're the biggest companies in Las Vegas. They did it just ahead of F1 in November, and it resulted in the largest wage increases in the union's history. Well, now they have a week to hammer out deals with 21 other properties, making up nearly 5,000 workers. There is a big sticking point. The union is asking for the same wages at the smaller casinos that the big guys are paying. The union told me, yeah, that's standard, and says the casinos are making huge profits, even the small ones, in the post-pandemic boom in Las Vegas, and that the workers deserve to participate in the upside. A spokesperson says workers are committed to striking next week if their employers won't make a deal. And of course, that's going to affect hospitality at the Super Bowl at those affected properties. And it has an impact on the bottom line. We know from Caesars, for instance, they just revised the fourth quarter estimates in part because of labor costs attributed to this historic deal with the culinary union, Tyler.
Interesting stuff. Let's talk a little bit more about this looming or potential Vegas strike, only the most recent example of labor tensions here in the United States. For more, let's bring in Dan Julius. He's a labor management scholar and practitioner with academic affiliations with Yale, Rutgers, and Case Western Reserves. Mr. Julius, welcome. Good to have you with us.
How are you today?
Yeah, we're fantastic. Let's talk a little bit about this Las Vegas situation. What do you expect is going to happen there ahead of the Super Bowl? And why has this union, among many others, become rather agitated recently?
Well, I think what you're seeing in Las Vegas is almost a perfect storm. You have unity among the unions. You have 100 different unions operating there. You have a labor market, which is tight labor market in the sense that these places need these individuals. There was an exodus of hospitality workers during the pandemic. And now you have a major event coming, similar to the Formula One in a way. And there is no way that the power structure in the city wants a labor strike at this time. Keep in mind also, these are the unions that gave Joe Biden Nevada by 2%. They were out there, and there are strong connections there. You know, unions in Las Vegas have a long history, and I suspect they will come to an agreement. I don't know the details, but I suspect they'll come to an agreement rather than have labor strife during the Super Bowl.
Well, because there is competition for labor in Las Vegas, and, you know, the housekeepers matter. Let me ask you about this sticking point that I was told about. Is it typical to have wages at a smaller company be on par with wages at a much bigger company? I don't know, like, if this is a good comparison, but does Spirit Airlines pay its flight attendants the same as United? Does a local news station that belongs to the union pay its reporters the same as the reporters in New York City?
Well, I'd hesitate to say anything in Las Vegas is typical, but I would say that there's always comparability, and it depends upon the union has political problems of its own if they are representing the same group, and one group is being paid very differently than another. So there's no question that there are strong pressures mitigating towards paying very comparable wages, no question. And I think that what we'll see is something very similar along those lines.
There's another issue that it was a sticking point, I understand, in the negotiations with Wynn, MGM, and Caesars about automation. We're talking so much about AI replacing human beings. I'm curious to hear what you think of this. The union told me in Las Vegas, we aren't trying to stop automation from taking our jobs. We know that's going to happen. And especially, you see the robot vacuums coming through or the robot bartenders. They said instead what we did was we demanded specific language and protections so that, one, we're alerted that it's coming. We're now looking at vendors for robot vacuums, and we're going to be replacing housekeepers for it. Two, here's some money to go start retraining these workers who will be replaced. Three, severance if there's no job waiting. Is that something that you anticipate will be more in use across the nation and across industries? It looks like we're frozen. We've got one of those moments where Zoom is not Zooming.
There's a problem with Teams and.
But what do you think? Like, you know what I'm saying? We are talking all the time about whether AI is taking over, but already if you are a clerk and a cashier, you're seeing your jobs replaced by customers being able to go in and do their own thing.
Your own. So he's back. Okay, we get his answer there. Dan, did you hear the question?
Sorry.
That's all right.
I did hear the question. The notion of automation and union jobs is an old one in the labor movement. And ultimately, they've worked this out. This is true with toll takers. This is true on railroads. Ultimately, there's going to be some kind of arrangement where jobs are safeguarded. In the future, there may be fewer jobs. It would be very enlightened of the management to look towards retraining. That would be a very good way to go, in my opinion. There needs to be a partnership between labor and management.
Is there a resurgence in unionization in the United States these days when you think about SAG-AFTRA on strike, the UAW on strike? Earlier this week, fascinating to me, the Cal State University system went on strike, shut down classes for a day, then that was settled. And agitation for unions at the likes of Starbucks, where they have some, and even Amazon. Are unions coming back?
Well, certainly there's an interest in unions that we have not seen in decades, and there have been some high-profile successes. If you take a look at the actual data, fewer employees are represented by unions today than in the heyday of the 1950s and 1960s. And in fact, it's really less than 7% the private sector, maybe the public sector is 25, 30%. There's no question that there's a great deal of interest and success at the bargaining table. You mentioned the Cal State strike. That's quite interesting. 29,000 faculty at 23 institutions go out for one day. But now what we also hear about that strike is they may have difficulty ratifying that vote, which brings to mind one issue that doesn't come out very often, and that is unions have difficulties managing the expectations of employees. What you do to organize groups and what you do then to negotiate is sometimes at odds. There's an old phrase called bread and butter unionism, and that unionism seems to very concerned with wages, working conditions, and as opposed to the ideological strands within the union movement that want much more out of social unionism. So what's happening today is that you're finding very, very effective organizing efforts in a number of industries, but when you get to the bargaining table, when it comes 50,000 feet to sea level, then it's really a different kettle of fish. And what happens there is that most of the social issues and the organizing issues sort of dissipate, and it focuses more on wages and working conditions. And that's exactly what happened at the Cal State system. But in fact, the union may not have prepared the union well enough to accept what the final settlement was.
Dan, it's good of you to join us today. Thank you for sharing some of your insight and perspective with us.
Thank you so much. Privilege.
Still ahead, flag on the play. The NFL wide receiver charged in an illegal sports gambling scheme, accused of placing thousands of bets while he was underage and while he was playing college football. A legal expert weighs in on who else bears responsibility. when Power Lunch returns.
CNBC.
New England Patriots rookie wide receiver Kayshon Boutte is in some serious trouble with the law over allegations of gambling while he was underage and while he was playing college ball. He was arrested, booked in jail yesterday on a felony count of computer fraud and a misdemeanor charge of underage gambling, according to Louisiana State Police. And they say there could be more charges. The affidavit for Boutte's arrest warrant says FanDuel contacted police to report a possible college athlete making bets under aliases, one of them his mother's. The investigation alleges nearly 9,000 bets over a year, more than $500,000 staked or wagered, bets on himself, all of that. But Boutte is not accused of throwing games. I reached out to FanDuel. It won't comment. I've reached out to gaming regulators in Louisiana. I have yet to hear back. But this raises a lot of questions about integrity in the game and the integrity of betting. Let's dive in further here with Danny Savalos, who's a criminal defense attorney and NBC News legal analyst, and Steve Grasso joins us back as well. Danny, walk me through a little bit the significance of charging a kid. He turned 21 last year. For a year, he was doing some serious gambling that wasn't permitted under aliases, which is where the charges about computer fraud presumably come in.
Yeah, the biggest problem here for him is clearly the felony computer fraud, both on the criminal front and then, of course, on the NFL discipline front. Two different paths here. On the criminal side, the felony, of course, is the bigger deal. And it's also the bigger deal in terms of discipline with the NFL. Any felony will get someone under NFL's personal conduct policy, will subject them to discipline, and I believe an automatic administrative suspension. Strangely enough, the NFL's gambling policy has been relaxed, at least as to betting that doesn't involve NFL teams, or the worst offense is betting against your own team or betting on your own team in the NFL. Betting on college is actually allowed for players, but not NFL personnel. It is really, really confusing. Also punishable for an NFL player is betting on college sports, but at an NFL facility or on an NFL trip. As you can see, it's incredibly complex.
Yeah, and the NFL just changed its policy on suspensions regarding if you get caught. It's 2 years if you get caught betting on professional football. But in this case, we have no indication that Booty bet on professional football or even as a professional player. The allegations that we have seen written out and the charges against him have to do with him betting as a student athlete in Louisiana and betting underage. I'm curious, could there be more charges coming, for instance, against his mother, whose identification he allegedly used, or against the other alias he used is a real person. We don't know whether that was permitted, whether she gave permission for her identity to be used or not. But could other individuals be on the hook?
Yes, potentially. But even if there are other individuals on the hook, it won't get this defendant off the hook. He is not going to be able to pass off liability unless he can make an argument that these were the people who were really involved in the gambling. But that is his biggest uphill battle, is fighting the fraud charges and the misdemeanor charges. And strangely enough, as long as betting on college sports didn't happen at an NFL facility, NFL players and players alone are actually allowed to do that. It's really the criminal allegations that are the biggest problem for this player because of the NFL's personal conduct policy, which, again, as you point out, these things are alleged to have happened while he was a student and not a player. So that might be an out as well.
Yeah, I was just noticing that. I mean, this looks like it took place between 2022 and the spring of 2023, while he would have been a student at LSU. Is that right?
Yeah, that's right.
LSU. And he put 8,900 bets down in a year? My goodness.
Exactly right, yes. And so the other concern, I think, might be, and there's really been no reporting of this, but whether or not the NFL becomes interested to find out, well, what has he been doing since he became an adult? Because obviously these allegations arose out of conduct by a minor, by an underage person who alleged to be gambling. But if the NFL decides to conduct its own investigation, see what he's been doing since then, they may find additional information that could be problematic for him. Not criminally.
And I know for sure that other sports books are looking at their records to see whether they have exposure. I'm curious what you think about, I mean, I covered the gambling companies. What's the danger here for them? What's the danger for the bottom line? What's the danger for investors who might be looking at these companies?
Well, I think it's the liability. So you touched on it before, and Danny mentioned it. So it's very convoluted who's responsible. So it's very difficult to say it was my mother's phone, his phone, who was betting, how was it betting. So there's a lot of, what happens if people want to use this as a nefarious way of getting out of losses that they actually bet and say it was my 16-year-old son who bet it? If you think about it, when you buy something on Apple and it's not you and it's your children and they run up a tab, Apple forgives it. What happens if the tab turns out to be $80,000 every time that we're talking about these things? Isn't it easier? So there's a liability that these companies share. But when you take it back to a DraftKings, when you take it back to something that's pertinent for the conversation, there's so much upside to these stocks. It's up over 170% that the liability is very small.
By the way, and they still want gambling legalized in, for instance, Texas and California, and these things come up with the regulation.
Danny, do you like Kansas City plus the 4.5?
Now we're way, way outside of my area.
All right,
this is not my jurisdiction.
Danny Savalas, thanks very much. All right, still ahead. Out of gas, President Biden pressing pause on a new LNG export projects, a move many are calling a victory for climate activists. We'll get the key details when Power Lunch returns after this.
Reports that Treasury Secretary Yellen is to testify on February 8th before the Senate Banking Committee.
The app today.
Quick market flash for you. Johnson Controls moving sharply higher in the last few minutes as the company considers selling $5 billion worth of some of its HVAC assets. That's according to Bloomberg. Shares are up around 2% intraday. They're at 56.81.
Coming up, rules of engagement. Lawmakers in Florida propose an outright ban on social media users younger than 16. We'll discuss that and much more when Power Lunch returns.
So Trafigura now says an oil tanker is struck by a missile in the Red Sea. So again, this is Trafigura saying that an oil tanker was struck by a missile in the Red Sea.
Book now.
All right, we've got about 3 minutes left in the program and several more stories we'd like to tell you about. Let's get right to it. The Biden administration pausing approvals of pending applications for liquefied natural gas export facilities to countries with which the United States does not have free trade agreements, citing environmental concerns related to climate change as a key reason for the move. We talked about this, Steve, in the last hour with former Secretary of Energy Perry. He sees it as purely a political move.
Yeah, I think it is a political move. And if you look at on the crude production side, we're at historic levels. So that got the base really angry with the Biden administration. This is his way of sort of pulling that back, throttling it back, if you will, and getting them back in his corner. So
pre-election.
Pre-election. I think it's important to realize that our allies will still have the production or the supplies that they need in theory. Hopefully this doesn't expand to a bigger dimension. And this is going to take months to review this case.
Florida's House just passed a bill that would limit youth access to social media by banning new and existing accounts of users younger than 16 years old. Now, the GOP-backed bill would be one of the strictest social media restrictions in the country if passed by the Senate and signed into law by Governor Ron DeSantis. It is unclear how that legislation could be enforced or would be enforced, but you have to wonder if Florida was able to do something like this, that might not affect the bottom line of Facebook and Snapchat and other social media companies. But if other states started to follow suit, if other countries started to follow suit, it could.
This could overlap with our last story on gambling, right? So how do you enforce it? How are you supposed to enforce this type of thing? And it's worth noting that it was a bipartisan decision. So it was equally as many Democrats inside of Florida that were against social media as well for kids underneath 16.
Which, if you can get those two sides to sit down at the same table, then there's something there.
I just think this is better to be left up to the parents, but I do understand the concern. Having 4 kids, you want to get them off them.
What do you do?
So you take their phone away at a certain time, but the problem is when you take their phone away, they say they need it for homework. And then I shut off the Wi-Fi occasionally, and they say they need it for homework. So you really have to be, you can't be an absentee parent. You have to be hands-on.
It's a tough one. We should have been stricter on the phone because now it's all the time.
Of course.
All the time. All right, let's finish off here on 2 dismal tech reports this week. Tesla warning vehicle volume growth in 2024 may be notably lower than last year's, but it was very good last year. You can come down from that number and still have nice growth. Our own Jim Cramer now says the stock has lost its spot among the Magnificent Seven, and also Intel taking a hit after issuing weak guidance. Let's start with Tesla. They may not have the growth they had in unit sales this year that they had last year, but they grew something like 50% last year.
But when you look at Tesla, though, the story was always it was a tech stock. It wasn't an automobile company, and it's being valued now as an automobile company. The AI angle is sort of losing its luster.
We're going to leave it there. Steve, it's been great having you.
Great. Yeah.
Great
Come back, will you?
Thank you.
All right.
Thanks.
Awesome.
Have a great weekend. Closing bell starts now.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange on this Friday. This make or break hour begins with a countdown to that critical week ahead. The Fed, the mega caps, and maybe just the fate of this rally. We will ask the Wharton School's Jeremy Siegel what is likely to happen and where your money is likely to go from here. He joins us in just a moment. We can't wait for that. In the meantime, your scorecard with 60 minutes to go in regulation looks like that. Well, the S&P, it's close to 4,900 yet again, and it's trying to close above that level. We will see over this final stretch if it can get there. NASDAQ, it's somewhat muted today ahead of those key tech earnings next week. You see it just negative by a smidge. Intel, no smidge. It's sliding sharply after its disappointing guidance today. One of the worst stocks in the market today, down 12%. As far as rates go, take a look. The 10-year, after that better than expected read on inflation today, and a pretty nice real-time look at the economy this quarter as well. We're at 416. It takes us right to our talk of the tape. What stocks are likely to do in the weeks ahead and how the next 5 days will be critical to that outcome. Let's ask Wharton Professor of Finance, Jeremy Siegel. You see him there as he joins us now. Professor, welcome back.
Happy to be here, Scott.
I'm so happy to have you with us today because we do have so much important lying ahead. The state of the market today to you is what?
I'm still positive on the market. We are selling for 20 times earnings, although, I mean, if you're a growth stock, you're selling at 25 to 30. If you're a value stock, you're selling at 15, 14. So there is a difference. Overall, 20 is okay. It's not cheap. And I still think we can get 8 to 10% for the year. The economy is still very strong. I think we're actually going to beat 242 earnings on the S&P 500, and as a result, I think stocks could advance.
I mean, earnings haven't been really good, though, to start things off. Are you kind of disappointed with the way we've started? Because, I mean, let's be honest, they just have not been good.
Well, I mean, there's been a few headline ones like Intel, particularly Tesla. I mean, that does
3M,
that.
Tesla,
I mean,
Intel. I mean, I could go on.
Okay, I thought I had read earlier that 70% had beat, which is, I think, a little bit lower than the historical average, which is about 75, 78%. I mean, we have to see how everything falls out of this. But, you know, notwithstanding, I think all the news about a soft landing and no recession keeps on getting stronger and stronger with every day of data that we get.
So you said, I think a moment ago, you could get 8 to 10% this year. I thought the last time we spoke, you were thinking maybe 10 to 15. Have you muted those expectations because what we did towards the end of the year and now where the overall multiple has gone to?
Well, I'm talking about from today. We have gone up a few percent, so that does bring us down a little bit. And the fact that, you know, when take a look at the multiple, I don't think the Fed is, I mean, we're going to hear next week. I think they're going to be really reluctant to say they're going to be lowering rates soon because the economy is so strong, they can afford to stay higher for longer. That might disappoint the street somewhat, although I've maintained that I much rather have a stronger economy with better earnings than the Fed rapidly lowering rates because they see a recession. So I don't think a bull market really depends on them lowering rates quickly, but nonetheless, I think that I think the rates are going to be staying higher for longer. Maybe that will dampen stocks a bit, but I still think, I mean, look at even 8 to 10%. That's still a very, very good return. Yeah. Much better than you're going to get on bonds.
Do you think that the broadening out of the market happens more substantially, and that's how you get the 8 to 10, 12, whatever percent? Or is it still going to be a go big and go home market?
It's so hard to say. I mean, you know, Tesla, is the first of the Mag 7 to fall, if you want to call it that. I think you need more earnings disappointments on those growth stocks to change the momentum, but let's not put that out of, consideration. I think there's a story about how fast things can change. I mean, we were just hearing about Florida passing laws against social media. I mean, what happens? I mean, there's a lot of anti-tech attitudes. What happens if the U.S. Congress decides to move in some way against tech? I mean, what happens to Meta? What happens to all these companies that depend on that? I mean, there's always threats out there. It isn't always, smooth sailing. And as long as there's those threats out there, I would move to those lower PE stocks. They don't need the growth in order to get the great returns that I think are inherent in their companies.
You don't think that if there are, at the words that you just said, these more earnings disappointments for growth stocks, let's say that happens, okay? Do you really think that those stocks can come down, have some kind of corrective phase, and yet the market can still go up because money's going to rotate into those other areas?
Yeah, I think so. I mean, look at the last 2 years. I mean, last year we saw an incredible increase in growth stocks at the expense of the rest of the market. And the year before, we saw exactly the opposite. We saw a collapse of growth stocks, and the rest of the market actually held up very well. So there's a lot of times when you see one segment of the market really move forward without the other segment moving forward. So I can see growth stocks having perhaps a 0 year, while value stocks could have that 10, 15%. Very possible.
0 year. I mean, maybe the course of interest rates plays a role here too, in the way that growth stocks trade. Now, you said earlier that you think the Fed can afford to stay higher for longer, but are you concerned at all that they stay too high for too long and snatch the defeat from the jaws of victory when maybe the data now says they actually should cut?
Well, I mean, I think the inflation data is very good. The sensitive inflation data is also very, very good. But the economy is strong. Listen, I don't think they're really going to be pushing strongly to lower rates until we see the real data weaken. And we have not seen the real data weaken. Now, certainly it could happen. But I think you would have to see some rise in the unemployment report, rise in those jobless claims, some soft, real economic indicators that will persuade them to start moving the rate down. I think at the present time, the sticky parts of inflation are such that they can say, and I think that Jay Powell is going to be very reluctant to say anything about a March decrease or even beyond that. He's going to say that the data dictates. I think the only thing that might be interesting next week is actually is discussion of whether he's going to end QT or not, or whether there's any discussion on that. But I think the rate unchanged, of course, next week, and with no commitment to lower rates in the future, not with the strength of the economy that we see.
Others are saying, there's no reluctance at all. They're arguing that they should cut. On that note, let me bring in our senior economics correspondent, Steve Leisman, to the conversation, because you got my attention earlier, Steve, when you posted this thing from Capital Economics, essentially suggesting that this immaculate disinflation story is here. And that, quote, it's time for Fed officials to take the win and start dialing back the level of policy restrictiveness soon. They're arguing to cut. And maybe they're arguing to cut as early as March.
Yeah, I don't think that's going to happen. I understand what Capital is saying, and I agree with them generally that you do need to start taking some up. But there's a difference, Scott, and I think Professor Siegel laid it out between what might be called tweaking the rate and cutting rates. And I think they're going to be tweaking. I think that'll be a few cuts down. And I think that the question is, and this is, again, sort of same line of thinking as the professor, which is, if the economy's not broke, how much fixing does the Fed actually have to do? The numbers we got yesterday in the GDP report were quite striking. We've been defying a lot of the textbooks with this strong growth and these declining inflation. And I'll just tell you, Scott, that the Atlanta Fed just printed the first quarter. Now, just be really wary of this number because there's not much to go with it. But it's 3% first quarter growth. Now, that's double what our CNBC Rapid Update is, but still it tells you what the trend has been, and the trend has been for stronger growth. So it may mean, Scott, and the Fed may take a lesson from these numbers and decide it is not that far off the neutral rate that it seeks. And so it may decide, hey, we don't need to cut down back to 2.5, which is where the neutral rate is. We may have to do a few on the edges. I still maintain, Scott, that 3/4 point cuts is probably the best bet this year. Every other meeting where the Fed goes carefully, whether that begins in May, perhaps in June, so the Fed cuts on the meetings when they have projections. That's one strategy. I think March is too early, even though the numbers, Scott, are very good when it comes to inflation on 3- and 6-month annualized basis.
I'll tell you what, I mean, you could build a case, Steve, that this is arguably the most perfect scenario for the Fed, in that you have a robust economy, you have a robust stock market, they can stay high for longer, restrictive in some measures, if you will, and avoid a Burnsian mistake, if you would, of the 70s. They don't have to hike again. They can stay where they are and feel good about it because the other data about the economy is letting them do it.
I think that's right. I do think they need to take a little bit off the top. Simple math is that they're 300 points tight, which is you take their long run rate and do it, subtract the 538, it's a little under 300 points of restriction on the economy. Let's say their 2.5 neutral rate is wrong and it's maybe 3 or 3.5. They're still tight. I think there's still some room to let things run. The question that the Fed has to ask itself is whether something, and I'd love the professor's thought on this, whether something more profound is happening beneath the economy. Productivity has come back, Scott, to the point where we are back on trend. There was talk about the idea that maybe we were losing the global supply chain. I'm not really quite sure that's true. And I'll give you an example, which is pretty a little offbeat, which is you look at what's happening in the Red Sea, and we have not seen much in the way of pricing pressure It may be that the global supply chain still exists, which is to suggest that some of the preconditions for the below 2% inflation that we had before the pandemic may still be in place despite people believing that they're going away. I do have a question about corporate profitability in an environment of lowering prices. I think companies had it easier when prices were rising. I think things get a little tougher for companies, but there could be something profound happening beneath the surface, and that higher productivity may mean the Fed has room to reduce rates without creating inflation.
Professor?
Yeah, I mean, first of all, I agree with Steve. I think the neutral rate is 3.5%. I know they had 2.5% for years, but I think that is so. I think we're 2% high and not 3% high. We might even be a little bit higher than that. And so I think that's important. I think one of the reasons that the Fed has gotten away with this so-called immaculate disinflation is honestly because inflationary expectations never really rose during the last 2 years. And I think that has been that has enabled the Fed to slow it down without having to crush it to break expectations. If you take a look at those inflationary expectations figures, yes, they bopped up a bit, but they're all the way back down. And I think that's all the difference between this business cycle and what we saw in the 1970s, where we had 10% inflationary expectations. Took a crush to get that economy down.
It's going to be exciting to look forward to next week. I can't wait to see you, Steve, in the room. Wrap it up real quick, Steve, and then I want to bring in somebody else. Go ahead. I see you want to say something.
I was just going to tell the professor, I was talking this morning with Jeffrey Lacker about the 70s and trying to understand the differences. And Jeff Lacker talked about what he called a catastrophic loss of credibility by the Federal Reserve in the 1970s. That is not the case. The Fed stopped at 5%, way too high in the 70s. The Fed's down near 2% now, and it's not going to be cutting very, very quickly. So I think there are big differences in the concern about this return of inflation. I mean, it won't not happen if the Fed doesn't hold firm on this, but it's not going to come back automatically. This is not the 1970s for a whole lot of reasons.
Yeah, not going to come back automatically just because the economy remains robust is the key point where you're alluding to. Steve, we'll see you next week. I look forward to that. That's Steve Leisman. Let's bring in Shannon Sakosha now of NB Private Wealth into the conversation. So, Shan, it's good to have you with us. You heard the professor. He's still bullish. 8 to 10%, maybe you could still do. We've come a long way in a reasonably short period of time. But what's your own view here?
Well, I think it's interesting because the professor talked a lot about this rotation, if you will, to the laggards that we've been talking about really since the fourth quarter of last year. I'm a bit less optimistic, though, if we're talking about growth stocks returning zero this year, just from a benchmark perspective. That's not going to look and feel great for investors who happen to be overweighted to the S&P 500. But under the surface, I mean, you think about what's happened so far this year, Scott. We've seen a little bit of a tick up in yield since the end of the year. We've seen some, I would say, softness or weakness in some of the interest rate sensitive sectors. But those sectors are the ones that could potentially benefit from a more robust economic environment. Of course, I agree with Steve's concern about top line. There's been a lot. It's been very easy to grow top line over the last couple of years given inflation. However, that bottom line opportunity for a recapture is much more present in our view in some of these sectors that haven't participated. So to the professor's point, do you see a rotation if we see some tech misses next week? The initial reaction is likely to be very negative to that. And then I think there is probably taking a step back, looking elsewhere within the universe to see if there's perhaps opportunities where that threat of multiple compression isn't so large.
Professor, do you think we're late cycle or not? Because I find it hard to believe that you could think we are and then still think that growth stocks could return zero and that these cyclical plays are going to carry us to the gains you think we could do if we're at the end of the road.
Well, it's hard to know, talk about late cycle because we just hit new highs a couple weeks ago. So some people say this is the start of a new bull market. I would hate to think it's near the end. But I do want to point out, I mean, productivity has gone up and AI promises productivity to go up. And that doesn't mean just the growth stocks. AI is designed really to reduce costs to the smaller stocks that have lagged so far behind. One thing is important. You don't need a lot of earnings growth for a 12, 13 PE stock to give you a great return. For a 30 PE stock, you have to keep on churning and not fail.
You know what, Professor? I was having a conversation with somebody who even suggested that these GLP-1 drugs, these weight loss drugs, are going to continue to increase productivity and continue to increase employee retention. And that's all going to be, you know, a stimulus for the economy as well that maybe we're not considering enough.
Well, and reducing health care, which, of course, in the United States has the highest proportion of costs of the OECD countries. So if we can reduce that, we can add productivity to so many other parts of the economy.
Well, you increase corporate profits too in that sense too. If they're shelling out less for their overall health care costs, correct?
Absolutely, absolutely.
Yeah, Shan, we've had these fits and starts with some of these lagging areas of the market. Would you buy those today, or would you feel better ahead of earnings? Let's not forget, mega cap earnings is going to be the talk of everything next week in terms of market positioning. Which is a better buy right now, laggards or the leaders?
Yeah, I still think there's opportunities to add to the laggards because, Scott, if you look at, we do have a little bit of a push here in terms of healthcare and financials. We've seen better performance. They're certainly not performing from a sector perspective as strongly as technology and comm services have thus far this year. But you are seeing a little bit of life, and maybe that's partially on GLP-1. But we saw that last year in those names. There's other parts of healthcare that are getting another look. And so I think if you're looking to position ahead of not necessarily whether it's March or May or whether it's 3 or 4 rate cuts, I think you're looking to position ahead of what could be the next part of this cycle. And whether we're late cycle or early cycle, Scott, we've had several rolling cycles. So I think in thinking about it just from a rates perspective, going into some of these interest rate sensitive areas, whether it's now or lagging it or legging in over the course of the next couple of weeks, most clients, most investors, most funds have exposure to the technology stocks that are reporting next week. We could see some weakness that creates buying opportunities in those laggards, but likely those are not going to be the big movers next week. It's really going to be these big tech names.
Professor, all laggards are not created equal, obviously. What's the best sector right now that you have your eye on?
Well, you know, I don't actually do individual sectors. I like to do classes of stocks. And about value and growth stocks, let me say, it's impossible to tell in the short run, a week, a month, a quarter. But when you go through the data over the longer run, especially right now, we have a 40 to 50% premium on PE ratios of growth relative to value, relative to its historical mean. And that tells you you're set up well for long-term investing in exactly the stocks that we've been talking about, those that have those lower PE ratios.
Professor, I always enjoy our conversations and the debate. I really do. You have a good weekend. We'll see you soon. That's Professor Jeremy Siegel of the Wharton School. Shan, thanks so much. Good weekend to you. We'll see you on the other side. Everyone talking today about Intel's big move. We mentioned it at the very top of the program. It's one of the worst stocks in the market today. It is not the only chip name taking it on the chin either. Christina Partsenevelos looking at that for us. Christina?
Yeah, well, the theme for today, much like Intel, is underwhelming guidance. This time also with KLA. KLA is a chip equipment firm, and they posted weak guidance, but they assured investors that a recovery was underway. Not everyone was convinced, though. That's why shares are down 6%. However, Goldman Sachs was a little bit, which is why they're still maintaining a positive outlook. Switching gears, shares of chip data storage firm Western Digital are down a little bit better, down, just under 3%. On concerns, why, of weaker memory shipments, specifically with NAND. I was just reading a Mizuho note, and they said the bull thesis remains intact because the memory cycle recovery is underway, so they believe this is a buying opportunity specifically for Western Digital, and that's Mizuho. Back over to you, Scott.
All right, tough day for the chips. We'll see you in just a bit. Christina, thank you. We're just getting started. Up next, pumping the brakes on Tesla. Wedbush's Dan Ives is back. He's taken the EV maker off of his best ideas list. And that's just a few days after going to bat for the company and Elon Musk right here on this program.
I still believe they continue to own the market along with BYD, but now you really have to hold serve in terms of what's happened from a price perspective, because this is all overall, in my opinion, the reason that we're long-term bullish, it's just the start of the next phase of the Tesla story.
All right, Dan Ives joins us with the top 10 things Elon Musk must do to turn things around. We'll debate whether he can do it. We're live from the New York Stock Exchange. Closing bell. It's coming right back. Welcome back. Shares of Tesla down 12% since reporting that big Q4 earnings miss the other day. Warning of a slowdown in vehicle volume growth this year as well. Joining me now at Post 9, Wedbush's analyst Dan Ives. He was with me the other day. Just ahead of that report, he doubled down on his bullish case for that company. So he's back. Welcome back.
Great.
Did you come back today to say I was wrong?
All right, man, look, we talked about we were dead wrong in terms of the call into the quarter. I'd almost go and say almost 25 years doing it, probably a top 5 worst call that we've had going into a quarter. We thought, as we talked about, that they'd put the line in the sand for margins. Price cuts are mostly over, and instead, it was a circus show from a conference call. They left the door open for price cuts, didn't give guidance. Musk talked about the 25% in terms of the ownership and the AI, and it went off the rails. And that's why we're here today, basically, looking at it and thinking, like, okay, now what's the step forward? Put out that top 10 list, which we believe could be an inflection point to how we ultimately get higher.
Are you reassessing essentially now everything about this company going forward?
Look, we took it off top picks list because in the near term, from a catalyst perspective, no smoke and mirror. I mean, you don't have the catalyst where you could ultimately say this is going to outperform in the next 30 days, 60 days. Now, in terms of the long-term thesis, look, we remain firmly bullish because it's my view, and it goes back to similar Netflix in 11 with the streaming. You go back to Jobs in 07 with iPhone. We've been through so many different evolutions of companies. I think view this more as an evolution into the next phase with AI, and I view the mass market vehicles sub $30,000. So we don't throw that out, but no doubt in the near term, I mean, it's been a disaster this week.
I look at your rate, you still haven't outperformed, right? So you haven't taken that. How do you fundamentally have an outperform at 1.2 trillion market cap and an outperform now that it's down to 581 billion?
Sure.
It's almost been cut in half. But how do you still have an outperform on it?
Yeah, it's a great question. It's my view that going forward, the margin story, it's going to trough. So I view like when they cut costs, you could actually start to get margin expansion 20, 30%. Then all of a sudden $5 of earnings becomes 8 to 10 when you look out the next 2 years, especially on AI. I mean, our view here is this could be the best long-term AI play out there. And that's what we talk about. I think it's ultimately going to form into some sort of holding structure from an AI perspective with Optimus, Dojo, and others that must take
the best AI play out there. I mean, what are you talking about in terms of automakers? Are you talking in total, like against Microsoft?
So I'm saying longer term, from an automotive and from where they could go with Dojo and Optimus, you could argue that longer term, this is going to turn to much more of a broader company. Now, as we've talked about, the AI revolution is led by the godfather of AI, Jensen, NVIDIA, Microsoft, everything we're seeing in tech. But for Tesla to misevaluate that this will be an AI story, this will be what I view as almost, I'll call it an air pocket, and it's more than an air pocket, but I think we are going to see at one point 2.5, 3 million vehicles per year. And at that point, Scott, we look back at this is more the opportunity, a very bad bump in the road, rather than the time that this is a structural, what I'd say change in the story.
Okay, so you mentioned your top 10 list, and I'm obviously not going to go through all of them. However, you suggest that they should do a $10 billion share buyback because they have roughly $30 billion of cash on hand. In the same token, down the list, you say that they should do an AI acquisition spree and an aggressive one because they have $30 billion of cash to fund deals. I mean, which is it? Do you want them to buy things or you want them to do a buyback? Because you mentioned the same $30 billion in both cases.
And it's not mutually exclusive, especially for a company that generates cash. Look, first and foremost, you got to do a buyback. I mean, the number one thing that you need here is you have to do a buyback because what I view is sort of their view of where the stock is, the cash situation, which really stopped them from buybacks in the past, but no longer. And you got to show confidence. As much as we could talk about the story, you got to, instead of talk, you got to walk the walk. But from an M&A perspective, it goes back to the thesis that the reason you are so bullish on Tesla here, like ourselves over the years, it's because EV, auto, that's just the first step to a much broader AI strategy that I believe they're going to implement. And I think they're in a strong position to do that.
What about this 25% stuff that he keeps talking about? You say he should get a new comp package after you get the Delaware legal issues taken care of. What are you alluding to?
So the new comp package, and that will come out in the proxy, and that's something to really make sure Musk is here for as CEO.
You think the board should give him 25% control?
So I don't believe the board should give him 25%. What I believe is ultimately going to happen, it's not going to be dual class or something in the comp package. I view it as a holding structure where AI, in terms of Dojo, Optimus, a lot of the AI technology that they're developing, Musk has some ownership structure of that holding with incentives, and that through incentives will ultimately get him to 25%. But we do not believe that a dual class will be there or the comp package is going to get him 25%.
I appreciate you coming on. After the call you made the other day and after what happened, we referenced going in that the prior 3 times the day after was ugly for the stock, and we've seen a 4th.
And Scott, we're going to be obviously all the good calls, but when you make a mistake like here, you got to own it.
Well, I appreciate you owning that. I know our viewers do too. Dan, thank you.
Thank you.
That's Dan Ives. Up next, 5-star stock picks. Capital Wealth Planning's Kevin Simpson is back with us to break down his latest trades, including the big tech name he is buying ahead of earnings. That and more after this quick break.
Icy hot.
Welcome back. Next week, marking the busiest of this earnings season. 1/5 of the S&P 500 set to report on their recent quarters. Let's bring in Capital Wealth Planning's Kevin Simpson with how he is positioning. Nice to see you again.
Hey, Scott.
Let's run through some stocks here. I see that you bought Apple again when it reached down to 183, 185. It's been back towards the march towards 200.
Yeah, for those of you following at home, what do you mean you bought back Apple? Because, Scott, you and I talk about it all the time, but we had the position called away around Thanksgiving, effectively at 187.5. The rest of the shares we sold at 192. And, of course, as Murphy's Law would have it, it continued to move up to about 200. Now, I'm not crying over spilled milk. We bought Broadcom. I think it's up 30% since there. But Apple specifically, it backed off 10%, got into the low 180s over the last week and a half, 2 weeks, and we started reinitiating that position. I still think it's a little stretched. I think the multiple's a little bit higher. Maybe we're over our skis. We heard earnings coming out next week. Scott, I expect them to be tepid at best. But Apple's a unique stock, and when I have the opportunity to get back into it more cheaply, less expensively, we absolutely wanted to reinitiate that position.
You sold out of SLB, but you're bullish on energy. Tell us.
Yeah, we got stopped out of it. I mean, I can't stand when that happens, but we follow a rules-based strategy. And as much as we like energy, and we own Chevron, we own ConocoPhillips. Chevron, by the way, had pretty lousy earnings last quarter, so we're going to be watching that very closely. But on a pure price action play, SLB came down and we got stopped out. I think very, very highly of the company, But if the price action isn't there, we've got to recognize and acknowledge our rules-based process. Still owning Chevron, still owning ConocoPhillips gives us good exposure to energy. And I'm not suggesting that we're wrong on that call. I just think maybe we were a little bit early.
You bought sell-to-open calls on Microsoft and Cisco. Explain what that is.
Well, we wrote the calls because we have earnings coming out. And volatility has been so low for the past few years, it's been difficult for us to write options. But when you get into earnings season, you can have some fun with it, because within individual names, you'll see heightened vol going into the earnings, especially with tech names. So if you look at this trade on a 425, we don't expect that to get called away. You know, earnings should be good next week, and you never know what's going to happen. But it allows us to supplement the dividend. And if for some reason Microsoft disappoints, which I'm not expecting, it gives you a little bit of a buffer to the drawdown on the downside. And that's how we look at covered calls, not as a means of generating cash flow just for the sake of cash flow, Scott, but for helping to buffer our portfolio and essentially over time to smooth out the ride.
Jeremy Siegel was with me earlier and suggested, since we're on the topic of mega caps, that you could get zero out of the mega caps this year and still have a really good market year of maybe 8 to 10% more from here. You buy that?
Well, from the professor's mouth to God's ears, because as a value manager and a dividend growth manager, I mean, it's incredibly challenging. And I speak on this firsthand. When your entire asset class or your entire category is basically catatonic in a closet for 2 years, and you're watching a handful of tech stocks go up. So it would be great if he's right. Here's why I don't think he is, because if we see a Fed that's decreasing their interest rate policy, meaning if rates are going down, doesn't matter if it starts in March or it starts in September, if rates are coming down, I think it's constructive for stocks across the board. And I tend to think that people will pay up for growth so that it wouldn't be a growth versus value trade or a tech versus non-tech. But his point about PE ratios, I mean, that really, really resonates with me. So maybe we don't need to see zero growth there. We can see modest growth. But the broadening and the breadth of the market that we started to see at the end of October, that happened to continue in November, December, and here in January, he and I are totally on the same page with that moving forward for 2024.
Well, you could tell that the 20 times multiple was making him a little nervous on the market. Does it the same for you?
Yeah, but he also points out way better than I could that 20 multiple on the market doesn't represent all the stocks. Like so many of the names in our portfolios are well below 16. So that breadth is really important. We haven't seen it in 2 years, but it started. It's those big names that have really expanded their multiples, which is why we sold Apple. You start to get a little nervous up there. Now, we're not a big tech name manager. We can't own these non-dividend growth stocks. But when they get a little bit ahead of their skis, they don't need to fall off the cliff. They can just level out, and the rest of the market can play catch up. And that's really what we've started to see. And I would expect that to continue for the rest of the year, because for the most part, like most stocks, maybe with the exception of NVIDIA, most stocks are where they were at the end of 2021. So there's certainly upward trajectories for these companies that are profitable businesses. They've just seen a little bit of multiple compression, and when they catch a bid, that's when you see the rest of the market move higher. So I agree with everything he said. I'm not sure that we would see zero growth out of these mega caps. They're just too productive a company.
We'll get some clues next week with earnings. Kev, thanks. I appreciate it. Kevin Simpson. We'll see you soon.
Thanks.
Up next, we're tracking the biggest movers as we head into this Friday close. Christina Partsinevelos is standing by with that. Christina.
A company stronger than people realize and management tougher than people think. Those are words used to describe, yes, Coinbase. I'll explain this new bullish thesis next.
the app today.
We're just about 15 away from the closing bell. Back to Christina Partsinevelos now for the stock she has her eye on. Christina.
Colgate stock, which is up about 2%, even though developed markets saw weak to flat volumes in the quarter. Revenue growth was actually propelled not by demand, but by higher prices. Interestingly, China was a talking point during Colgate's call this morning. The company noted, quote, continued softness in China, similar to what we heard from P&G earlier this week. We can still see shares are up about 2%. Coinbase shares getting some love from Oppenheimer analysts with a new outperform rating. They argue that the company will benefit from the recent approval of 10-spot Bitcoin ETFs, and they also bet Coinbase has a pretty good chance of winning its lawsuit against the SEC. This is about operating as an unregistered exchange. But not everyone agrees. Earlier this week, JP Morgan actually downgraded the name. Nonetheless, Coinbase shares are up about 3%.
All right,
Happy
Christina.
Friday.
Yes, you as well. Thanks so much. We'll see you next week. Christina Partsinevelos. Still to come, Meta hitting a fresh record. We'll tell you what's behind that big move and what this hot start to 2024 could mean for the rest of the FANG names ahead. Closing bells coming right back.
Begins here.
We saw through the third quarter, we saw some good spending. In the holidays, we talked about good consumer spending all the way from, Thanksgiving into Cyber Monday.
Well, that was the CEO of American Express 1 week ago with me on Halftime Report. Today, that stock, take a look at it, 7%. It's surging after reporting earnings this morning. We'll have more on what's behind that move when we take you inside the market zone. We'll do it next.
Markets on close imbalanced, 230 million to the buy side.
We're now in the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus Kate Rooney on American Express rallying after its earnings. And Julia Borston on the analysts getting even more bullish now on Meta ahead of its own earnings report next week. Michael, I'll begin with you. We keep trying to make a run at this close at 40. I know you know where I'm going. 4,900. Yep. You mentioned earlier about trying to do this at 4,800. Yeah. Well, here we are again.
And that was just the occasion for about 3 or 4 weeks of kind of sideways, churning around, digesting the previous rally. I don't know if somehow it's going to be a ceiling. If 4,900 is really going to be friction, if we're just hesitating here. But it is the way a market would trade. If the bear case is we're priced for perfection, the bull case is things look pretty perfect. You know, that in other words, all the economic numbers coming through, you know, you couldn't really ask for that much more in terms of the direction of inflation with stronger than expected growth and real personal income and all this stuff staying ahead of what we thought it was going to be. So who knows, you know, tactically speaking, 6 or so days up in a row at a new record. It's a rare streak. When you get these persistent rallies, it means there's underlying strength, but it also means you have to just expect that you're going to hit an air pocket for some reason or none at all.
It is pretty incredible. If, let's just say a year ago you would have said, okay, today you're going to get PCE with a 2 handle, and you're going to get GDP now with a 3 handle.
That's right.
You'd be like, you are crazy. And by the way, and you're going to be at 4,900 on the S&P?
Right. And so you add it all up, and it's 5% plus nominal GDP, with 3% of it now coming from the good part, which is real growth. So, again, it may be too much to ask that it continues exactly this way, but going into the Fed next week, there's actually not as much I think, anxiety or suspense around it, even though, sure, we're going to trade around whether we get a potential rate cut in March or not.
Yeah, absolutely. I think you nailed that. Kate Rooney, American Express. We heard from Stephen Squeri with me last Friday. Now they've delivered their earnings, and the market obviously likes it.
Yeah, Scott, he gave you a great preview. It's a lot of what he said this morning on the call really echoed that interview last week. But Amex has been the winner for the card companies, leading the Dow today. At least if you look at the stock, the big winner. Its positive outlook has been the big driver. Amex forecasted better than expected profits for this year and boosted its dividend. I caught up with Amex's CFO, who told me that higher income consumer that they serve, it's still looking strong, still spending. He pointed to restaurants in particular as a bright spot, topping $100 billion. For the first time, spending was up 11% on restaurants compared to about 6% across the board. Airline spending did slow a bit, though. He also said they're gaining momentum and traction among younger consumers, so Gen Z. Also told me Apple Pay's growth is benefiting Amex. They've got this partnership he called a win-win for both of those companies. Amex saw record revenue, although revenue and earnings were a bit light of expectations. We also had Visa this week calling the consumer resilient, citing holiday and travel spending. So overall, consumers looking strong based on what the card companies are saying, Scott.
Yeah, no doubt. Kay Rooney, thank you so much for that. I mean, it's consistent, Mike, with the story that we were just talking about.
It is. So Visa, American Express. I'll also point to Capital One. It's up almost 5% today. It's up 8.5% on the week. And it also has kind of gotten clear of a lot of the worst worries that you had about rising credit delinquencies, operating in a broader, different part of the market than American Express. So it all looks good. Obviously, it's backward looking, and you got to see if we get fatigue in there in terms of the consumer. But it's an offset to some of the other cyclical companies that have had a little bit more of a downbeat thing to say, whether it's 3M or some of the banks even saying that things look like they might be a slog. So far, it's kind of holding the earnings season together from seeming like it's more give and take than all negative.
Yeah, I would just also throw out what these luxury retailers have reported, and those stocks were absolutely bonkers today, to the upside too. To Julia Boorstin on Meta, as I look here, it's pushing towards $400.
That's right. Meta's hitting more record highs today ahead of earnings, which are coming up on Thursday of next week. And despite the fact that the stock's up nearly 170% in the past 12 months, analysts are increasingly bullish. In fact, Deutsche Bank raising its price target for Meta from $385 to $450, saying their ad checks show that fourth quarter ad spend was strong, saying AI investments have improved monetization across Meta's ad products and enabled efficiency gains. And Baird naming Meta a top pick, seeing ongoing strength in its core ad performance, Reels monetization, messaging monetization, and ramping AI initiatives. Now, Scott, we have counted at least 10 price target increases this month, and we're going to be watching this stock now at $394 ahead of those earnings next week.
Yeah, I know you will. It's going to be a big week. Julia, thank you. It's Julia Boorstin. Do you want to look ahead to mega caps next week?
Yeah, and Meta in particular, it's gone from being these guys can't get it right to can they finally get margins in line to now trading at a pretty hefty premium again. FactSet calculated what companies are supposed to contribute the most to fourth quarter earnings growth. Meta, the single largest contributor based on current forecast, bigger than NVIDIA on year-over-year earnings growth contribution. And even in the first quarter, so the current quarter, four companies are accounting for like 80% of projected earnings growth. That includes Meta, Amazon, Alphabet, NVIDIA. So it shows you why the market has been as concentrated as it has been. It definitely raises the bar for next week. I think everyone remembers 3 months ago, that final week of October was when the market bottomed, and partly that coincided with all these companies coming out and saying, business as usual for us. We're making money hand over fist, and we're actually outdoing expectations. So, yeah, you can see there being a little selling the news stuff.
But, you know, I would have perhaps said that about Netflix as well, and you managed to build on it.
I want your take, too, on what Professor Siegel told me earlier, because I think the most controversial thing that he said out of everything, and the most memorable, perhaps, is that you could get zero out of the mega caps this year, and the market would be just fine, because you get a rotation. You could still do 8 to 10%. You believe that?
I mean, mathematically, it's possible to do just fine, depending on how you determine that. You're talking about 70% of the market is not the big seven, call it. So sure, in theory, if that all moved the right direction, you can't really absorb a lot of outright weakness in those stocks and then still have the S&P do okay. But I think what a lot of people are looking at is you can kind of churn around and digest and have more stocks up than down. You get 55% of all days to the upside for most stocks, and you can build towards something. So it's doable, and I think it's much more about it just not being an either-or market. You don't have to be zero-sum about it.
It's doable if you got what Howard Marks termed like this perfection compounded. That's what you would do. Right. Can't wait to see you next week, because we got a big one in store. Great weekend, everybody. Into OT with Morgan and John.
Pretty good week for all the major indices. Not even bad for the Russell. That's the scorecard on Wall Street. But winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, the S&P 500 and the NASDAQ both snapping a 6-day win streak. Tech, the biggest drag on the market today. Healthcare and energy outperforming the broader market.
Yeah, speaking of tech, Intel, the biggest drag on the Dow, having its worst day since October 2021 following disappointing first quarter guidance. I asked CEO Pat Gelsinger whether it's market share loss or the macro.
Our market share looks healthy. We don't see any unique inventory issues outside of the non-core areas that we've already talked about. So we think the Q1 guide is just where the market is right now in terms of its outlook.
Much more of that interview coming up.
But first, let's get more on today's market action. Mike Santoli joins us from the New York Stock Exchange. Mike, great to kick off the top of the hour with you. It was a really mixed picture for the stocks today, but in general, you look at the Dow, the S&P, and the NASDAQ. 12th positive week,
so for the week
in 13. What does that tell us about what I'll call a potentially blistering rally to start the new year?
It means, for one thing, Morgan, that the market is able to seize upon what remains pretty good economic news. So, you know, at some point,